And with that, ladies and gentlemen, good morning and welcome. 조선, 다가호, 니하오, 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 konnichiwa. 안녕하세요. Salamat datang, merban. And welcome to Liquidity 2026. My name is Andrew Work, and I'm thrilled to be back here on the Liquidity stage for the third time. People have come from across Asia and around the world to be here today. And why? Because we are going to be determining the future of finance. We are looking at the connections between digital assets, tokenized assets, and traditional financial assets, and we are bringing them together. Many of you will be of a little bit of a philosophical bent. You will be familiar with the concept of thesis, antithesis, and finally, synthesis. In the early days of crypto, the word was the thesis. We will crush traditional finance. It will be the end of finance as we know it. Money, central banks will all be destroyed by crypto. And then came the antithesis. The people in traditional finance saying, this crypto's a flash in the pan. It's not worth anything. It's going to come and it's going to go. But we have arrived at synthesis. It has come together, as it must have. Now, it was not always obvious that it was going to be thus. For those who saw the synthesis coming, it required clear and precise thinking. The kind of clear and precise thinking you might expect from, say, an aeronautical engineer. And the man that has brought us here together today began his career and his education as an aeronautical engineer. He was an honest-to-God rocket scientist. He pulled it all together, but he made the switch into the world of finance when he saw the future coming. And the future was digital. It was tokenized. Started one of the greatest quant funds in Asia, massively successful quant fund in digital assets, and he saw the synthesis coming. And so, in 2021, he founded LTP, and he has brought us here together at Liquidity 2026. So please, let's welcome the founder and CEO of LTP, Mr. Jack Yang. Jack, please. Hey. There he is. All right, Jack, the floor is yours.
Thank you. Good morning, everyone. Welcome to Liquidity 2026. And yeah, we meet in the same place, also facing the same price of Bitcoin as last year. I think in the past week, we just experienced a historically volatility in the past 1 week, and the market crashed a lot. That's the things we are facing, and our industry, we are facing the challenges. First one, what is crypto? What the things we are buying, we are investing? It's an equity. We can get benefit from the future cashback. It's a debt with the risk and return, or it's just a speculation instrument. And we are also face the wealth paradox, like a lot of founders, teams. They made a lot of money. They buy a big house. But their token holders face 99% of the drawdown. And also, are we truly decentralized when like something happens to the exchanges or to something, we crash a lot. Are we building the future of finance truly? I think that's the big gap. That's the things we want to build and the reality it is. Yeah, we saw the challenges, but also we are trying to solve that. We see some like healthy trend in this industry. We are not just have crypto, we have more and more tokenization. You can saw in the past 1 year the TVL for RWA token, it's improved from 3 billion to 7 billion. It has been a bridge between the crypto and TradFi. Also, we saw more and more use cases. We are not just like trading speculation. We have the payment, especially in stablecoin. Even the market price is not changed a lot, but the TVL of stablecoin improved a lot. We saw more and more use cases in cross-border payment, in P2P payment. I think stablecoin is the first scalable use case for the token, and it will bring blockchain technology to everyone. Also, we are seeing the market structure is changing. Previously, it's mainly dominated by the centralized crypto exchanges. Now, we have more liquidity on decentralized exchanges. We have more liquidity on TradFi exchanges when we trade like ETFs. It's becoming more and more stable. And we have we LTP, as a prime broker, we have the responsibility to build the best infrastructure for this world, for this industry. So we will strengthen our cross-asset clearing infrastructure for TradFi. We will add more access to TradFi and provide the cross-margin between different assets and also between crypto and TradFi. And also, we are seeing the trend like more and more companies, they are moving their business on chain, make it more transparent, more trustable, and also more efficient, also composable in DeFi world. There are some good cases like Ethena, Maple, they are moving their asset management, lending business on chain, and it gets trust from TradFi. I think that shows the case like business can be done on chain, and you can get the global trust, global access by all the investors in the world. And in this way, everyone needs to be careful about the security. So in our platform, we will increase the insurance coverage to 100 million to make sure every client in our platform can enjoy the high tier of security. And also, I think now, definitely we are in the AI era, AI world. Crypto is also significantly affected by AI. And it will, in the future, will have a good cooperation with AI. That's the things we said last year. Yeah, crypto is the currency for AI agent. In the past 1 year, we saw AI have like very scalable, affect our business or everyone's daily life. We use AI more and more. We saw like we saw more and more AIs be used in coding, in the intelligence layers. Also, we saw a very good trend, like in 1 month, the open cloud. We saw the AI agents is coming. Since even like now, maybe a lot of AI agents at the behind is decided by the human beings. No, but it doesn't matter. It shows the new interface between human beings and the world. Previously, when the client want to interact with DeFi, with the chain, they need to use a private key and interact with a smart contract. It's some not so user friendly, but in the future, you just ask your AI agent to work for you, to trading, buy something, have some jobs. They can pay them. They can buy something by themselves. That's the things we will work for the future, and it will happen soon. From the research of Gartner, by 2030, the GenTech economy will be reached like 13 trillion. It's a huge amount. Things like the GDP in for US is also like 30, around like 30 trillion. That's the big future when we're dealing with all the AI agent. How AI agent can trade, can interact with the Web2 world is hard because they need to get KYC. They need to do the payment at first. It's hard for them to do the small amount transfer. But all the things can be done in crypto world, in DeFi. And also, previously in crypto world, it's hard to have like 1 billion of daily active users, because not everyone wants to have it's hard for everyone to use a wallet to access all the DeFi world. But in the final, all the AI agents, you can have like a daily active AI agents users to use your protocol. We saw the big trend. Now is the time for building. And also, there's one thing we want to announce today. We will launch our Rapid Market Trend version 2. We have been tested for like one year. We served like tens of the clients. They have a very good feedback, very low latency, it's benefited a lot for the HFT firms. And also it will be the infra for the future market data on chain. The AI agent also can consume the real-time market data, can do the trade on chain. That's the things we are building. Yeah, thank you. Thank you for coming here, and hope you can enjoy your day here. Thank you.
All right, thank you very much, Jack, for getting us started off today here at Liquidity 2026. Hong Kong is my home, coming up on 30 years this May. This city was invented and has reinvented and reinvented and reinvented itself time and time again, and now it is reinventing its regulatory and legal framework for the 21st century to maintain its place as one of the world's 3 leading financial centers. Our next speaker is part of the team. He is part of the leadership of the team that is reinventing Hong Kong's financial framework again. He had a tremendous career in banking, but at the same time, he had an impulse to serve the people of Hong Kong, which he did as a district council. Well, in Hong Kong, that's real retail level with the people politics. for many years before he was brought into government proper itself. He now serves as the Undersecretary for Financial Services and the Treasury of the Government of Hong Kong Special Administrative Region of the People's Republic of China. Please welcome Joseph Chan. Joseph, please. Hey. Here it comes. There we go. Thank you, Joseph.
Jack, Ethan, Andrew, distinguished guests, ladies and gentlemen, good morning. It is my great pleasure to join you at Liquidity 2026, the premier institutional summit on digital assets, as we gather under the theme of building next-generation multi-asset infrastructure, building digital assets, tokenized products, and traditional finance. This event could not be more timely or more fitting for Hong Kong's enduring role at the heart of global financial innovation. Well, let me begin by underscoring Hong Kong's position as Asia's leading international financial center. Well, Hong Kong enjoys a distinctive blend of advantages under the one country, two systems principle. Under one country, we enjoy preferential access to the Chinese mainland market, such as the Stock Connect, Bond Connect, mutual recognition funds, or so. And under two systems, Hong Kong's core competitiveness includes free flow of capital, common law legal system, a simple and low tax regime, as well as a regulatory regime compatible with major international markets. These advantages position Hong Kong as the super connector and super value adder between China and international markets, between the East and the West. With this background, Hong Kong has become the leading international financial center in the region, ranked number 3 in the world and number 1 in Asia in the Global Financial Center Index. Well, last year, we topped the league table in terms of funds raised through IPO, and across different other segments, such as Asian international bond issuance, cross-border wealth management, insurance density, and offshore renminbi liquidity, Hong Kong consistently tops the league table in Asia as well. Well, most global financial institutions have established the Asia headquarters or the largest regional presence here in Hong Kong. Then fintech and Web3 companies can enjoy tremendous access to potential customers, potential investors, and potential business partners here, making Hong Kong an ideal place for fintech and Web3 companies to start up and scale up. Indeed, under the Global Financial Centers Index, Hong Kong ranked number 1 globally in fintech offering, a testament to our vibrant ecosystem that continues to attract the world's brightest minds and boldest ventures. The momentum is particularly evident in our approach to digital assets, where Hong Kong is steadfast in ensuring the integrity of our financial systems while we embrace innovation. A pivotal milestone in this journey was the issuance of the Policy Statement 2.0 on the development of digital assets in Hong Kong in June last year. Our statement reaffirms our commitment to establishing Hong Kong as a global hub for digital asset innovation. Building on the foundational measures of the initial policy statement from October 2022, Policy Statement 2.0 introduced the LEAP framework as our roadmap forward. L for legal and regulatory streamlining, E for expanding the suite of tokenized products, A for advancing use cases and cross-sectoral collaboration, and P for people and partnership development. Anchored with the principle of same activity, same risk, same regulation under a risk-based approach, we are crafting a regulatory regime that reflects local circumstances while aligning with international standards and practices. This promotes the healthy, responsible, and sustainable development of the digital asset markets, further strengthening our status as an international financial center. Let me highlight some of our key regulatory progress. Following the implementation of the licensing regime for virtual asset trading platforms back in 2023, with currently now 11 licenses granted, the stablecoin ordinance came into effect in August last year, establishing a licensing regime for issuers of fiat reference stablecoins in Hong Kong. As of the end of third quarter last year, 36 applications had been received from a diverse field including banks, technology companies, security firms, e-commerce players, payment institutions, and Web3 startups, demonstrating robust market interest. With rigorous assessments across reserve assets, effective price stabilization, comprehensive and feasible redemption policies, technological security, and risk management, the Hong Kong Monetary Authority, HKMA, is targeting to issue the first batch of licenses within the first quarter this year. On the other hand, we have completed public consultation on the proposed licensing regimes for digital asset dealing service providers and digital asset custodian service providers, and we are now aiming at introducing the necessary legislations into the Hong Kong Legislative Council within this year, thereby completing comprehensive regulatory coverage of our 4 key nodes in the digital asset ecosystem. Our philosophy on regulation is clear. We firmly believe that encouraging financial innovation is only possible through providing a transparent, certain, and predictable regulatory environment. Our commitment to tokenization is equally bold. Back in 2023, the Hong Kong SR government led by example when we became the first government in the world issuing tokenized government green bond. Then in 2024, the world's first retail accessible tokenized gold products was authorized by SFC and issued in Hong Kong. Afterwards, 5 tokenized money market funds were authorized by SFC by the end of September last year, with around 4 billion Hong Kong dollars in asset under management, marking it the first in the Asia-Pacific region. On the other hand, the HKMA's Project Ensemble Sandbox, launched back in August 2024, and now advancing to its pilot phase as Ensemble TX in November last year, is empowering participants to test tokenized deposits for money market fund transactions and manage liquidity and treasury needs in real time. This real value environment initially settles through the Hong Kong dollar real-time gross settlement system and evolving to 24/7 tokenized central bank money represents a significant milestone in our tokenization ecosystems. Ladies and gentlemen, well, Liquidity 2026 is more than an event. It is a call to action for all of us in industry, regulation, and innovation to collaborate in building sustainable infrastructure that drives institutional adoption of digital assets. By prioritizing stability, investor protection, and real economic benefits, we can harness the transformative potential of these technologies while mitigating risks. So let's work together to shape the future of multi-asset trading, regulatory coordination, blockchain application, and institutional risk management. I wish you all a wonderful summit and a pleasant stay here in Hong Kong. Thank you.
Thank you very much, Joseph. Keep doing what you do. Hong Kong appreciates it. All right, and you can see my friends at the Marriott are leaping into action to bring our first panel up on the stage. For those of you that are tracking the agenda, you know that we have got a dynamite panel coming up here. Joseph said it, market asset trading and market convergence are on the agenda for this panel. And so, come on guys, don't be shy. There we go. That's right. Look at these guys. When I talk about people doing the heavy lifting, literally, they're doing the heavy lifting. And they're doing it so we can get this panel up here and in motion. They're going to be led today by Sheldon Hunt, who's joining us from Sundial, developers of the Sundial protocol. When you check his picture against the man, you'll see that he is very trimmed up on the facial hair, looking very sharp just for you. He's going to be joined up here on stage by a dynamite panel. John Cahill is here from Galaxy. Joining us all the way from Singapore, we have Casey Lam Kok Chung from the Singapore Stock Exchange. He is going to be up here on stage with the very, very fashionable Tom Higgins of Gold Eye. We're going to be having somebody from BitMEX, Stefan Lutz from BitMEX is going to be here. And then finally, seated in the last position on stage is going to be Adrian Tan from Binance. So these are the heavy hitters in our industry. We're excited to have them up here on stage. We're ready for them. Sheldon Hunt, bring your team on up here. Let's go, guys. That's what I'm talking about. Let's have a round of applause for these guys coming on up here. That's what I'm talking about. All right. Good stuff. All right. I'll take one of those. You bet. All right. Go get them. Thanks, Adrian. Cheers.
Okay. Well, good morning, everybody. It is a great honor to be here today. This is my 4th Liquidity Summit, and it really does get better every year. And so kudos to everybody behind the scenes who puts these incredible events on a regular basis. Thank you to Jack and the whole team at LTP. My name is Sheldon Hunt. I'm the CEO and founder of Sundial Protocol, but you're not here to hear me today. If I'm doing my job right, you're going to be listening to 5 of the brightest minds in crypto today. And with that, I'd like to turn it over to you fine gentlemen. Would you like to introduce yourselves?
Sure, thanks to everybody for being here. I'm John Cahill, run Asia for Galaxy Digital, based here in Hong Kong for our Asia business. We do 2 main things. We run a big data center out in Texas, and we also have a big digital assets business. We kind of do everything soup to nuts from sales and trading, asset management, running validators, and everything in between. So thanks for having me.
Hi, I'm Casey Lam. I'm from Singapore Exchange Group, and I head the FX and crypto derivatives. We recently joined the Crypto Club in November last year, so late November last year. So that's the reason why, as a TradFi exchange, I think it's good to basically announce our presence, probably the only TradFi exchange here among the various exchanges. Thank you.
Good morning, everybody. I'm Tom Higgins, and I'm CEO and founder of GoldEye. We are a technology company. We were founded 18 years ago in the traditional finance space in foreign exchange, and then we moved into the digital asset space about 8 or 9 years ago. And we do liquidity aggregation, liquidity management, bridging traditional finance and digital asset finance.
Hi, I'm Stefan Lutz. I'm the CEO of BitMEX. BitMEX is the oldest, still running crypto derivatives exchange, the safest. Our founders basically invented everything you see on crypto derivatives trading these days, which is the market infrastructure. So we see ourselves as bridging as well the individual side of crypto, the crypto natives, with now the more inflowing liquidity from institutions from TradFi.
I am Adrian from Binance. I head the APAC VIP and institutional effort. This means that we cover clients ranging from high net worth retail all the way to single family offices, market making funds, prop firms, asset managers, private banks, sovereigns, and pretty much every institutional player you can think of across the spectrum.
Very good. Thank you very much, gentlemen. Thank you. So yeah, we do have a very diverse panel here, and we've got traditional, we've got some very leading edge Web3, traditional finance together with what we've been seeing. It's a very interesting time. It's actually, so I'll get right into it. So multi-asset trading has been discussed for years. What feels genuinely different this time? What is different about today's convergence compared to previous cycles?
Maybe I'll start with this one then. I think for a long time there were different platforms for different asset classes, and this was never very good for the people who actually wanted to trade them. It was always the idea as a trader that you have one asset, you deposit one lump of money for your margin and you can trade it across different asset classes. But it was very difficult technically to make all that happen. I think what has changed today is that technology has enabled connectivity into all these different spaces. There's lots of other issues like regulation and commercial issues, but from a technical point of view, it's now possible to have one screen with multiple different assets, much as you were saying. And the trader can see one screen with multiple assets on it, one lump of money that they can trade across all of them. That's what's different. The connectivity has now made that possible.
I would love to add on attitude. When I look back at the Liquidity conference and other crypto conferences like years back, we had a completely different set of people sitting here. So what do I mean? Like 5 years ago even, or longer, you had just crypto native guys who came from the Bitcoin space, maybe something else, and they wanted to trade crypto only. So they were very much focused on what can I do in crypto, crypto. They never looked at any TradFi assets at all. It wasn't risky enough. It wasn't volatile enough. That has changed with the wealth that has been created. This year, last year, basically the last 2 years, we have seen a lot of interest in what we now call RWA, which is nothing else than crypto natives wanting to trade TradFi exposure, equities, FX, commodities, which is what we offer too. So they want to margin this in crypto. But at the same time, you have the TradFi institutions who now have interest in being active in that scene as well. So being exposed to especially Bitcoin and the major level 1 protocols. That's basically it. It's not altcoins, it's nothing else, right? So, and here we see it, and this is the convergence we see. Now TradFi institutions or TradFi customers can more and more, not there yet, but more and more trade those with their brokerage accounts. And the crypto natives can actually trade the same exposures with their crypto native accounts, which is like the first step. The ultimate step will be bringing both together, but this is for the next years to come.
I mean, I think the biggest thing that's different is we've evolved as an industry. Like in many ways, for many years, we've been trying to get access to crypto to be more universal. We've tried to get a little bit of regulation to bring more credibility to the space. We've tried to get politicians to understand the space. It was a huge education effort. Crypto won. Like we won round 1, which is credentializing the asset class as a thing that should be investable. And look, allocating 0 to Bitcoin is a perfectly fine investment decision, but it's now part of the framework of portfolio construction, which didn't exist, 5 years ago. If you're a CIO, dismissing, crypto as scammy or unsafe, I don't think that's a credible position to take anymore. And so we're now in a position where we're engaging more with regulators. We're trying to bring these things together because there's real investor demand to include crypto as part of the investing asset classes that they look at. And there's this entire plumbing upgrade that's coming for all of assets. I think, I firmly believe, and we're certainly putting a lot of effort and investment behind it, that everything will be tokenized in the fullness of time. If you have efficiency and you have safety and you have regulations, it just makes sense because it's more efficient. It's not sexy, it's not 1000x, but it's an evolution that's well underway, and I think one direction at this point.
You can see the argument coming from one end, from the crypto native world, coming into multi-asset space in offering multi-asset offerings in their platform. And in a traditional exchange like ours, we already have multi-assets, right? We are strong in equity derivatives, we are strong in cash equities, we have the whole FIG compound, the currency trading, and we added crypto recently. So hopefully we see the two sides coming together, and there is probably a joint sweet spot somewhere that we offered. So from SGX perspective, we took a very hard look at how we should structure this, because from a TradFi exchange, offering crypto is something new. And we want to basically offer the most liquid format as well. So it's not just a futures contract or just an options contract, but it's actually a perpetual contract, right? Just like what the crypto natives are doing. And this is where all the liquidity is. And thanks to both BitMEX and Binance, who have led the way, in a way pioneered, and now one of the largest crypto natives volume. We actually see that this is actually a very important format, because what are we talking about today? We're talking about liquidity, right? So it's liquidity, LTP, having this conference. I think this is important. Liquidity is where we need to basically focus our attention and our resources at. Thank you.
Yeah, I think from a Binance perspective, we typically look at things from a global macro perspective, but then we overlay it and have a localized approach as well. So from a global perspective, we look at it in terms of partnerships. We've announced partnerships with Franklin Templeton. We've announced partnerships with BlackRock. We're definitely moving deep into RWA. The momentum is there. The trend is there. That's not going to stop. I think from a more localized perspective, I can speak personally from all my visits to various APAC countries that we service. The reality is that there's a lot of institutions in each of these individual countries that want to engage. They are very keen to adopt crypto and service their customers and offer them access. The point is how to do it in the framework of clear regulations. That's one of the things that they struggle with, and they are trying to find ways to gain access, but in a legal, regulated framework that allows them the ability to service clients, but at the same time conform to their necessary compliance requirements.
Yeah. Very good. Thank you very much, gentlemen. And now, kind of continuing along the same theme, right? This unified principle, essentially having more of the back-end piping getting unified. So really, from an institutional perspective, what are the main barriers to trading digital and traditional assets side by side within the same unified or single workflow?
Okay, thank you. I think we both got the same comments on this one. Sort of leading on from before, I think you've got technical things, because if you look at the pure technical side of it, you've got different, I'll use the word protocol, but I mean technical protocol rather than coins. So you've got WebSocket, FIX, REST, things like that that are important, because in the traditional finance world, everything is FIX protocol. You would never use anything else. You wouldn't dream of it. And in the traditional crypto space, or in the pure play crypto space rather, it's WebSockets and REST and things like that. So you need a technological layer, something that we provide, to hook the two together. So you've got that problem which is solved by allowing someone who uses FIX to access something on WebSocket, which sounds small, but actually it's quite complex. It's even worse in the DeFi world, by the way. That's completely different and more complicated, but possible. You've then got the regulatory side that we've covered. Is regulatory regimes are completely different in cryptos and traditional assets around the world. They are starting to come together. And then you've got the commercial side of it on things like funding, perpetuals funding every few hours, whereas in the retail FX world, for example, you would have daily financing on things, and so you've got to get your heads around how you're going to charge your clients for funding and financing. So you've got those sort of three areas that are all needing attention.
Totally agree. So it's difficult to add, but what I want to add is, again, this lens of where do you come from? If you come from crypto, if you're really crypto native, your main issue is getting the exposure. So you're usually exposed to crypto only. Now we have equity perps, FX to follow, commodities to follow. But basically, how can I diversify my portfolio without switching infrastructure? So it's, as you said, but the other way around. If you come from more TradFi, it's exactly the same, plus the legal and compliance aspect. Whereas I have to say, the legal and compliance aspect isn't, I mean, it is a thing. You need to be compliant. You're dealing with other people's money. Totally get that. But actually, it won't solve anything. Crypto was invented to basically have the regulatory layer in the technology, right? So BitMEX was founded, for example, on the assumption that we want to provide a counterparty credit riskless trading system. So without recourse, without margin calls, where you don't know what happens the next day, et cetera, et cetera. So we believe this convergence needs to be around this, to really embed technology and the processes that has been invented or have been invented into regulation as well. Right now, the convergence still is very much like, let's copy and paste from TradFi regulation, not acknowledging what we can do with the technology, which would be a different panel. But I still believe there is a little bit way to go before we really have convergence, so that TradFi institutions are happy to jump on a crypto train and the crypto natives to jump on a TradFi train.
Yeah, from the TradFi exchange perspective, our key mandate is to make sure our clients have a seamless approach to trading all the asset class, including crypto. So therein lies also an issue, right? We need to solve for the risk management requirements, because crypto is not like any other asset class. It's high volatility and stuff. So we put in a new risk management framework to enable, to make sure that, you know, all our clearing members are able to buy into this. Because as an exchange, we work with our clearing members, identify how to solve for this risk management framework. They also want a seamless approach in how they trade the product. The same API, for example, the same governance, the surveillance of our market, the robustness of our operational procedures. I have to be consistent, because the collaterals that they pose, right, also has to be the same. So they are so used to basically doing this. So anything that you introduce that is different, right, is going to be challenging. We introduce funding rate as one of the requirements, and that's actually coming through seamlessly through all our ISVs and our software vendors. They provide all that. So coming from the other side, from the institutional perspective, this is something that they are now able to basically trade crypto in a very seamless manner. Same model, same structure, comfort in doing whatever they're doing today, just having a new asset class to trade in and more strategies to deploy. Thank you.
Yeah, I mean, from an institutional perspective, we're ourselves an institutional investor. We run a bunch of asset management products. I think it's a story of harmonization, right? Things have grown up in different verticals with different risk profiles. When you're dealing with bearer assets, you have vastly different ops risk. And orienting, old money, traditional stores of value around those new risks is challenging. Because, when you're the risk guy, your job is to say no. And unless you have a compelling reason to say yes, or the industry has developed tools and the same mechanisms for monitoring portfolio risk and things like that, you're not going to get to yes for any a pension fund or an insurance fund or a sovereign wealth fund. And that takes time and investment, and it's a bit slow. Also, instant settlement is great. It is an enormous step forward to unlock a ton of locked value in markets, but that's scary. A generation ago, if there was a run on a bank, you knew because there was a big long line and there was literal panic in the streets. We saw, 2.5 years, 3 years ago, run on banks that it was
T+14 in some jurisdictions.
Right. So those types of risks can be existential to a bank, and it's not as visible when you have instantaneous movements and settlements. So there needs to be a little bit of an orientation from the oversight side of global markets to get comfort around the process, around the oversight, around dealing with a wallet that might have been tainted 5,000 transactions ago, and then being able to look at that stuff. Now we have those tools, and they get better every year. They become more institutional grade every year, but that's the learning process we're on now, and kind of harmonizing a lot of these different things that are out there.
I like this perspective, and I guess this room will appreciate that as well. When I moved from TradFi to crypto, what I was excited about is really that real-time risk management. You were like on 24/7, but I still remember when I worked at a bank, it's like, okay, let's have an end-of-day flash P&L that you get the next noon. Basically, your risk report was after a week, so that doesn't go together well if you have high volatility and no recourse. Yeah?
Batch processing, yeah.
I think from my perspective, it's a question of whether or not we can get the regulators as well as the institutional players, frankly, together in the same room to really hash it out. In some sense, it's obviously already happening. There's a lot of education that a lot of industry players are already doing. The problem is that if you go from jurisdiction to jurisdiction, every regulator more or less has their own version of what they feel is the right fit for their local markets, which inherently presents a challenge, right? Because if the goal, frankly, is an interoperable setup, where from a consumer perspective, all I want is to be able to click a button and be able to move assets instantaneously across the world, how do I do it from jurisdiction to jurisdiction to jurisdiction without the embedded players providing the infrastructure breaching individual localized regulations? I think that is actually a real challenge. The opportunity here is that with further institutionalization and big players, big global players with a lot of credibility and respect, they are also pushing. So it's not just about crypto native players pushing, but actual global players are actually pushing this same agenda. For the first time, I think, since probably at the end, towards the middle of last year, you started to see the big players started to push along the same agenda. And I think that's really, really a great opportunity for the industry.
I think one of the problems is this industry is a big spectrum of quality, going from the high quality end that we're all talking about, liquidity, to a very low quality end. And I'll give you a story about the low quality end. So last year I went to a conference in Romania, and there were lots of companies there offering pump and dump as a service. So you pay them $20,000 and they will have an influencer to launch a coin for you, and then they would pump it and then they would dump it. And you had this as a complete service. And this was completely acceptable to a whole load of people at this conference. And I chose the wrong conference, obviously, to go to. I was horrified that this still existed. And they said, well, yes, it still exists quite a lot. So because that end of the market still exists, it's tainted by that. And I'm hoping that the flight to quality is going to get rid of that side of things.
But here I don't disagree. And I want to add something. I think this argument is overstretched by far. I mean, I spent more than, 25 years in TradFi. I still remember equities trading in the 90s. I remember derivatives trading in the 2000s. Basically, just 4%, I think, of globally listed stocks account for 90% of all profits. You have a lot of penny stocks, and the volatility in the stock markets these days is not lower than in crypto. So this whole argument around there is scam, there are investments that you shouldn't take, is just a surface level argument. It's not correct, because you need to do your own research. And this is something that the crypto natives, the Bitcoin natives always said. You need to do your own research. If you get yourself involved in meme coins, which isn't bad, it's a choice, then you need to know what you get yourself into. Is it ready for allocation and pension funds? For sure it's not. Really. I mean, this is the only thing we need to say. It's the same thing. Blue chips is okay for pension funds. Well, penny stocks are not. It's the same thing, and we just mistake it because it's based on the same technology.
I agree with that. What I want to say about any speculative bet on any asset, you should, if you're being prudent, follow like an axiom of where there's high volatility, you size accordingly, right? You don't put 15% of your treasury into XYZ crypto if you're not okay with the drawdown potential. That's just basic risk management 101. I don't think the principles of risk management, frankly, are any different for crypto than they are for every other asset class. Gold and silver last week, multiple $1 trillion of intraday value being created and destroyed on a daily basis. Probably we're still there in this market environment. Like I don't understand why crypto is held out as being different. It's another asset which has its own unique volatility profile, which over time has come down an awful lot because there's more participation. The barriers to entry are fewer. The concentration of holders is less, and there's volatility, which is generally a feature.
Yeah, I think it just boils back down to investment discipline, right? I think most of us on this panel have done our 20 plus years in TradFi before moving over, and it basically boils back to first principles: investment discipline, risk management, asset allocation, proper diversification. I think these things, they are like first principles when it comes to TradFi. And I think from the crypto native angle, it's starting to get that way. It didn't used to be that way, right? And it's starting to move towards that. And that's part of growing up and maturing as an industry.
Yeah. Well, oh, sorry.
Yeah, I mean, just want to basically echo some of the sentiment here. All I can agree is that, the crypto has its own attractive volatility profile, and, being a high leverage risk asset, it is actually attractive to some of our participants in the TradFi world, in our exchange, for example. And that's the reason why we've been asked to basically include this asset class in our offering.
Yeah, very good. I wanted to actually come back to something you had mentioned about harmonization. And maybe this is, Adrian, I'll put you on the spot here on the Binance side of things. So the question is, how are exchanges, Binance and others, and other venues thinking about harmonization and harmonization of liquidity across asset classes without compromising market integrity?
I think in terms of harmonizing, it's about actually managing different asset classes, but having a different set of, I would say a different set of liquidity pools, but underlying structure, the technology, the market surveillance, the compliance behind it being of top grade quality. That means the exchanges have done the investments, they've put in the manpower to try and harmonize it for such that liquidity can be supported in all the different asset classes that they offer on exchange. I think from Binance, we have a lot of manpower dedicated to the tech, to the compliance. I think we have like 900 compliance professionals globally. That's a significant chunk of our employee base that's actually just dedicated to making sure that the frameworks are in place, the market surveillance is in place. But ultimately, all that is in service to build the deepest possible liquidity pools for our clients.
I mean, here we tend to agree, I would say, more to the TradFi players. In what aspect? We believe that, as we are a derivatives exchange, right? So forget about spot trading, but derivatives trading. It needs to be basically 24/7, reliable, and fully rules-based. So that means if you have documentation, if you say, for example, the insurance fund mechanism works in a specific way, it needs to work fully automated in basically all the market conditions, which on October 11th, that was the big debate. Did that happen? Did that not happen? I can only speak for ourselves. It totally happened. We had the least liquidations in the market compared to open interest and trading volume. We had the least auto deleveragings, right? So, but that was due to what Adrian said. It's like the investment into the technology and the throughput and the reliability, right? So this is the machine, what the machine should do. This builds trust, if it does, number one. Number two, I think in terms of liquidity pools and bridging that, it still very much is coming back to a thesis I had before. It depends on where you come from, right? If you have large crypto holdings, or let's say Bitcoin holdings, Bitcoin, Ethereum, Solana, that's basically it, maybe one or two others. You want to use them to collateralize your positions because you want to hedge them or you want to take a position. Then your system needs to work and needs to add those other asset classes we spoke about, equities, FX, I mean bonds, RWAs, etc. And the crypto native exchanges are best placed to bring that early on. If you have then switching it, if you come from a fiat world, if you come from brokerage accounts, if you come from TradFi investment, actually you go the other way around because your collateral currency is different. Your collateral currencies are equities, bonds, I mean equities not so much, but bonds and fiat. And you want to use them to trade crypto. This is why SGX is here. Or I mean, Galaxy, you're trying to bridge that in the best possible way, right? So we come from the TradFi, from the crypto native angle. We know people will come from the TradFi angle. The question is, where will we meet in the end in 5 or 6 years' time?
I think it's important that we create a seamless access experience for all our customers, our clients. And that I mentioned that earlier. I mean, some of it have been covered by our esteemed colleagues here in terms of providing technology service, making sure that the user experience, in the case of collateral management, Stefan earlier mentioned as well, for the case of the traditional exchanges and the customers and the institutional customers, they are so used to fiat, right? So how do we then bridge the difference for those who are coming in to our exchange? Let's say, for example, a crypto native participant who is rich in stable coins, but not necessarily in fiat. We are clearing, this is where it gets interesting, right? Our clearing members are also providing that kind of service to provide on-ramp and off-ramp services for those clients who want to basically trade into our exchange. So to our end customers, everything is similar, seamless, same risk management profile, same posting of collateral, same margin cycles, same APIs that they connect into us, right? So that is actually kind of important to make sure that the client have access to all the liquidity pool in an integrated fashion from the exchange perspective.
All right, well, so now kind of, and this is a question I was going to go back to you, Casey, again, and it's really looking at like what lessons from traditional securities, fixed income, commodities, FX markets, and more are most applicable to digital asset market structures today?
Yeah, thanks for that. I think one of the things that maybe instead of answering from the TradFi world, let's look at what we can learn from the crypto native world, right? The 10/10 event had a complete liquidation of 19.1 billion or so, more than FTX event at 1.2 and a recent 2.5 billion on February 2nd. What actually drive that, and what is the market structure from the lens of a TradFi exchange? I think that's very important from us. It's different the way they operate, and in a crypto native world, if I understand how they have evolved, they started off with a fully tightly integrated model, the market structure. And that's because they need to run 24/7. They need to do the broking, the clearing, and it's just the infrastructure at that point in time is not fragmented. They have to do everything in-house. So they evolve in that manner. It's tightly coupled. So in a fast market situation, in situation where crypto or prices were dropping, right, you have to liquidate, right? And you have to basically liquidate at a very high frequency. And you don't even have enough time to back up your collateral. And even then, your collateral, even though it's supposed to be pegged, 1-to-1 to $1, may run a basis at a time of high volatility. So the way we actually constructed our approach to crypto is that we actually look into our existing model. How do we best fit our existing structure to make sure that our client and our clearing members who are not so used to that kind of, auto liquidation model are able to subscribe and fit into this. So we have a batch clearing margining model. We are protected 4 levels. So if a client were to trade our crypto product, the first protection is the IM level, the initial margin, and then the clearing member itself, the funds, and then there's a default fund, and then there is the exchange. So we are protected at 4 different levels at different cycles of time. And we have other process that we introduce for crypto from SGX perspective. We look into when market is illiquid, how do you handle that? Where there's market disruption, how do you manage that, right? So our team and our 24 hours team are actually able to basically look into that and adopted this new SOP that's for crypto asset class. So that's actually some of the things that we learned from the crypto native world. But everything else we are looking at in SGX is, for example, we basically make sure they have the same robust way of basically trading our product, are able to manage and post margin on a regular cycle, et cetera, et cetera. So this is some of the things that we took from the crypto native world.
Something that I'd say because we're like a layer above, the exchange operators are brilliant at what they're doing, but something that we've always done in the traditional finance world is we assume that something is going to break. So when we design some software, assume it will break, and then we model and plan, okay, what happens when it breaks? This is how our system will behave, rather than saying, I hope it's not going to break, I'm going to make it very reliable so it won't break, because when it does, then we're in trouble. So if we design everything like that, then we assume that one of the exchanges will have a problem, and we would suggest to our clients that they would aggregate through multiple exchanges so that they've built in a plan of when something goes wrong, or if something goes wrong, they're automatically covered. So when we had these big liquidation events recently, some people were not pricing at all and others were. And so our clients who were aggregating from multiple sources were still protected, and their clients were fairly unaware that this was going on, even though our broker clients had to deal with particular exchanges that were having problems. So it's like the layer above, assuming that you design something that will cope with failure, so it makes it much more redundant and more available.
I think one of the TradFi concepts that might, in theory, work for us in the crypto space is this concept of circuit breakers. Now, I have no idea how it's going to work, because in the traditional world, you have thousands of brokers, but effectively, they are all participating in similar venues. So the venues themselves can implement the circuit breakers. The issue with the crypto space is we have so many different venues, right, who are all accessing pretty much the same pools of liquidity. So how do you implement a circuit breaker on one exchange that then translates to circuit breakers on all the various other exchanges? Effectively, you'd have to get all the exchanges, or the major ones at least, to come together and to agree on it. But I think events like 10/11 or what we saw on February the 2nd could have benefited from some circuit breakers in the TradFi space.
What I think is the main thing for the crypto world that is already embraced, but it's not fully implemented yet, is kind of, you call it the aspect of third-party custody, right? So of consolidating your holdings, like in a general custodian in the TradFi space via multiple venues. I have to say, like, I love this concept because especially for institutional liquidity, that will unlock a lot. At the same time, it's pretty difficult the moment you go into crypto assets. Why? Because if you don't hold the keys, you actually endanger the winning party of any derivatives trade. And this is often forgotten, right? So the thing is, in the crypto space, the crypto native space, if you have a perpetual contract or a futures contract and you're on the losing side, right? You want to make sure, or on the winning side, it doesn't matter in the first place. So third-party custody is great because you want to make sure that the exchange doesn't run away with your coins. That's number one. So totally acknowledged. Number two, you want to make sure that your collateral is used in the most efficient way over multiple venues to enable what you just said, right? So this is cool. But now imagine another scenario. So you have put on your trades, you're on the winning side, you have a high volatility event, but you don't get your P&L allocated. Why? Because it sits with a third-party custodial venue and they don't unlock the funds that are sitting there from the losing party because they actually dispute the position. This is actually what was solved by the crypto space in the first place by having a full one-to-one allocation, right? So this is what we need to work on, and then to make sure that it works across crypto assets and fiat assets. Then it will unlock a lot. But I want to make sure that all of you keep that in mind. This having the collateral on exchange is not just a risk, it's a feature to protect you if you're on the winning side of the trade.
Any thoughts on that, John? Are you, not to put you on the spot?
No, man, I remember like probably a lot of people in this industry where I was when the FTX news broke. And there was a lot of focus on de-risking exchange risk for about 5 minutes. And look, we've evolved a lot, and there are now a ton of solutions with very credible third-party custodians working with the biggest exchanges that are out there. And those are available, but they're not really being taken up. They're not really being used. I actually want to throw a curveball to the panel and just ask about what does the end state look like? There's a lot of projects out there building central clearing, reinventing the construct that we already know and have relied on in traditional markets for such a long time. Is that part of the solution in the end state, or is it something that's different? I don't know. I'm actually curious to hear people's opinions. I wrestle with this often. Is like, are we just literally just building the same exact thing with better plumbing? Is that the end of our job here, or what are people's thoughts on that?
Stefan? Okay.
Yes and no. Yes, that will happen because that's where all the money is, and the plumbing in the old system is rubbish, but the idea is good. The no bit is when you go into the DeFi world, which is, we've started getting involved in things like Hyperliquid and stuff like that, and the innovation is extraordinary, and the things that are being developed in DeFi are just another level. They're so extraordinary, but they're incredibly complicated for anybody to actually use. And I suspect that world will invent some things that will probably take over from our old traditional world rather than something else.
My view is that it's probably going to happen for some asset classes and not entirely for everything, because I think there's a lot of moving parts here. We have the regulatory part, we mentioned that a lot, but it's also, sometimes there are other stakeholders as well. Regulation aside, right? If you're, let's say you're talking about, tokenizing other things other than crypto, for instance, say commodities or currencies, then you have to get the central bank involved. The legacy system that they have that's globally used, CLS, these are not integrated to any payment system that the crypto world is so used to. So a lot of things, not everything will move at the same speed. Some of them actually with the benefit of, trying to push for efficiency, finality of settlement, like repo, for instance, may actually have a short, right? So I think that it varies. And as regulation becomes clearer, as infrastructure is better and more system and providers coming in to breach that, I think that will happen. But I think it's a journey.
Well, I have a wish and then a more muted version of that might happen. My wish is that we can combine this. Why? I think self-custody and third-party custody is the first step on the way. And I especially say self-custody for individuals as well. If that gets integrated, I think that's a huge step forward. And if that's then integrated with TradFi offerings, great stuff. That is what I wish for. Because where crypto originally came from, and I'm still, let's say, part of this, is like maintain a certain level of control of your own assets, of your store of value. You can argue about that. I'm not here for ideologic reasons, but this is why I wish for it. And third-party custody, let's say, integration of self-custodial wallets will be a thing. There are compliance things, so not discussing that for now. At the same time, I believe that in the next 5 years, or 3 years, whatever, it's 5 years is a lot in this space, we will see way more progress in the overhauling of the plumbing of TradFi. With what's going on in the US, that's actually what happens. It's not about, actually it's not even about Bitcoin. It's about adopting blockchain technology to TradFi systems. That is what it's about. With that, there comes the ability to overhaul clearing mechanisms, to grant direct access for certain individuals, maybe not for all, but for certain individuals, et cetera, et cetera, et cetera. This is why crypto and Bitcoin was invented originally. So I believe we will see, if you look at the surface level, way more progress on that end. And this is where in the next 18 months, 24 months, everyone will look at. But I hope that we can integrate both, because there is, as you say, like there is a layer between centralized TradFi, fully decentralized DeFi models. There is a layer in between that has value.
And so my next question, and this is like building on top of everything you guys have just mentioned, it's maybe a bit of like a step back, but kind of curious, like what is actually driving a lot of this? Is it actually client demand? Is it cost considerations? Is it efficiency? What is, because we could always say, oh, it's all of that. And that's like a bit of a cop-out, but what is, like, in your own opinions, what are the leading drivers here? And so Adrian, you want to...
First principles, it's always about user demand, right? First principles for anything. If there's a user demand, you build the product to try and service that demand. You don't try and sell a product that there's no demand, or you're hoping there's demand. So I think in essence is that from Binance, we are always user-focused. So first is user demand. The fact that there's efficiencies behind it, that's an enabler of the demand. So that's pretty much where we sit. I think just to circle back on a specific point, my view on the overall markets, I'm generally an optimist. So to answer John's question, I think the end game is not only do we overhaul the plumbing of TradFi, we actually create a new world where there's a ton of new applications, a ton of new developments. It's just that the industry as a whole, we've come a long way, but we are still so young in the grand scheme of things. There's so many applications out there that have yet to be developed, that have yet to be created. The amount of brain power invested and youth and energy invested in this industry is tremendous. So I'm very optimistic.
I think a lot of that energy has been wasted.
Oh.
Not the foundational stuff, but crypto's been really good at speculation. That's the #1 use case for crypto to date. The plumbing and the ability to create programmable contracts is an enormous and extremely valuable thing. But we haven't delivered great applications. We haven't delivered, unification of systems. A lot of that just takes time, and there's regulatory burden. There's, all of that stuff, and it's all coming. So I don't want to be. It's actually not a negative statement, but it's a fact. Like there's a lot of good salespeople and marketing people that have raised an enormous amount of money, and not delivered a lot of value back to their investors. That's just a fact. I'm also beyond optimistic. I'm certain directionally that this will move towards the efficient frontier of how to operate. We'll move towards the efficient frontier of competitiveness, where consumers are the winners, and ultimately sovereigns get cheaper and universal access to an enormous menu of investing options, where there are gatekeepers and barriers that frankly don't exist for any reason apart from trying to keep market share, in one ecosystem. And that's going away. That's going to take a while. Even now, we're talking to 50 banks. A lot of them in the US, talking to regional banks all over Asia, all over Europe. Their impetus is to how do we win? How do we win crypto? Oh, that's the wrong orientation. Like, the market wins, the consumer wins, the investor wins, and some of the incumbents that charge big fees are going to have to be competitive with
I think you're wrong,
folks.
I think you're wrong. I think that the banks will always win, because if they haven't done it themselves well, they'll just buy it because they've got all the money. So if something really good comes along, they'll just buy it. So they'll always win.
Building on, I think for us, what drives this demand is our client. Oh, sorry, you want to go? I'll let you have your way. But I think more importantly, if we look at crypto trading for our community and our exchange customers, started off with our financial institution who are very good at trading basis, right? So they see the opportunity in the market, they dabble into it. And as liquidity builds up, our hedge fund participants in our market start looking at it and say, hey, this is actually a big macro trade instrument. So they got excited, they join in. Asset managers trying to be competitive are also keen to basically participate, but there are some restrictions, right? For example, asset managers cannot hold spot crypto for some, and therefore they have to trade other things to have exposure, like a futures or a perp, for instance, right, on a regulated environment. And then obviously corporate will come in to try to basically build on the yield, build on the whole borrowing and lending, and that's how our ecosystem from the TradFi will actually evolve from terms of demand for this crypto asset.
Last word, good sir.
Yeah, let's look at demand, but from a slightly different perspective. We just have a few seconds. I believe, again, it's room for all. And you need to delineate between trading and investing. Investing probably will be TradFi dominated because it's working with other people's money. This flows into trading indirectly. Direct trading, you see it already in TradFi, is a retail game these days. Full stop, and it will be in crypto, and I believe that is here to stay. We have that in DeFi, and we have that in the bridge between the two.
We will have to close it at that. I think we're going to continue this conversation in the back. We are not done here. Well, with that, I want to thank all of you for being here today. Thank you to the panelists for a wonderful discussion, and look forward to seeing you all next year. But with that, round of applause for this wonderful first panel.
Brilliant job to the panel. Brilliant job to our moderator, Sheldon Hunt. Thank you so much, gentlemen. Oh, we're going to get you for a photo right up in the middle here. Yeah, that's right. For those of you in the audience, we've got roughly 10 minutes, maybe 15, but go grab a drink and get right back in here. Maybe make one new friend, not 20. One new friend and get back in, and we're going to have some more action for you. We're bringing you the biggest names in traditional and tokenized assets. So please, we'll see you back in here in 10 to 15. We've got a break brought to you by Avelicom. So thanks to Avelicom for buying everybody a coffee. Thanks. All right. And with that, we are back in action at Liquidity 2026. Earlier today, I talked about the thesis, the antithesis, and the synthesis. And if digital assets, tokenized assets, and traditional finance are going to come together, they have to learn how to talk to each other. They have to learn how to transfer assets from one place to another, melding or merging, or at least building a bridge between the different ways that we account for ownership, as things move back and forth. And so we're going to be talking today about clearing, custody, and the interoperability of markets up here. To do this, we've got a dynamite panel for you. First up, we've got as our moderator, Coco Tong. Coco Tong, who is joining us from The Block. He's bringing, again, mighty fashion to the stage. There seems to be a theme of the day here at Liquidity 2026. She's going to be joined by Andrew Robinson from Coinbase. I'm a customer, one of the heavyweights of the crypto world. Ian Lowe from Ceffu is going to be right up here on stage, helping to make the action happen. It's a double Zong. Of course, I said we got Coco Zong moderating, but we have Amy Zong from Fireblocks, who's going to be joining our panel, along with Darren Jordan of Komanu. So ladies and gentlemen, that's your panel coming to talk to us about what's going on and how we put these markets together. Coco, is your team ready to go? Yeah, let's get them up here on stage. Let's go, guys. Let's hear it for Coco Zong from The Block. Thank you. And here they come. All right, ready for action. There we go. There's Mr. Robinson. Another Andrew. We like that. Yeah, good stuff. Good to have you guys up here. Thank you. Double Zong and Darren Jordan. Thank you very much.
Hello, everyone. Testing. So I'm Coco. Nice to see all of you here. Are you guys having a good day? Yeah? Who was here last year? Yeah, I was here last year as well, and then, like, everybody was just talking about is institutions are gonna move into a crypto world, and nowadays we're talking completely different scenarios here because we're now seeing all the institutional players are full on crypto and digital asset. So before I move on, I just want to have a quick introduction of myself. I'm Coco. I'm working at The Block as an APAC director. And next, I'll move the spotlight to our guests and panelists. So Andrew, you want to do an introduction to our guests?
Yes, thank you. So Andrew Robinson, based out of London. I represent the institutional business for Coinbase in EMEA as well as APAC, and I've been with the company for the last 8 years.
Morning, everyone. I'm Ian. Heard that this has been a good event for the last 2 years. That's why I'm decided to be part of this. I run the crypto custodian, global crypto custodian for the world, connecting to some of the largest exchanges, and happy to be here.
Good morning, everyone. My name is Amy, and I lead the Fireblocks APAC business and been with Fireblocks for almost 6 years at this point. So it's been a long journey and very excited to be here.
Hello, everyone. Darren Jordan, Chief Commercial Officer. Been with Komanu for now 3.5 years, in the regulated digital asset space for 8.5 years. Komanu is a regulated custodian, off-exchange settlement, staking. It's a pleasure to meet you.
Thank you for being here. So yeah, let's just dive into the questions today. So they're obviously very forefront at the new ecosystem, forming the new rules in digital asset with the institutional. And so for my first question is, in terms of institutional skills, do you see that settlement as a bottleneck at the moment? And what kind of things do you think need to be changed, or what's the biggest challenge you face in terms of settlement during your work?
I think that like settlement as a bottleneck is like when you think back to like where we came from, like with a custody from a custody perspective. Custody was largely just cold storage, right? A lot of it was just like hold my keys and that's all you can do. And as like it's evolved, it's become a lot more than that. So custody has become more of like the operating system that allows for like the settlement and also for clearing, and almost like the next gen system for like financial infrastructure, right? If we're going to continue to tokenize all assets, so that bottleneck has to be released from just pure, cold storage, hold my keys, I can't access it, to the ability to like manage the on-chain financial life cycle of all these assets that we're trying to use for cross collateral and for different like use cases and purposes, whether it be stable coins or tokenized credit funds or money market funds or whatever it may be. So I think that really that evolution is what's key, that we need to see happen in real time and continue to evolve in a way that also reduces the counterparty risk.
Ian, do you want to talk about it?
I think from settlement perspective, I would not say that it's a bottleneck. It's just that crypto is a new industry as compared to the TradFi, right? The challenge is trust. The part of the TradFi connecting to the Web3 world, I would say that is, we need to find a way, right? We need to find a way with the exchanges as a custodian together with TradFi on finding that balanced approach on how to make it as seamless as what the current TradFi models has. So fundamentally, I think from my perspective is how do we create that trust and how do you build that trust? Apart from using solid legal fundamentals agreements to safeguard that, and on the other hand, from a technological perspective, how do we put it on chain, create a smooth clearing settlement, and to ensure that the tokens are able to move to where the clients needs them to be. So I think that's from my perspective.
I would say for settlement, a lot of times with the crypto natives is an opportunity. Majority of the funds today that are operating pure crypto space actually take advantage of the fact that you need to go settle assets to and from various different exchanges. There are a lot of challenges associated with that, and therefore they actually make quite a bit of money, whether through cross-exchange arbitrage or they figure out a way to really fast, efficiently, and securely to manage their withdrawals. And various different solutions that we have helped clients develop over time, and that's been a great opportunity. But now, if you look at what's happening in this industry, a lot of the flows are actually happening unrelated to blockchain, right? A lot of flows are coming through ETFs, there are derivative products being built on top of traditional financial infrastructure. Actually, as that industry develops more, a lot of the settlement risk, quote unquote, that happens at a blockchain to exchange to custodian level actually will get removed as more and more of these derivatives products that is traded via traditional financial institutions. You could ask the question of like, is that really good for the industry if everything trades it as an ETF or as an options product settled by CME or wherever, like what's gonna happen to the actual blockchain value, right? But that's the reality of what's happening now. More flows are happening on the derivatives market than they do on chain.
I think the other panelists mentioned some really interesting points. I think if we're bringing blockchain, crypto to institutions, we've kind of got to align with the way institutions think. Now, I previous to digital assets, I was in literally TradFi for 30 years, and if you said to any kind of fund or asset manager, park your assets with an exchange, they would look at you in a very weird way. So I think we need to kind of have a hybrid solution where we work with clients to provide an institutional settlement solution that allows clients to work with exchanges, let exchange be price discovery points, let them be the masters of connectivity and order books, but let the custodian and the settlement layer effectively join the dots and reduce counterparty risk. That's where we see it, and I think initially we started with crypto. We now move away into different areas that include using digital assets for collateral. So it's not just connecting exchanges for settlement layers, it's also connecting other parts of business, whether it's lending, and obviously we've got real world assets, you have repo trades potentially going on. They all need to be settled in a way which is reduction of counterparty risk in a safe, compliant way that institutions understand. I think that's the key here.
Yeah, I think we have talked a little bit, according to Darren and Amy. Right now, the custodian models kind of have to also be involving with more multi-asset kind of involved in, including U.S. Treasury, tokenized treasures, right, and then ETFs and RWAs. Do you see any changes on the custodian models right now that you're working on? Amy, you want to start from that question?
Yes, I think there's a lot of changes happening. So, for example, you're seeing a trend with the retail fintechs. They're actually offering non-custodial wallets to their end retail users. And the reason being is wallets are difficult, compliance is hard, and for a lot of retail users, for them, actually being able to hold assets themselves and eliminate some of the bottlenecks of using MetaMask and using, let's say, Trezor or Ledger, actually brings the next billion users onto the blockchain space. So we're seeing a lot of retail fintechs are actually coming up with non-custodial wallet solutions and allowing users to get access to prediction markets and all the different solutions. So that's on one hand that we're seeing happen. On the institutional side, I actually think a lot of institutions, to be honest, don't care if they self-custody or third-party custodian. At the end of the day, I think first and foremost, unless there's a regulatory requirement where they need to leave assets either with themselves or with other third-party custodians, they're actually looking for sets of functions and features that allow them to really efficiently manage their workflow. So for example, obviously on October 10th, when clients are really like having difficulties moving assets around in high liquidity situations, they needed to have a solution that allows them to, ultimately their wallets are going to determine whether they make money or they lose money on a day like that. So that still happens in our industry, and I think a lot of institutions still really care about it. And then for the TradFi folks, I think a lot of traditional finance definitely wants to do what they're familiar and what they're used to. But a lot of the smart TradFi money actually are demanding a lot more from their wallet or custodians because they also see it as an edge to help them ultimately make more P&Ls as well.
I think Andrew raised a very valid point. Back in the day, custody was literally park your assets in cold storage. There was no utility. You couldn't do anything with it. Generally, most people just sat there. Suddenly now we've got this concept of actually you can do a lot with it, but you don't have to give up risks. So we've been spending a lot of time on the whole collateral management piece. And to your point, I think it was interesting when you say institutions don't care self-custody or managed custody. I think there's a world where they both coexist. Many institutions we talk to, they explore the self-custody model, and to be perfectly honest, they find it complex, challenging. The responsibility of key management, backup keys, is quite a daunting task if they don't have that experience. So for us as a regulated custodian, we've got all that layer around that. But where we think the biggest future now lies in utility around the assets, and that comes in with collateral management, settlement, but also working with partners that are creating real-world assets, tokenized real estate, tokenized money market funds, tokenized anything, using that as collateral, which then leads us into kind of DeFi. We need to bridge the gap between wallets to be able to support DeFi and the regulatory framework that will allow a custodian to participate in that business. And that's coming. There are some interesting conversations with regulators. They're starting to grasp the concept that on-chain vaults, they have some interesting concepts. They need to get their head around the AML concept, but there's definitely movement in that area.
I said it to Darren's point. The line is blurring between like the choice between self-custody and third-party custody, as well as like the line between crypto custodians, right? Which a lot of us are crypto-native custodians, and then also the traditional banks, right? So those lines, I think, as the ecosystem continues to mature, will blur more and more and kind of look like one versus these two distinct ends of the spectrum that we still see to some degree today.
And what is the approach in Coinbase when you're settling different custody models and multi-asset? Is there any special approach to it, or?
I think that there's the approach depends on the client, right? Ultimately, and like what the client needs and what the client wants. But when you think about the, I guess, multi-custodian or provider question, it's really one of like, what are you ultimately trying to solve for? And if you're a hedge fund, or if you're a bank or a broker, is your core business the complex cryptography of like custody? Is it like worrying about the next protocol that's going to come out, or is it like generating alpha or delivering a killer like UI that's going to enable prediction markets or whatever it is? So I think that like coming at it from that perspective, like, do you really want to spend your time on core infrastructure, or is that just more of a distraction for what you should be really focusing on day to day? And I think that for most clients, they realize that, like to Darren's point, they start, I want to do self-custody. And then they're like, okay, I'm going to get like a on-prem solution. I'm going to do this, I'm going to do that. And then they realize that my time to market is going to be a lot longer, and I'm going to be stitching together all these different providers, and that's going to increase enterprise risks and make it a lot more messy, right? So I think it really depends on what your first principles are as the client, being whatever client segment it is, in terms of what you're trying to achieve.
I think the hedge fund industry also is another very interesting one because arguably they are presenting their strategy to the investors. Having a solution that is regulated sitting at the back end is kind of a nice tick box for them. So I think, to your point, it allows them to say, well, we're focused on trading, generating alpha. We're not kind of looking at the noise around how to hold keys in it.
I think that also too, like, if you don't solve, if you have all these different counterparties that you're stitching together, you just create fragmentation, right? And so with that, you increase risk. And we also saw what happened like on October 10th. And so if your collateral, if your assets are trapped on one exchange, when it's under stress, then that mobility becomes harder. And then you start to think about things, Darren, from like that we're familiar with from traditional finance, like cross-margining, right? And so again, there's a cost to just have your capital siloed within one custodian or within one exchange. And so what we're seeing, or what we advise clients on, to your point, is more about the prime brokerage model and kind of bringing the traditional prime brokerage model to crypto in a real way. I know that there's a lot of attempts to do that, but that really does allow the instant settlement and movement of collateral and to be recognized by different venues in real time.
If I can add on to both gentlemen, I think we, from Ceffu, what we do, I think at the end of the day, we started with co-custodian. Should it be self-custody? Should it be the keys should be held by themselves, the clients, or should it be held by us on their behalf for operations? We have gone past that. Reason, because we know that there is a demand in the market to move out of, apart from having the assets that are safeguarded, there is an operational aspect of should it be self-custody or should it be something else? And that's why we start to pilot a program where we connect to the exchanges to bring value or yield to clients that they want to use that. And that goes back to what Darren's saying, because that's where the prime broker comes in, work together with custodian, and with that, the custodian will safeguard the assets. Trusted prime brokers from that perspective, prime brokers will generate yield for the clients. And where does the prime broker goes? And it goes to the various exchange. And that's how we start to run it, to make sure that, first, we make sure that the assets are safe, secured. We help them to solve the problem if they do not want to have that operational, I would say, bottleneck from that perspective. And then, after the funds are safe, how do I generate yield? I mean, if you go to the normal TradFi model, I will generate yield in my CASA account, my cash account, and after that, I will start to put into a wealth account to get it managed. And that's where the prime brokers comes in, and that's where they go to the marketplace where the exchange decides to do that part of things. Of course, on the other hand, there will always be the DeFi angle to things. I'll leave it as it is, because DeFi is something that it is not so widely accepted from a CeFi model at this point. But if you talk about how crypto custodian evolve, this is definitely where we are heading to.
Yeah, and I agree with that, right? So like, particularly like at Coinbase, we realized that that bottleneck, right? So there's no secret that we custody a lot of the assets for the large ETF providers. But what we quickly realized is that there was an underserved client segment, being the crypto native hedge funds, the VC funds, high net worth individuals that were like, hey, like we want our assets to be held in a qualified custodian with like the same like policy engine and controls in place and insurance and SOC certifications, but we want to be able to access that DeFi, the world or the on-chain world, right? So it's almost like you do that at your own risk, but like we can provide that same institutional framework and infrastructure that allows you to access it the same way that you would your cold storage or your other trading or staking functionality.
I think prime brokerage is a very interesting angle because it solves a number of issues, specifically around exchange connectivity, cross-margining. The one thing to be aware of, certainly from coming from a traditional finance background, the balance sheets are not totally there yet. So merging that with a custodial solution to allow a pledge to a prime broker, that solves that problem. So I think that's the angle that the industry is going down at the moment.
But it's not like a balance sheet issue, it's a volatility issue. So if you actually broke down to why prime brokers don't really exist and can't really cross-margining across biggest trading venues for crypto, if you look at where the liquidity are currently being captured, you got the Binance, OKEX, Bybit of the world, who ultimately require you to pre-fund all of these venues. So it's a really balance sheet intensive, but ultimately the volatility is too high for anybody to come in to really properly assess the risk of doing cross-margining. And then you convert it into the other side of the coin, where all the ETFs flows are happening, which is settled in a very unique and a really different way than how the Binance and OKs are being settled. So as a prime broker who will have to come in to manage all these different risks, and with the volatility that we have in market in crypto today, with the leverage that exists in the system across various different venues, it's very difficult for them to raise balance sheet to support that business model. And eventually they're around of money to manage this. And we've seen this happen in our industry where the biggest bottleneck for prime brokers to scale is access to balance sheet. And that's not because they don't have balance sheet, but just rather the market itself is so volatile and so complex that no real proper like balance sheet funders look at this business model and be like, yeah, I'm happy to go and fund your balance sheet and make 20%, 10% on the balance sheet itself. That's really high risk for that money, right?
I still think it's a balance sheet problem. I tell you why, because there's a number of prime brokers out there that need, when you post collateral with them, they need to re-hypothecate it. They have not enough balance sheet to deploy in the market. That is your risk, because your assets then title transfer to that prime broker. You're taking full counterparty risk. There are few out there that we work with that don't need title transfer. And that is a very interesting element here, because you can park your collateral at the, I don't know, tokenized money market fund, generating yield. They've got a lien on that, they've got a security interest on that, but they're not taking title transfer. You still remain the beneficial owner. That is a huge positive. Not all prime brokers can do that. There are a number out there that need they will take your assets and rehypothecate because they don't have a balance sheet themselves of significant size.
And I would say that's like one of the problems, right? Because you have these like intricate webs of bilateral arrangements, and like as long as you still have those bilateral arrangements, like you're not getting a true capital efficiency, right? So you have to break down those silos in order to like solve the balance sheet problem and also like the collateral and asset mobility problem. Because the bilateral, it's slow, it's antiquated.
Yeah. And you're absolutely correct. And that's the reason why I think when you start to look at how to have that balance sheet and to be able to have that liquidity to be able to run that, I think no one should be bearing the risk. Shouldn't be the client, shouldn't be the custodian, of course, shouldn't be the exchanges, definitely shouldn't be the prime brokers. So I think then the question is, what is the kind of framework and the rules that we need to put into the market by the various major players that we can make it fair for everyone, nobody taking additional credit risk, nobody taking unnecessary risk, and when there are bilateral arrangement, that's something that it is not as transparent. So in crypto, we want to be transparent, and we want to make sure that there is a model that is sustainable. There's no individual risk that will be taken by any party within the chain unnecessarily. So I think that's important.
But that model will never really exist unless you go fully funded through a dollar-based product or like a fiat-based product. The second you have got is, say, a coin-based, whether it is Coinbase, a token-based, whether it's Bitcoin, Ethereum funding as your collateral, ultimately, whatever you obfuscate the risk, there's no backstop. You can't print more Bitcoin. You cannot print more Ethereum, right? Like ultimately, if you look at how the financial models and financial industry works in a dollar-based system, ultimate backstop is government backing, right? Like you can always, whatever bank blows up in the end, they can get bailed out. And there's a backing to which that risk, if it's mismanaged, there's a backstop to this. Versus in the coins world, and if you're looking at anything using Bitcoin and Ethereum ultimately as the collateral, you cannot really obfuscate that risk to someone, which means that that risk has to either be distributed across the participants, the venues, the custodians, or something other form of the likes to really distribute that risk, but you can't really obfuscate it in the, call it coin version of this kind of balance sheet management.
Yeah, it is very obvious to the audience that it's a rather complex system, right? And like everybody has a role, and in terms of the infrastructure building, we're still doing it, right? It's slowly, step by step. Are you guys also working with third parties, infrastructures, and what kind of roles they're playing in this, complex system in terms of reducing the fragmentation, the operational?
What do you mean by third-party system?
Third-party infrastructure that helps to reduce the operation fragmentation in this complex system.
I can take that one, because so as a regulated custodian, we actually use a number of different back-end technologies, one of them being Fireblocks. Now, why? People say, why not just build your own? But you have built-in redundancies by using multiple different technology stacks, but also some clients want cold storage, HSM, some clients want MPC, some clients want a long list of supported assets, which may be not available on one technology. So this is not that we just say, oh, we'll just hand over that responsibility to that vendor. We build on top of it. So it becomes the security that forms the base of everything we do, from collateral management to also just vanilla custody and staking. And then we build our own governance layer, API, and all the technology on top of that, and then the regulatory wrapper. So I think, for other custodians do it differently, but you then have a single point of failure. When that technology fails, people can't transact. For us, I think having different technologies, different vendors, that is, yet again, you're working with partners rather than kind of absorbing all that responsibility, but always having that governance at the top.
I think that we take I guess a slightly different stance. It's like a little bit slightly of a hybrid approach depending on how you consider outsourcing. Like when it comes to our core prime brokerage product, of which custody is at the heart of. That's our own infrastructure. Of course, there's like Amazon Web and things you have to bring into it, right, if you're using it, but it's everything that's owned and operated in-house. But because we're very keen about fragmentation, again, capital efficiency, which has become a big theme, when it comes to liquidity, we connect to multiple different venues, right? So bringing the idea of best execution to crypto. Things like staking, we work with third providers to make sure that there's also, one single node that becomes a point of failure. So a bit of a hybrid approach depending on, which element of the prime brokerage services that you're speaking to.
From we adopt that model like you guys, right? Or even Komenu, is the likes of we believe in the right people do the right things. This staking companies, Figment, Kill, and the stuff. We talk to them, we provide the additional services because we focus on our core, which is pretty much on custodian, cold custodian, hot custodian stuff, and we will be connecting to them. Those are the third parties that we use to generate additional yield for the clients. I think the other one that I see, and I've been talking to a couple countries on building, and we will Ceffu to become that third-party custodian for the countries to be able to help them with the infrastructure that's going to be built. Because the largest thing that we see is most country, if not all, believes in the HSM technology, which has been used for hundreds of years or tens of years in the industry. The question is, how do we get a breakthrough on that? We work on having that hybrid approach to have something that they are comfortable with, something that from the crypto world perspective, we are comfortable with, and to have that hybrid model. I believe 4 of us here on this panel, we have been thinking hard to find that breakthrough of where we are of this traditional finance perspective. Because we do have to believe that we have to break through. If not, there is no way there's no way we can make it bigger for the industry and to be that module between the TradFi and the Web3 world.
I would say the worst model you can operate is probably like if you operate in the UK, you have one set of stack that helps you to manage. If you go into the US, there's a different separate stack. And if you're in a place like Hong Kong, that is a completely different set of wallet stack, whether it's custodian or not, where then your team needs to learn how to manage all of that. It's probably the worst model. So in general, I think where the industry is going towards is you can have this operational layer that ultimately allows you to connect to exchanges, connect to custodians, connect to your self-hosted wallets to get you access to DeFi and the various different components, but that operational control sits on the client side. And on the back end, you can be pretty modular. You can swap out different custodian, you can swap out different key technology, whether you want to do HSMs or MPC or whatever versions that is out there in various different jurisdictions, but ultimately the control panel and the control center is managed by the customers and they can decide what is most suitable for them. Because also I think unlike traditional industries, like the crypto industry is very global, right? You speak to the customers, they're not just operating, they're usually operating in like 10 countries at the same time, all have different sets of regulations and requirements. For them, it's super important to have that control center that controls everything. And then get them access to like compliance, travel rule, which is a really big topic at the moment where everybody's trying to figure out. And that in itself is super fragmented for people to comply to. So generally, I think your question around like, do people use third-party technology? They have to, right? It is impossible for a firm to build themselves. And that includes some of the largest firms, which is usually the retail exchanges and the institutional exchanges, all the way to your 2-man in a garage in trading tons of millions of dollars of crypto. Like in this day and age, I feel like a lot of the technology is there now. People have to use third party to get them best-in-class solutions.
Would you say this approach is quite standardized across different countries? As you have mentioned, this solution has to be kind of standardized, but obviously we previously mentioned that clients will have different needs. How would you kind of balance out that standardization and flexibility there?
So most regulators care about AML. Most regulator cares about compliance and control. Some regulators have specific requirement around the technology itself on where to store your keys. Generally, regulators have choices around temperatures of the wallet, right? If you look at it from that perspective, a lot of this is actually, even though they operate across the different globe, the nuance really comes into the back end, which is like where your keys stored, what technology used to store those keys. But the compliance, operational tooling, all of that stuff usually is pretty standard across the jurisdictions. The trend that we're seeing now, as we call it, is called a journey to the West, right? We're like literally West relative to Asia. So essentially, we have a lot of clients who are now effectively applying for the MiCA license, trying to be in Europe because it's a 400-something million population market. It's one license to get you access to 28 different countries. Like a lot of people going for that route. And that's a trend that we're seeing kind of moving towards that direction as well.
I think like one of the biggest things from a regulatory perspective that probably makes the life of a custodian hard when it comes to jurisdictional responsibilities is like if every country or geo goes the route of like you have to have like the private keys or servers like in country, right? Because then to your point, that doesn't give you any scale, and then you have the same thing that you have in the US, that you have in Europe, that you have in Hong Kong, that you have in Dubai, et cetera, right? So I think that that's one of the big whack-a-moles for custodians when trying to think about their right-sizing their global footprint.
And then you got to put balance sheet on the side to get the
capital
license.
against that.
So there's like a lot of challenges I see folks are facing, but at the same time is where the opportunity is, right? Like I think in places like Hong Kong, where it's currently going through really positive regulatory regime, clients are coming to the space and seeing that, hey, like there's licensing to be had, there's opportunity for us to go and operate, and let's take advantage of that and be the first in market and ultimately pick up majority of the flow that you see in a particular country.
Yeah, and it seems like there's a lot of risk involved, right? Because there are so many parties involved. There are third party, there's infrastructures, there are so many parties involved. How do you see the risk ownership in the process and in terms of clearing, custody, and settlement?
If I can take that, I think back to what Amy was saying, that there won't, from a balance sheet perspective, there won't be a single way of balance sheet or solution to that. I think second thing, we know that operating in different jurisdictions, we need to have that operation layer, the single operation layer that is able to help us to simplify things and make things fast. At this current moment, yes, these are all dreams, a vision that we all want to have. The question really is, at the end of the day, we just have to be that good corporate citizen to be able to run that, to be able to understand the risk on each individual component, clients, banks, custodian, prime brokers, exchanges, hedge funds, whatsoever. The full suite. Everybody needs to understand the risk because single point of failure will just crumble the whole process and the whole model that is being set up. And we are running in a very complicated model. Everybody is trying to do their best, and with regulatory enforcement that is being put up in every single country because they have to protect their residents or the businesses. So then the question really is, how can we work towards that? And I would say that it will take a long time. We need more time to make sure that the public and private sector are aligned so that we can have that mechanism to eliminate, not to eliminate, but to bring the risk to the bare minimum that is being able to be tolerated by the users of the framework.
I think you just look at standard diversification, right? We see it in traditional financial markets. We see it here, whether it's diversification of technologies at the back end, whether it's being splitting assets across multiple jurisdictions from a regulatory perspective. The list goes on and on. Certainly from a custodian perspective, we have to prove to regulators that we have control. So if one of those technologies did fail, that we still have the ability to recover the assets and move to another technology provider. That's kind of it's the standard diversification model that we see time and time again. That is how you manage the risk of different vendors. And obviously you have very high stringent requirements for SOC audits, et cetera, and you periodically do reviews of all the vendors, et cetera. But ultimately it's diversification.
Okay, kind of like we're seeing a lot of progress right now, and obviously you guys are working very fast on progressing those things. My last question would be, when do you think that will be a signal to say that the whole system will be matured? What are the signals? And obviously you guys are working hard. This is something that we talk about that would happen in the future. But what kind of milestone would you see that's a signal that's a matured whole system of like tokenized industry in your institutional perspectives?
Yes, like when will the system be like fully updated, I guess, is the way to frame it. And I think that probably like once things like T+1 settlement goes away, right? And so on-chain DVP or delivery versus payment becomes not just a proof of concept, but something that's boring that we no longer mention. I think that that's like kind of like where the reality of like clearing and settlement and everything has gotten to a point that this infrastructure allows us to take it to. The second point of that I would say is like that coupled with like stable coins, right? And so when stable coins becomes more than just, you know, trading settlement and is, again, we're seeing it in real time for like collateral management, for the use of real world assets, for trade financing, for deposits, et cetera. And that there's the regulation, be it MiCA, the Genius Act, whatever, that supports it so that it can be viewed the same way, and that we're seeing it tied to like real world economy use cases and not just like some of the trading volumes that we've seen today. So the two things between the way we think about DVP and the way we think about the use of stable coins or in general all on-chain assets for settlement.
I think you're right, because other thing that I see is, apart from Genius, Clarity, MiCA, Hong Kong's regulations in Singapore, Dubai, these are the major jurisdictions that's taking the forefront. That consistency has to come. As long as from a regulations perspective, we see that there is going to be a push for improvement and progress. I believe the market players, the industry players, the leaders will capitalize on that, and we will start building towards a more make it an environment that is pretty much going to have more adoption. I think it's only from a regulation perspective that we can do that, because if not, industry leaders and players pretty much will be stuck at this current point, and we are really stuck at a certain point. We can only do in small scale, not scalable, and that's pretty hard to have a significant breakthrough from there. So it's only through regulations that I believe that we can move forward.
I think if you look at indicators and signs, you asked the question a few years ago, people probably will agree that, oh, when the institutions come in, that'll be the sign the industry is ready, right? That's a really boring outcome, in my opinion, because if the world goes back to there's only 4 custodians that ultimately holds majority of the assets, and it's US-denominated story, and we go back to the same realm that we had in traditional markets, I think everyone in this room will be quite bored. So I actually think the opposite, which is the convergence between crypto folks launching traditional regulated products in traditional markets, and at the same time, the regulated traditional players offering crypto products. You've seen this happen already on both sides of the pond. That actually, I think, is a more exciting outcome, because to me, we used to think that institutional adoption is the customer, but actually institution is the competition. And that, I think, is a way more exciting view for the future to come, where you see crypto players, or actually crypto native players, are competing head to head with traditional institutions in markets that they both were previously operating in. That, to me, is signs of like, what is institution ready, when are they all happening? Because that means us as the industry has matured enough to operate at a playing field that has historically been dominated by a few players, whilst they're also coming into the crypto industry to go and access to liquidity and so on and so forth.
I think for me, what is a positive sign is custodians working together. I think if we have a world, as you just said, that 4 custodians, that's the big 4 out there, we all know who they are, as in TradFi custodians, you lose innovation, right? These guys can't move quickly. Crypto, digital assets is an industry which moves ultra lightning fast. That would be a disaster. So I think, for me, the success or measure of success would be collaboration between custodians on a settlement layer, to allow, ultimately, what Andrew mentioned, T+0, instant settlement or near instant settlement. We're not just talking about crypto, we're also talking about tokenized real-world assets, we're talking about equities, etc. That is the massive game changer. If we get that to T+0 in the traditional financial market industry, then it revolutionizes the movement of money to a 24/7, where you need more than 4 custodians because you need innovators in the market, and it's not going to be the standard, the usual suspects.
Are you see that coming soon?
It's being worked on. It's being worked on. There are a lot of pilots out there right now. Because people say, why are you tokenizing assets? What's the point? There's some weird stuff with regards to you have to run dual registers because regulation's not caught up yet. The ultimate objective here is to get near instant settlement. And the capital efficiencies alone from moving T+2, T+1 to T+0 is huge. You then overlay that with collateral mobility, that is a game changer, because the whole counterparty risk reduction plays as well.
From our perspective, we try to pilot on that. I think with a couple of the RWAs token, likes of Buildo and USYCs, and absolute, that's the problem. We look at it from a traditional settlement and clearing itself is T+2 or 3. We cut it down to T+1. Then we need to look about T+0. But this is only from a collateral perspective. The question again is, what can it be translated of having a tokenized money market fund to make it into a token or an instrument that we can put it into an exchange to be able to get yield. So this is always something that we are trying to get a breakthrough. Like I say, we can't do something that is on a big scale when we don't have the support. And these are some of the things that we are trying to pilot. So to your question, if it is happening in small scale, but not exactly that big.
So, it's already T+0. So I'll give you an example. For NASDAQ New York Stock Exchange right now, it's settled for T+0 on Fridays. Everybody in this room who work in traditional hedge fund in Asia are waking up on Saturday morning to clear their trades. It's just life right now. And you look at the software vendor that supports the Asia-based hedge funds, they're figuring out how do I do batch trades and all this stuff on Saturday morning. And actually, if you look at the crypto industry, folks, we're already used to this, right? We're used to 24/7 trading. On the weekend, it's fully automated. I actually think that it was interesting. We talk a lot about T+0 and settlement happening internationally, but actually that's why I think the crypto industry and digital asset industry is perfectly suited to trade traditional markets as they go into T+0, because our infrastructure is already set up for that kind of world of settlement speed.
Yeah,
You have more decimal places than they do.
The tokenized money market funds is a classic example, right? There was some liquidity in that, but on a Friday night, you can't redeem the full amount until Monday morning when the underlying market is open. So it's dragging that traditional market infrastructure into the world of digital assets, what we're all working with right now. That's the challenge.
Okay, great. Thank you so much for sharing this comprehensive perspective with the audience today, and we're really glad to have you. Thanks for sharing again. Let's give them a big round of applause to thank them for sharing this amazing insights. All right. That's all for today. Thank you all.
All right, wonderful job, Coco. If we could get you guys in for a photo right up here in the front, there you go. Tight, there you go. Come in close. You're all friends now. Fantastic. There we go. Thank you so much. Coco, you did an absolutely magnificent job, as always, moderating this panel, for which we appreciate it. There we go. All right. Thank you very much once again. All right. As we all head off, thank you very much. There we go. Love another Andrew. All right. Good stuff, Coco. Great job. One of the wonderful things about crypto is has always been the idea behind it that we are democratizing investment, democratizing finance. Outside of crypto, there was a company that really embodied that. A pioneer, we would have called them a fintech firm, and of course that was Robinhood. And later on, as somebody who came in and kicked over the apple cart of traditional finance, they later said, listen, we're joining the crypto party. And so we're excited to hear from them today about how they are going to bring the next 100 million investors into the party. We've got a little fireside chat set up for you now. And we have Sean Lee, who is the founder of OSN, one of the leading lights of crypto right here in Hong Kong. He's also a contributor to Forbes. So if you like what you hear, you can check him out on Forbes to get more of his thinking. But he is going to be interviewing Johan Kerbrat, who is the Senior Vice President and General Manager of Crypto at Robinhood. He's an engineer's engineer. He did it at Airbnb, did it at Uber until Robinhood said, we have to have this guy. And he rose up to SVP and General Manager of Crypto. So please welcome Sean Lee and Johan Kerbrat, please. There we go. Take it away, gentlemen. All right. Go get them.
All right. How's everyone doing today? The first day of Consensus Week, so lots of activities, lots of guests coming into town, including my guest of honor for the fireside chat here. So let's talk a little bit about this particular topic, right? 100 million investors. Maybe what we start with first is 100 million users, right? And then we can potentially go into the investor side. And I think there's probably no one better to really talk about what it takes to build the infrastructure for such a large number of users. With Joanne, you know, coming from Airbnb, Uber, and then obviously now Robinhood, maybe talk a little bit about your journey in terms of what you see from the perspective of user acquisitions from that perspective.
Yeah, you've done your research. So, you know, I think for us, for a very long time, crypto has been focused on just trading of assets, crypto-made assets. And so at some point, we're forgetting a lot about the actual technology behind it. And what we believe at Robinhood is that we can actually use this technology for a lot more things, from payments to actually transacting traditional finance instruments. And that's how we are really focusing on. Basically, for us, the idea of you buying a tokenized asset shouldn't be you have to create your own wallet with your private key, you have to pay gas fees, you have to bridge to a different chain. All this complexity, we need to remove it and abstract it away, and just focus on the actual kind of usage that people want to do. So, you know, for us, we have about 26 million plus customers, and our goal is to bring the other 100 million by really focusing on what are they trying to do and how do we give as much value as possible to the customer.
So maybe let's dive deeper a little bit into that. So as one of the leading fintech companies in the world, both from a regulatory perspective and obviously from a banking services side, how are you seeing some of the similarities and or differences between what a traditional kind of banking service provider now and the crypto service provider? What are some of the intricate similarities and differences that you see on that front?
Well, you know, I think there's a few different issues right now. The traditional system is still very slow. We just celebrated in the US moving from T+1 to T+2, the opposite, from T+2 to T+1. So that means that you still need a full business day to sell a transaction where you're buying stocks. And you know, imagine on a long weekend, you buy on Friday, you need to wait on Tuesday to actually get the receipt of your stock. And that's where we think the technology can really change things. By default, crypto is 24/7, fractionalization, instant transfer. So all of this can really reduce the cost of capital, reduce counterparty risk between companies, and at the end, all this cost saving can be actually pulled back to the customer, and the customer will have to pay less fees, or they will have to worry less about, you know, what can happen to their portfolio. There's a few things missing here. We need the regulatory clarity in a lot of places, including in the US. And we also need companies to start adopting the system. And we saw it with stablecoin. It took a bit of a while, you know, like the culture shift had to happen before people started to use it. But now everyone understands the efficiency and the benefit from a stablecoin. And so we want to bring that also for traditional assets like stocks, ETF, private equity, and more.
So how exactly does that work though, right? So you mentioned in the crypto industry, obviously it's 24/7, right? And with many trading venues all around the world in different time zones. With stocks, I know you guys have already tokenized more than 500 US stocks and ETFs and whatnot. So how do you actually synchronize between the traditional markets and then now a tokenized versions that potentially could be trading 24/7? So how does that work, both from a process perspective and maybe talk a little bit about the infrastructure side as well?
Yeah, so our main focus has been on our tokenization engine, really building a way to scale to any type of assets and any type of exchange. We started with the US. We have about 2,000 stocks token now. So really our goal was to make sure that we could give as much access to a wide array of assets, because nobody really want to have like just a limited amount of assets in their portfolio. And so, you know, for us, every time you buy a stock, every time you buy a stock token, we'll buy the same stock to make sure that we're always one-to-one. That's the most important part. If you remove the trust on an asset that is tokenized, you know, you're going to lose the market. And then during the market hours, obviously the price is pegged to what's going on in the market. And off market, we are making sure that we have enough liquidity providers and LPs and market makers to make sure that the peg is pretty close to the price. And obviously, you know, during weekends when there are big events, you will see volatility. But you know, nothing that is new, and you have the future of a market that is also allowing you to kind of making sure the price like stay pretty flat.
And are you seeing some unique requirements from the regulators in the markets that you operate in terms of how they would recognize in terms of how you're structuring this? Because obviously they're very used to the traditional market and how that works. And now that you're moving things on chain and running 24/7, there must be some requirements that they might have instituted. So I'm sure you've had many of these conversations with them. I myself have many of these conversations as well. So what are some of the interesting things that you find in these conversations, let's say in the US or in the European markets?
Yeah, I think we're still at the very beginning. So in the EU, we have a derivative structure to make sure that we can actually tokenize as many things as possible. In the US, we're still at the beginning, I think, of the discussion. So, the SEC mentioned that a tokenized security is still a security, which we completely agree with. We don't think the crypto technology is a way to bypass the regulation. We think it's just a way to enhance the market and the capital. And so, I think for us, at this point, we're fairly flexible. Our tokenization engine has been working for a while now, and we know that it's pretty easy to adapt. And it's more a question of like, how do we get past of this regulatory discussion? How do we get this built down in the US and in other places in the world? And actually get all the market makers and participants to embrace the technology. So, right now you see a lot of announcements from NYSE, NASDAQ, DTC, all of these things, but no one is actually using it just yet. So, we want to focus more on actually building and less about just like discussing.
So let's talk a bit about the number. Let's go back to the number a little bit, right? So we talk about the infrastructure, kind of the regulatory considerations that Robinhood is really focusing on. To get to 100 million users or above, obviously it's the US market, the European markets, the more developed kind of markets, but I'm sure you're looking into the developing and emerging markets. Are you looking into that as well? Because obviously they may have very different requirements, right? Like if you look at someone potentially from Africa or Southeast Asia, they might be looking at these tokenized products in very different light than a North American or European player. So what are you seeing that might be very unique in that regard?
Yeah, I mean, that's a part that we're the most excited about. I think right now, if you think about someone in Africa, like you mentioned, or someone somewhere else in the world where they want to get access to the US stock market, usually they don't have a ton of choices, they don't have a ton of brokers that can actually even support their account, and then they will pay a lot of fees. And so we think that the tokenized version of our assets allows them to access it for the best price, and they don't have all this complexity to even open an account. The other part is on the other way around. Right now we talked a lot about the US stock market, but you could actually use the same technology for any type of stock market in the world. So from the London Stock Exchange to the Singaporean Stock Exchange or Hong Kong, since we're here. And so you give also access to the Americans or to the other places in the country to actually invest in those markets that otherwise it's very, very difficult to get access to. So I think it's going to democratize not just the access but to the US market, but also to the other markets in the world.
So I think that's quite interesting. So what you're saying here is potentially the term dual listing that we know of traditionally might have very, very different meaning now.
Absolutely.
Right? So not only geographical listing, but also from an off-chain and on-chain perspective. And you talked about potentially not only working with the more kind of US-centric financial products, but also products from other places. So if you look at it from that side, then are you, as a company, are you looking to democratize access to products across the board? Because I'm sure there's going to be a lot of friction and a lot of restrictions potentially, right? Either from the regulatory bodies or from other local exchanges and financial institutions that may not like that as much.
I think, as much as we've talked to regulators and to different countries, they are pretty excited about it because right now, if I ask you, how do you invest in a Nordic exchange in Europe, it's quite difficult. Even if you're a savvy financial investor, you don't have a lot of brokerage that allows you to do that. And on top of that, you have fees all the way. But at the same time, the Nordic countries, they want investment to come in. They want people to invest in their country. So, You have like some wrapper mechanism, like ADR, for example, on the US market. But at the end of the day, it's still so difficult. And so I think that's where the beauty of the technology comes in. You will be able to access all these markets, and customer will be able to actually invest in things that they don't necessarily had access until now. And so I think in the term of energy, AI, all these things that have been developed, not everything is happening in the US, right? There's a lot of things being developed everywhere in the world. And so it will give a lot more accessibility to everyone. And at the end of the day, that's been our main focus for Robin. And we focus on accessibility, making sure that we remove the barrier to entry and reducing the cost to the end customer.
So you and I were catching up a little bit earlier before the fireside chat. You're here in Hong Kong for a few days, and then you're going to head to Southeast Asia. And I've noticed that recently there's been a number of acquisitions that Robinhood has made. I'm assuming, based on what you're sharing with us right now, that these are part of the strategy in not only growing that user base, but more importantly, gaining access to products that may be available in the local markets. Maybe tell us a little bit about that.
Yeah, that's right. We did a few acquisitions. Bitstamp, which is an exchange mostly focused on order book, deep execution, liquidity. We have crypto as a service that allows bank and other provider to offer crypto services to their customer. We also acquired a company, we announced the acquisition of a company called WonderFi in Canada, in Toronto. And so for us, it was the idea of accessing the Canadian market, not just the customers, but also having connectivity with market makers and exchanges there. And recently we announced the acquisition in Indonesia of two companies, one a brokerage and one is a crypto company. And so we are pretty excited about the Indonesian market. There is 13 million plus customers that invest in crypto over there. And we also think it's one of these markets where the exchange, for example, is very difficult to access, and we think we can bring a lot of value to that customer.
I mean, it is the fourth most populous country in the world.
It's a huge.
And I think I read somewhere that the median age is like under 35, right? For the entire population. So that's a massive market to really tackle. And I think it really plays to the point that you mentioned, gaining accessibility, right? For the young kind of working class in countries like Indonesia, how do they get access, right? Through very simplified means. We've got a few minutes left, so let me switch a little bit back to kind of your roots, right? Your engineering roots. And I recall that this weekend there was a news that I saw across the newswire about an exchange. Someone did a fat finger. Again, it seems like every month we see one of these, and a lot of the users were given thousands of bitcoins each. So it speaks to the potential of expanding beyond your scope and attracting new products, especially going on different type of infrastructure. But it also talks to the risk. So if you were to kind of wear your engineer hat back on, what are some of the things that you guys are doing to make sure those type of issues will never appear?
Yeah, it's a difficult one because, those issues existed for a very long time, except that crypto brings this instant and decentralized platform where in this situation, for example, if you get the 2,000 Bitcoin and you're fast enough to withdraw them, it's gone forever. And so back in the days, you will just reset the database and call it a day and, no one saw anything. So it's a very different world, and so we have to be careful. That's why Robinhood is usually not the first to launch product. We are very focused on how do we make it safe to our customer? How do we make it safe for the company? And so we spend a lot of time on doing red tests. For example, we have a team of hackers that are going to try to hack our system and making sure that we basically are bulletproof in many ways. But it is very important. At the end of the day, this is a new technology. People need to trust it. We had many issues in the past between Mt. Gox to FTX to other. And so for us, a lot of our focus is making sure that we bring this security so that customers don't have this constant fear of their assets. And at the end of the day, for a lot of customers, the solution is to decentralize and to go to self-custody. I don't think it's necessarily the answer, right? It's still very complicated to self-custody. You don't necessarily want to deal with it. And so I think centralized players still have a role to play here and just need to focus a bit more on safety first.
All right, so last question. I know we're coming up in time. Instead of asking you your projection over the next 3 years or 5 years of Bitcoin price or anything like that, let's stay away from that.
Thank you.
You have a few more days in Hong Kong. What are going to be some of the things that you look forward to doing while you're here?
Well, it's always super exciting to be here. I was here last year, and the enthusiasm at the conference was really big, and it was the first really big conference I did in Asia before Token 2049. And I think what's exciting is to see how much the local community wants to bring this technology here. So I think there is a lot more to do, and pretty excited to spend time here.
Excellent. Well, help me give me a hand to Johan. Thank you.
Thank you.
All right, great job, you guys. If you don't mind, I think our photographer would like to get a shot of you two good-looking gentlemen. Fantastic. There we go. And let's see. Are we changing up the furniture? We are. Okay, good. Hopefully our boys are standing by. There we go. Merci encore, Johan. C'était vraiment super. Sean, thank you very much. There we go. Fellow Canadian. That's what I like there. Sean Lee. All right, so very good. So we are moving on now with our next speaker. He is Corey Liu. He is the head of APAC for Duro Labs, who are developing the Pith network. He was with Paradox, and so he is going to be coming to speak to us today. He's got a great smile and a great message for us. Please welcome Corey Liu of Duro Labs and the Pith network. Corey, let's go. All right.
All right, hey everyone, I'm Corey Liu. I'm head of APAC for Duro Labs, and we are building the Pith network. I'm here to tell you today about a $50 billion industry. Let me start by asking a question. How many of you know these following companies? Bloomberg, LSEG, FactSet. Most people outside of finance don't know these companies, but I'm sure most of you know these. But what if I told you that combined, they are worth over $180 billion? And no, they are not AI companies. But what do? What makes up this valuation? Financial market data. Here's another question. How much do you think companies spent on financial market data in 2024? $1 billion, $2 billion, $10 billion? I'll give you a hint. If you had invested in financial market data 25 years ago, you would have outperformed the following assets. Gold by 2x, the S&P by 7x, oil by 18-fold. Financial market data generates over $50 billion annually. The cost of market data has increased more than 15-fold in the last 25 years. So you might be wondering, why? Isn't the price of Bitcoin, Nvidia, gold just public information? Can't we just type this into Google and just find the price? Well, the answer is quite simple. Data quality. High-quality data is extremely valuable because low-quality market data leads to people getting ripped off. How do you know you're getting the best price for something? How do you know you're getting the best price for even the most simplest of assets, like a cauliflower? All right, technical difficulties. Yes, we're waiting for the video to kick in. All right, pretend there was a video about various different cauliflowers, and there is a difference between the quality of the cauliflower. So pretend you're at the supermarket with your husband and wife, and then the wife picks a piece of cauliflower. Obviously, it's the best cauliflower in the supermarket, but the husband picks it, and it's the worst cauliflower. So the point of the video was supposed to show that there is a variety of quality data, of quality cauliflower. So connecting back, quality data is worth a premium, but historically, it's been fragmented and inaccessible. PIF aims to provide the highest quality data for the lowest possible price. How, you ask? That's a great question. A new economic model for market data through blockchain innovation. Let me show you what the old model used to look like. So for context, before this model, let me define market data. Market data is the price to buy an asset and the price to sell an asset. Effectively, it's a bid ask and you have a mid price, right? So this is a list of traders, banks, HFTs, firms, etc. These are the counterparties that are providing liquidity and giving you a price. So these institutions, they connect to the exchanges and the various geographics of them and all of the products. So the next step looks something like this. Whoosh, a lot of different connections out here and very convoluted. Then afterwards, these exchanges specifically connect to the distributors. So you have the Bloombergs, the Refinitives, the FactSets, etc., that take this data individually and then repackage it and sell it back to the institutions. But afterwards, the institutions are forced to aggregate the data again, so adds another step into the process. So that's what it looks like before. So let me show you what the new model will look like. Okay, so we have PIF acting as a price layer. So notice on the trader side, on the flowchart here, it is directly streaming into the price layer, and the exchanges are directly streaming into the price layer, leading to, for us, for PIF to aggregate the market data, and then we can sell an aggregated high-quality stream back to the institutions providing better data. This combination of quality, quantity, and cost has never been possible before. We have a chart here. So there are many exchanges here showing fragmentation and lower quality, but higher quality for higher costs, obviously. But if we add PIF into this, boom, low cost, high quality. So to give you some context, we launched PIF Pro about 2 months ago. It is designed to be the ultimate subscription for financial market data, but built by and for institutions. It's like Spotify, but for market data. One subscription, one fee, every asset class, updated every millisecond, sourced from the best traders in the world. And the best part, it's 10 times less expensive than anything else on the market. Since launch, PIF Pro already has 10 weekly institutional inbounds, over 80 active subscribers, and over 1 million ARR in the first month. And we also we've empowering all of the popular RWAs that you've been seeing on centralized exchanges. Think of Binance launching their new silver perps, HIP3 markets across Hyperliquid. We've empowering all of that infrastructure with our new customer base. So connecting this back, going back to, let's say, did you know that less than 5% of software sales companies have achieved 1 million ARR in their first year of monetization? And we have already achieved that at PIF. So this is just the beginning. If PIF manages to capture 1% of this $50 billion industry, that's $500 million in annual revenue. But where does that revenue go? That's a good question. It goes into the PIF reserve, a tokenomics update designed for systematic value accrual. How does it work, you ask? Subscription revenue flows into the PIF DAO. The PIF DAO buys PIF tokens on the open market. The purchased PIF is held in the PIF reserve. This is what the flowchart will look like. All the revenues from PIF Pro, PIF Core, Entropy will flow to the treasury, and then a monthly percentage is purchased PIF on the open market into the PIF reserve. More product adoption equals more network value. Institutions are willing to pay for PIF data, and now the value will flow to the PIF ecosystem. For more information, please scan this. If you are an institution that would like to test their data or provide data to the PIF network, I would love to connect with you afterwards. Thank you, everyone.
Corey Liu, thank you so much. Great job today. All right, wonderful. Make sure you do check out the PIF network. Come and talk to Corey if you want to find out more. With that, we're taking a little break. We'll look forward to having you back in your seats at 1 p.m. because we will start like couple of minutes right after that, ready with a lineup of dynamite panels for this afternoon. So in the meantime, grab a bite, and we'll see you back here in an hour. I'm Andrew Work. Thank you. All right, hello, ladies and gentlemen. We are back in action at Liquidity 2026. We're looking at where digital assets, tokenized assets, and traditional assets traditional finance are all coming together. With the Winter Olympics on, it seems only appropriate to go to that all-time hockey great, Wayne Gretzky, who said, you have to skate to where the puck is going to be, not where it is. And so we are going to be looking at institutional allocation trends, where the money is going to be. We've got a great panel who's going to come up and investigate this question for us. We're going to be looking into the future. They're going to be led today by James Winfield from Bloomberg, who's going to be up here with Fabian Dorey from Signum. We've got Michael Ashby from possibly the mathiest name company we're going to have here on the stage today, Algo Quant. Duncan Trenholm from TP ICAP is also going to be gracing this stage, and rounding it out is none other than the legendary Giovanni Vicioso of CME. Oh, you like that, don't you? I can see it on your face. Big fans of Giovanni Vicioso, and the rest of the panel is just as great. So James Winfield, the time is yours. Let's do this. All right, go get them. Let's have a big round of applause for these guys as they come up on stage. There we go. Go get them, Fabian. All right, good job, Michael. Excellent. All right, Duncan, perfect. And Giovanni Vicioso and his fan club in front. Take it away.
Well, thank you. Over the past 2 years, I think it's fair to say we've witnessed a seismic shift in how institutions engage with digital assets. What was once a speculative side bet is fast becoming a strategic allocation. But how far have we really come? What's driving capital flows, and what's still holding them back? To unpack all this, we've assembled a powerhouse panel for you. From Zurich, we have Fabian Dorey, Chief Investment Officer at Signum, a digital asset bank at the forefront of regulated crypto finance. Veteran of hedge funds and digital strategy, CEO and CIO of Algo Quant, Michael Ashby is here. Duncan Trenholm, Global Co-Head of Digital Assets at TP ICAP, brings a broker's perspective on liquidity, tokenization, and institutional readiness. And finally, I don't think I can do the introduction justice to what we've just heard, but Giovanni Vicioso, Global Head of Cryptocurrency Products at CME Group. So let's dive in. Fabian, I'll start with you. How have institutional approaches to digital asset allocations evolved over the past 12 to 24 months?
As you mentioned before, I think quite significantly and actually decisively among traditional investors. I believe the notion prevailed for quite some time that crypto assets and blockchain technology might be an interesting but for sure a risky animal. And that notion, I think, has been transitioned into the understanding that the technology, the ecosystem has the potential to really shape future finance along three main use cases. First of all, crypto assets, digital assets as an alternative means of payment, settlement. That's all about stable coins enabled by the Genius Act at the latest last year. Second, digital assets as an alternative store of value. Obviously, Bitcoin is a form of digital gold, although that use case has taken a bit of a beating over the last couple of days and weeks. And last but not least, digital assets as the infrastructure for a future decentralized application economy based on smart contract platforms, DeFi, Web3 applications, and so on. And I think the key elements that drove that transition from a risky asset or from a risky animal to shaping future finance has been foremost regulatory advancements in the US, but not only in the US. Second, also the emergence of readily available turnkey solutions for traditional investors to invest without the need to onboard the fully fledged wallet infrastructure, so ETFs, derivatives, and so on. And as you mentioned, that all brought, I think, digital assets to the point where they are now really considered as part of a strategic asset allocation.
And Duncan, I guess, you know, with TP ICAP being at the coalface of these actual flows in the institutional market, does that resonate with you? Is that what you're actually seeing come through?
I think in terms of actual flows, it's still concentrated around crypto. That's where the multi-strat hedge funds, banks have dipped their toe into the market. I think if we scroll back 24 months, I think you were in the minority as a traditional financial organization if you were exploring digital assets. I would argue now that you're in the minority if you're not. Most aren't in the market, but they are figuring out how they access the market. And I think the other big trend is, it was probably crypto that everyone was talking about. I think now we're seeing the applications on top of blockchains that are really getting a lot of traction across financial markets. So think intraday settlement, the ability to move capital around very quickly, what that can do to your capital efficiency as a bank, leveraged on blockchain. And then, of course, stable coins, because that's the FX markets, and that's such a big part of traditional finance. So being able to move money globally, cross-border, and integrate that into your workflows is clearly much easier, I think, within a traditional financial organization to build like a commercial case around, and much easier when you're going to risk committees and management and boards and say, this is what we want to do.
And Giovanni, I think Fabian mentioned that they are seeing these allocations actually start to feed into broader portfolios. How would you say institutions are assessing digital assets within these multi-asset portfolios rather than just a standalone allocation?
Yeah, for sure, and really agree with what Duncan and Fabian have said, right? I think when you look at the space, we entered the space in 2016 by introducing a reference rate to help people really with describing what is the price of Bitcoin, right? So we established sort of that benchmark, and then we followed with Bitcoin futures in 2017, and it's just interesting seeing the change of market participants in the market. Like when we first launched Bitcoin futures, it was your traditional liquidity providers. We attracted, say, some of the crypto native platforms, crypto focused hedge funds. But it really wasn't until, say, the introduction of the spot-based ETFs in the US in 2024 that we really started seeing additional sort of more traditional institutions enter the space. And that's been a theme, like these firms, for example, that didn't have access to the spot markets, all of a sudden now could access crypto through something that was familiar, namely the ETF. And when you look at CME futures, we are the benchmark for a lot of these products. We allowed a lot of these products to exist due to the liquidity that we offer and the risk management tools that we offer the marketplace to help support these products. So we started seeing the interest from hedge funds that were pursuing, say, basis trading. And that's a trade that really lasted for most of 2024 into 2025. That basis started to collapse, but then you started seeing, say, some of the traditional asset like hedge funds on the allocation side, rather than just chasing basis, now they're actually allocating in the space. And for some of the reasons that Duncan mentioned, when you look at some of the actual use cases for the technology, you're hearing more and more institutions speak about how can I use this underlying technology, and that ultimately drives value in the underlying coins, and that's where CME products come in to help market participants manage some of that risk.
Can I briefly explain?
Yeah, absolutely.
Because I think you made a very important point, right? When new investors think about crypto investments, they are mostly concerned about the volatility, about the high volatility of the asset class. But thanks to instruments you just mentioned, funding rate arbitrage, future arbitrage, etc., crypto can really be seen as an asset universe rather than an asset class, because it offers very different risk-return profiles, fully market-neutral yielding strategies, directional exposure, VC investments, and so on. And I think that also helps in the context of portfolio construction, because it allows to diversify traditionally exposed portfolios in many different ways with totally different value drivers and risk factors, which helps integrate that from a diversification perspective.
Yeah, absolutely. And I think, it's interesting that point around those multiple different use cases. Do you see, Duncan, those multiple use cases in terms of then this portfolio construction going forward? You mentioned sort of rather than pure investments or a settlement, or the use of these for settlement and things like that. How does, I guess, evolution in this industry actually allow more traditional firms to use those mechanisms within their sort of standard multi-asset portfolios?
Well, in truth, I think that's a little far off, because you've got to go through the banks, the prime brokers, and it's very much an infrastructure play to start with. So you need the ability to access blockchains. And that's really like COO down, thinking about how we access these products and how we make that a service for the trading arm of our business or the markets arm of our business. Because there's definitely a drive coming from like treasury in a lot of these organizations to say, look, if you can move margin around much quicker, if you can release capital that we hold with other banks much quicker, then that's going to be valuable to our trading business. And then it's on the kind of infrastructure side where they're saying, well, okay, how do we actually make that happen? So there's clearly a variety of ways you could do that, but they just need to get that integrated and up and running before it becomes something the bank can use.
Yeah, so that infrastructure is in place, it then allows them to utilize this, and that could then actually free up, I guess, capacity or other things they can do in those multi-asset portfolios as well. So the impact is not just direct, but potentially secondary impacts on their overall allocations. Michael, I want to come to you. In terms of these allocation decisions, things like liquidity, custody, regulation, portfolio diversification, what do you think actually matters most now?
So I think it's, excuse me, really dependent on the investor. Also, there's some context. If you look at venture versus liquid strategies, it's also important. We've seen a lot of liquidity get taken out of the market over the last year. 10-10, which happened, most recently, really does, I guess, suck out the remaining liquidity. This past week, we've seen even another sort of ripple. And so I think from a perspective of running a fund, we're very focused on where is liquidity, where we can find depth. If you look at on-screen liquidity, it's actually quite misrepresentative what's there. The market makers have really, I guess, left the space in a lot of different tokens. So the depth of the book is not there anymore. And if you're looking to run large size of AUM, you're pushed into Bitcoin, Ethereum, etc. And so this is where the counterparts become very important. And having the ability to have strong custody, strong partners within the space to mitigate the counterparty risk, I think is very important. And so if you look at some of the banks like Signum, etc., they're doing good work to move forward in that space, but it's still very nascent. And the other thing I'd say is that we have seen evolution in a space. Like crypto is very dynamic, the technology is very dynamic. So we saw DATs last year, we then saw prediction markets. DeFi has taken off. So a year ago, we didn't have the liquidity we now have in Hyperliquid. But investing in DeFi is very difficult because there's no KYC, no AML. The counterparty risk is very high, you need insurance, etc. And so the bar is much higher. And so if you want the type of returns that you had 2 years ago, where you were making 20 or 30% with relative ease, that's no longer really possible in CeFi. You need to go out the curve a little bit further, which means more risk. And a different tech stack, a different team. And so I do see investors, and they're looking at these funds, and they want to get comfortable. It's not a 5-person operation anymore. They need a proper 20-person with a compliance officer, a risk manager.
And Fabian, I might just bring you in there if I can. I think particularly on the regulation side, as a bank in this space, that increase in regulation, or certainly clarity in regulation over the last couple of years, must have had an impact on the business. Are you seeing that filter through as a positive to the market?
Definitely. I think for institutional adoption to happen, you need to have the regulated rails that provide access in a compliant way, where the infrastructure is ready and scalable, yes. But I think it depends a bit on the specific cycle. When all things go well, when there is a positive cycle and so on, the risk appetite increases as well, and then other venues become more important again. And then in market cycles, as we have seen recently over the last couple of days, couple of weeks, you mentioned it, right? Counterparty risk, resilience in terms of operations, segregation of assets, safe custody service, etc., become much, much more into focus again. So I think the drift is really towards regulated services and regulated institutions, although the cycle, depending on the risk appetite, might circle a bit around that specific drift.
And if I could add a little bit to that, I think when you look at some of the regulatory developments, particularly in the US, for example, right? You see now where you're beginning to get, say, greater rules and rules of the road, if you will, guardrails that are allowing now people to become more comfortable with these cryptocurrencies. And you look at the passage, for example, in the States with the stablecoin bill, that helped drive interest in Ether. It helped drive interest in Solana, for example, where in our markets, we saw like the amount of Ether futures volume that's done relative to Bitcoin. Ether was averaging maybe about like 10% in terms of notional comparison. After the passage of the Genius Act, we really started seeing more interest in Ether, where Ether now represents close to 50% of Bitcoin volume. So we've seen investors transition from Bitcoin into Ether. And then we saw the same thing. We introduced futures on Solana last year, and we started seeing a lot of interest in that contract as well. So there really has been a move now from institutions really beyond, say, core assets like Bitcoin and moving into other asset classes. And just today, for example, we launched futures on 3 new cryptocurrencies. So we launched futures on Cardano, Chainlink, as well as Stellar Lumens.
I'll just add to that, actually. So what's really interesting to look at, we have a couple of businesses. One is we have voice brokers managing risk for clients so they can trade options, futures, and that's typically traditional financial products. So it's products like the CME. It's also things like the ETFs, ETF options. The other side of our business is a spot exchange, fully electronic, which is on physical crypto. Right. What we found as we've grown this business out since 2020, because all the derivatives fall under traditional regulations, we're pretty much set to go on those straight away. So, the CME products have grown massively. When options on Bitcoin on the ETF launched at the tail end of 24, it was 6 months and it had bigger open interest than on Deribit. Like, this is how important regulations are. When they're in place, that all that capital that's in traditional finance can trade and access these products. As we've been building out our spot exchange, it's a nightmare, the patchwork tapestry of different regulations in different jurisdictions. And it's super important that these come in, and it allows banks, institutions to be comfortable dealing in the spot market. And when they do, that's going to really lift up the asset class, grow volumes, and grow AUM.
Yeah, absolutely. And I think you took the words out of my mouth, Giovanni. I was going to ask you around, effectively, your institution still primarily focused on these core assets, or are they exploring outside of this? I mean, apart from what you've just sort of outlined there, anything else that you'd like to add?
Yeah, for sure. We are seeing more interest now in clients interested really in diversifying within the crypto space, right? So I mentioned some of the newer products that we launched just today, but we're also seeing a lot of interest now in index-type products. So clients really looking for exposure beyond, say, just single coin. So they really want to see exposure to the core ones, Bitcoin, Ether, Solana, XRP, for example. But now they're really interested in getting some exposure to that tail, where they no longer need to make that decision on which particular coin. I just want exposure to a broader index. So we recently partnered with NASDAQ and introduced the NASDAQ CME Crypto Index. And that's an index that tries to capture at least 75% of the investable market capitalization. The index currently consists of 7 constituents. And incidentally, we now have futures covering those 7 components. So we're really excited, say, about the future of the space, because I think that there is growing institutional interest. I think, Fabian, you mentioned, what's going on in the market now today. But if you've been in the crypto market for a while, this is almost like normal. It is something that happens in the space. But luckily, we do have products like the products that CME offers to really help the marketplace navigate, say, some of that risk with confidence.
Maybe just to add, I think as the institutional adoption is advancing over the last couple of months and years, we still have seen quite a significant consolidation in the market in terms of interest really on the core assets. They have been mentioned before. What really has a bit lost of attention is the broader ecosystem, different use cases such as gaming, metaverse, and the like. So these use cases have lost quite a lot of attention. And from that point of view, institutions are really focusing on the use cases that have attraction, that have the regulatory clarity around it, that have the market depth that Michael mentioned in order to be traded. So there, I think there is a concentration around the core assets, but the core assets being defined a bit more broadly.
And Michael, as an investor, it's great to hear everyone on what they're saying in terms of the products and they're in the market, but as someone who's investing in that market, are you primarily still focused around those core assets, or do you look more broadly?
So I guess not to beat a dead horse, but we look for liquidity. So we have about 30 plus SMAs, mostly liquid strategies. I'd say what we're seeing now is a real focus on having funds that understand risk management. And that's not just traditional portfolio management, it's understanding counterparty risk, it's understanding operations. So first and foremost, if they're using a firm like LTP, we're very happy because we understand they understand prime brokerage. If they got a system like Telos, we know that they've got a good platform, et cetera, et cetera. But we really want to ensure that they know what they're doing first and foremost. And then from there, we look at their strategy and we're a multi-strat, so we have a plethora of different strategies on the book. We're looking for idiosyncratic alpha. Now, there's not a huge amount of alpha in the market right now. So you then look for treasury trades. Okay, where can you find basis? The basis is quite compressed. So then you're looking for arbitrage. Okay, if you're doing cross-exchange arbitrage, how are you managing different legs? And going back to 1010, we saw this auto liquidation. Now, a number of the larger funds have done deals with exchanges where they're able to reduce that risk. Smaller ones don't have that. So how do you manage that? So again, it's quite a complex, I guess, approach right now, just given we have these, the majority of crypto funds are actually trading shops. They're $50 to $100 million. They don't have the scale to manage all these different risks. And so we have to in-house that. So I now have 70 people at the firm, and 30 of them are focused on just managing that risk.
I think just picking up on something you said there around the size of those firms and that scale, what do you think, and maybe Duncan will come to you after as well, given your perspective on what we were talking about earlier around the size of the allocations, but Michael, what do you think does need to change for those allocations to scale going forward and that liquidity pool to grow?
So I think it's the onus is actually on the exchanges and the regulators to really provide a platform for these funds to flourish and for investors to get comfortable. Previous to running AlgoQuant, I ran one of the largest multi-strat digital asset strategy, and there was no chance they were ever going to touch the CeFi exchanges. It just wasn't going to happen. And the reason for that is that the rules that these exchanges operate on are a world away from the CME. And what these traditional finance investors expect is they expect clarity of rules. And so with all due respect to these exchanges, it almost feels like they're making it up as they go. And so I do feel as though we need to grow up a little bit as industry, and until we do that, we're not going to be able to bring in the large allocations. And what we see today is a recycling of crypto capital. So, I represent one of the larger family offices in crypto as a multi-billion-dollar family office. He made his wealth as one of the original Bitcoin investors. That's what I see more and more is large crypto wealth, less of the traditional family offices coming in. But I do feel, and to be positive, that tokenization is going to be the thing that changes this. And I do feel like that's what is a paradigm shift that brings money in.
Duncan, any thoughts on that?
Yeah, so I guess what you got to remember when you're thinking about banks and hedge funds and commodity trading firms, typically when they're trading crypto, it's a part of what they do, but it's not dedicated what they do. So unlike if you're running a crypto hedge fund where your whole day is all of the different tokens and everything, it's, hey, I'm trading a bit of precious, and I'm also trading crypto along the side. Sometimes you see a dedicated crypto trader, but very rarely. At banks, it's typically sat on FX desks or EMFX desks, and on the multi-strats, they're usually macro traders. So what they want is to be able to access venues and not have to think about it. They don't want to go through the infrastructure setup. Typically, that's going to business managers or kind of out of the COO side of things. So it just needs to fit the plumbing that they already have. And what do you hear from them? It's like, well, the exchanges I deal against, they need to have an investment grade credit rating. There aren't many of those in crypto, right? That's one thing. It needs to be plugged into the EMS vendors I use, like your flex trades, your things like this. That's where all my routing goes. So, when you see things like integrations between crypto EMSs and traditional EMSs, that brings the barrier to entry down. And then it's like, well, my custodian is this bank and they don't offer crypto, so that's not going to work for us, right? So again, it's on M&A activity between crypto custodians and traditional custodians. Once that plumbing is there, it then becomes much easier for them, and that's when they'll broaden outside of CME products, which is just another piece of what they trade every day, or ETF options because they already trade ETFs. And on just going back to the portfolio diversification side of things, one interesting trend we are seeing, which is very much on the other side, is crypto businesses that are getting to a certain AUM that are realizing they need other opportunities to trade. So they're actually coming back and trading TradFi instruments. So whether it's picking up like index options on equity futures, like one of the big trends for us over the last year has been the big crypto dealers onboarding to trade equity options and products like that. And once they trade IBIT options, they're like, well, why aren't we doing coin options? Or why aren't we then doing Apple options, right? And it just kind of spreads from there.
How was that trade last week?
Sorry.
How was the IBET trade last week?
Yeah, there was, to be honest, we're doing the blocks side of things, so we don't see screen side of stuff, but it was a busy week for our brokers on IBIT, so.
But adding to what Duncan said, right, one of the things that we've observed in the market, right, is that we started seeing, say, some of the crypto native funds trade in our markets, but we saw some of those funds begin to trade some of our other products. You know, trading, like when you see volatility shift from one asset class to another, we started seeing some of these traders looking at NASDAQ 100, looking at gold futures. And an interesting anecdote, I was catching up with one of the developers of Filecoin, for example, and introduced myself, and he goes, oh, you're with CME Group. You guys have that FedWatch tool. And I'm like, what? Yeah, we do. We have that FedWatch tool. Well, you know, why are you interested in it? But he uses that particular tool to really gauge what's happening in the marketplace, because these markets are interrelated. But I thought that was kind of interesting, where I would never have thought that somebody in the crypto space would be looking at, you know, interest rates, but they are.
Yeah, interesting. I think as much as it started up separate, you know, coming together just into the larger financial market is good. While it may say it blends that in, I mean, it just exposes more people to the market. I think it brings it into that infrastructure. And if it can be bought or consolidated into that, it just makes things more efficient. Things are going to get done more quickly, more easily, more cheaply. And, you know, that's only going to be a positive driver for the industry overall. Michael, just coming back to you, in terms of, you know, we spoke about this allocation, and we just spoke about having different, or traders working this in different ways. Do institutions now differentiate between trading exposure and strategic allocations more clearly now? Are they taking, you know, where maybe previously it was more just purely on trading exposure? We've talked about it gradually working more and more into a strategic asset allocation. Are we seeing sort of desks or funds split that and say, I've got a strategic asset allocation, I've got to digital assets, I've also got maybe shorter term tactical trading exposures, or are they one or the other?
It's a good question. So what we see people looking at treasury books and then alpha books.
Yep.
And I think we're currently talking to some of the larger traditional hedge funds that are looking to enter the space. And I think there's a general focus on what they can actually do over the next couple of years. And I mentioned tokenization earlier. I think that's the big next wave here. And I think that, you know, if you look at what tokenization is going to do, just very simply, it's going to increase the TAM of equities and these derivatives. So you're going to, instead of trading Apple during the bourse hours, you're going to trade it overnight on the weekends. There's going to be huge price disallocation because liquidity is going to be lower. So I think a lot of firms are saying, okay, how do I get access to that? How do I manage that? Is that a strategic asset, or is that a way of risk management? You know, I think crypto in some ways has been whipped around as a macro asset on the weekends, because if people see an event happen on Sunday, well, they can't trade SPYs. They go in and they trade BTC and ETH, etc. That is going to go away fairly soon. And I think, you know, my personal opinion is it takes a little bit longer than people are saying, but when it does come, I think this whole TradFi crypto, actually there's going to be something in the middle where we combine the technology.
So to become an enabler of those TradFi assets.
And then it goes into the point, right? So if you look at a traditional, you mentioned flex trade and some of the systems, they're not built for blockchain. Now they can build a widget, but you need actually the ability to have 20, 30 digits. Most systems cut off at 8. It's a simple example, but it's really important because these tech stacks are very costly. They're very easy to build, and so you need the integration between the two.
Michael, are you at all concerned, say, with as we move, say, more towards tokenization, but do you become more concerned, say, with that fragmentation of liquidity?
So yes and no. I see it as a huge opportunity. But from our perspective, so a simple strategy would be you put a basket trade on. You're looking for that sort of net liquidity. You're either putting a price regression or dispersion trade on. So I think if you put these trades on and run it as a basket, you probably get enough liquidity across the book. But I think people should recognize that the prediction markets, which is unregulated in the majority of the fact, all this stuff's happening, and you're going to have NASDAQ and New York Stock Exchange trading token equities, but you're also going to have hyperliquid. So there's going to be regulatory arb. So I think the world is going to be very interesting for a couple of years until this all sort of settles. And there'll be lots of opportunities if you're smart about looking at it for the arbitrage.
Fabian, maybe come to you. Do you, I guess, agree with that tokenization is the next wave that we're going to see, and effectively not just digital assets themselves, but the way that they will open up the rest of traditional markets is going to hold?
Yes, definitely. We strongly believe in a future where all future financial assets will be tokenized, because of various advantages that come with the technology. The obvious one, I think it was mentioned before, 24/7 trading, settlement, reduced costs for cross-border payments, etc. But I think the real driving force will be the integration and automation of value chains based on smart contract features, based on AI agents, etc. So really automating routine tasks in the back office, in the mid office level, and so on. So that will for sure drive the adoption of tokenization.
From and maybe this can be to anyone who wants to pick it up, but from an institutional perspective or a plumbing perspective that we've spoken about, if and when we do move to that type of model where we have that 24/7 trading of effectively tokenized assets and underlying traditional assets, operationally speaking, in the traditional world, there's a lot of issues around settlement timing, and any sort of move from even a T+2 to a T+1 is a global event. So when we have tokenized assets sort of potentially settling very, very quickly and the underlying traditional assets on a separate sort of cycle, does that cause issues within the plumbing system?
Yes. I think one thing we can observe from the last 6 years of watching different pilots across the industry, whether that be the EU DLT pilot regime or various different sandboxes, is it's very difficult to convince big organizations to implement blockchain technology and digital assets if it's pitched as reducing your OPEX. It's always going to lose out to other prioritization across the bank or across the firm in terms of trading opportunities. So for tokenization really to take hold, it has to be driven by client demand. And a lot of what we've seen is like sell-side products pushing tokens and not actually the client demand for them. And what do I mean by client demand? I mean, instead of buying Apple shares through a traditional brokerage and holding it as an equity, you're buying it through one of the great crypto firms that have offered crypto to you as in a wallet. And as soon as there's that groundswell of more and more people buying, it will push the institutions to offer that service internally. But when you're looking at just saying, hey, when you're dealing in bonds, if you spend X number of millions uplifting your system, it's going to reduce your kind of slippage a little. It's very hard to get the project approved at a bank.
I agree to that. It's really a journey that will take different steps to be fully adopted. And interestingly, I think it starts with tokenized money market funds, right? We see a significant demand for tokenized money market funds as collateral in an off-exchange setup, allowing to keep collateral segregated from the trading activities on exchanges, so minimizing counterparty risks, etc. But I believe, and I agree, it will be a multi-step journey that now is taking its first steps.
But I think when you look at things like tokenization, and you start thinking about, why did these cryptocurrencies, why do they exist in the first place, right? And we speak about cryptocurrencies, but it's really that underlying technology, right? And tokenization being one of those use cases, which is really going to open up the world and think about globally the number of investors that don't have access to these markets that all of a sudden now can buy a share of Apple, Tesla, or what have you, anywhere in the world. And I think that's really important, and that's what ultimately then drives value. It's not about speculation with these cryptocurrencies. It's about the underlying value of these different technologies that these cryptocurrencies power.
All right, and we've got about 5 minutes left, so maybe just a rapid fire response from everybody. At the moment, 8 out of 10 TradFi allocators are still choosing TradFi solutions, ETFs, etc. When will 8 out of 10 choose crypto solutions? Less than 5 years, more than 5 years? Giovanni, maybe we'll start.
I think that's really hard to answer, right? It's always difficult, say, to predict the future. But certainly, when you look at what TradFi has done for the space, going back to the introduction of the spot ETFs have really been driving more and more volume in the space because they've attracted new market participants. So they're driving more value across the CeFi space. They're driving more volume across the derivative space. And they're also driving volume, say, within the ETF space. But all these markets are really interrelated. So I don't see it as a case where, say, the crypto firms are going to overtake or DeFi is going to overtake. I really see it as a blend of these different techs, if you will.
Duncan?
More than 5 years, I'd say. I'd love it to be sooner, but I probably thought when we started this business in 2020 that it would have happened by now. So we've had to rebase it to 2030. But the signs are good. Last year, just we can speak to even 4 globally systemic important banks that got board approval to start building spot crypto. That means they're going on that journey to setting up custody, learning, coming to reach out to the crypto community and figure out what service providers are out there. So it's happening. It's just everything in TradFi takes a long time.
Yeah, I guess I think it has to do with the U.S. regulation. So I'm Canadian, and as my, southern neighbor, they have the biggest financial markets. They have the biggest fund market, and really, you're not allowed to do a whole lot there. So if you're trading, a fund in the U.S., you can't access most of the perpetual swaps and offshore liquidity. So I think if Clarity Act goes through, and then some follow-on legislation at a state level, we'll actually see this market open up. And depending on how quickly that happens, given the pro-crypto administration at the moment in the US, I think that could really help open this up.
And Fabian, final word to you.
I'm with Michael there. I think the potential is there to happen earlier than within 5 years. I would relate it to AI, right? AI has been on top of mind of many for quite some time, but only the introduction of ChatGPT has then really accelerated the adoption significantly. And I think the passing of the Genius Act last year, hopefully of the Clarity Act this year, this will really be that catalyst, that ChatGPT moment that really accelerates adoption and then leads to 8 out of 10 adopting it within 5 years.
Within 5 years?
Yes.
Okay, so we've got an unknown, a more than 5 years, a less than 5 years. I guess we'll check back in 5 years' time and see how we go. Ladies and gentlemen, please thank me. No, don't thank me. Please join me in thanking all of our panelists today. Gentlemen, thank you very much.
And please do thank James Winfield. He's done a marvelous job. Well done. Gentlemen, if we get you front and center for a photo before we let you leave the stage, look right into the camera lens. There we go. All right. Thank you very much, gentlemen. You've done a great job out here today. Get a chance to immortalize it in digital, I guess. There we go. Well done. All right, looking to the future. Thank you very much. Once again, James, great job. Right this way, gentlemen. We got our next panel all ready to go. Thanks a lot, guys. Great job. All right, hopefully we'll get to see you again. Hey, Florian, thank you so much. James, marvelous job. All right, it sounds all very fine and well when people say, yes, we must provide liquidity to the market. But people in this room know it's a little more complicated to that. Bridging, risk management, there are many elements that need to be considered, and we will consider them right up here on this stage today. Anton Feingold from Glassnode is going to be leading the discussion. He's going to be joined by Jeremy Long of Ludizia, Paul Kremski of Cumberland, one of the heavy hitters when it comes to providing liquidities to markets. Will Lung of Caladan is going to be right up here. And then we release the Kraken with Giuseppe Giuliani from Kraken. So they are ready to go. Anton, the floor is yours. Let's do this. Yeah. All right, go get them. There we go. Here they come. Look at these guys, ready for action. That's what we like. Hey, Giuseppe, go get them. All right.
Okay. All ready. Okay. Good afternoon, everybody. Thank you very much for joining us today. We're going to be exploring, I think, the central theme of this whole event, liquidity and trading as well. In particular today, we're going to be exploring how institutional liquidity is managed as digital assets are evolving. So, as I think we can all recognize, it's been a particularly uneventful few months in digital assets. I think this topic really does come at quite a pertinent time, given the flash crash at 10:10, given the recent downturn and volatility as well. So it's a great time for this discussion. We've got a great panel. We've got Caladan, we've got DRW Cumberland, we've got Kraken. It's a great team to discuss this. So I'll just quickly introduce Jeremy Long, CIO of Ludizia, Paul Kremski, who has been over 20 years at DRW Cumberland, Will Young, Chief Strategy Officer at Caladan, and Giuseppe Giuliani, who heads up institutional at Kraken. So, with everyone introduced, I think the next thing is to kick things off with the first question. So, I'm going to go to Will. Will, how do you see institutional liquidity evolving across venues, asset classes, time zones, and how do you see it comparing to TradFi?
Well, I think it's ultimately it's supposed to have a steady evolution towards what TradFi should look like. What is institutional liquidity? I think we throw that term around. It sounds really nice, but at the end of the day, it's do you have a mix of participants that are making liquidity stable? Which right now in crypto, we're not there yet. We primarily rely on retail and market-making liquidity, which is a start. But ultimately, institutional liquidity requires a wide range of stakeholders, market investors, participants who are all buying and selling for different reasons. That allows for you to continually have someone to trade with beyond just incentivized flow. And that's pretty much what TradFi looks like now for most major asset classes. What gets even more interesting is when you start seeing tokenized assets. Right? That's the evolution of that is so interesting. We're starting to look at a lot of these opportunities to trade tokenized gold, tokenized tech stocks. What does the liquidity profile look like? Right now, it's still, frankly, not great in the crypto world. But inevitably, as you start having increased volumes in these channels, then the participants that trade across TradFi and crypto will then increasingly be mixed. So long term, it's convergence, but I think it'll take quite some time, just because ultimately, it's steady growth is always slow grinding until you hit a tipping point, and I think we're not close to that tipping point yet.
Got it. Jeremy, do you have anything you want to add to that?
Yeah, I agree with what Will mentioned earlier. So I think that convergence will happen. I mean, the kind of institutions that we are seeing in the market right now that are actively trading crypto has become more and more diverse as well. And I think that growth has expanded faster than the crypto native firms trading the traditional products, right? So right now, like ETF, APs, issuers, they're very active in crypto space. And I think that is going to grow exponentially. And like what Bill mentioned, like those that are actively trading crypto as well, the crypto native firms will start to trade traditional products. We're already seeing more and more traditional type asset classes on centralized exchanges that offer crypto products. So I think this will continue.
Got it. Okay. We kind of talked about there, like how you see things evolving and merging, Will and Jeremy. But Paul, any kind of challenges that you see across kind of centralized, decentralized infrastructure? What are you seeing emerging, and yeah, what's your take on how we find solutions to these challenges?
Yeah, so, well, that's really loud. So I'd add a third category there is centralized exchanges, decentralized exchanges. I'd also add OTC. And these are three different liquidity venues that actually have really different characteristics. In crypto, as in all asset classes, but really in crypto more than any other, people very often mistake depth for liquidity. And the difference there is depth is like, okay, I can see how much is there. That's how much is going to be there. And the truth is what you really care about is what is the liquidity going to look like when you actually need it. And in crypto in particular, it's very nonlinear. So you can look at something when the market is calm and we're kind of drifting along, you can be like, oh, there's $1 million of liquidity within 25 bips. So if I need to get out, I know I can get out. And then, you know, if it's on October 10th or really just any time the markets get volatile, you're not going to see that much depth there when you need it. And it's very nonlinear. And there's actually different profiles for each of these three different markets. So on one end of the spectrum, you have decentralized exchanges, which actually used to be pretty stable when it was like Uni V2 style. But now that everyone is going to concentrate liquidity, when you're in the range that everyone is in, it can look like there's a lot of liquidity. But then you can have actually a fairly small move and there's just no bids and no offers. And that can actually really contribute to exacerbating liquidity, illiquidity. Centralized exchanges, I would say, kind of are in the middle. Yes, liquidity does dry up when the markets get really wild, especially in perpetuals markets and markets where there's leverage. But in general, there are market makers who are paid to be there, and they will always kind of be there. And then the reason I brought up OTC at the beginning is OTC, it can be a pain to connect to. You need to work with, you know, directly with one of these desks or with a prime broker, and not everyone can access that. But what you get with OTC is you get a lot more predictability of depth and liquidity. Because these OTC desks, they're not relying on, if I'm going to show a bid, I need there to be another bid that I can lay it off in. These OTC desks have the ability to say, okay, someone just sold me $50 million of Bitcoin. I'm long now, right? And they're able to say, I can work out of that over the next minute, 10 minutes, 20 minutes. The traders there have the ability to do that. And so there's less elasticity of spread, even during very volatile markets.
Okay, so you see the kind of main differences of challenges when pricing liquidity across OTC versus CEXs and DEXs rather than necessarily the infrastructure between CEXs and DEXs.
I mean, ideally, you want to set up with a combination, right? That's hard to do. It's easier said than done because they all exist on very separate technology stacks as well.
Got it, yeah. And Will, did you have anything you wanted to add there?
I think it was very comprehensive. Amazing. But I think what's important to distinguish is all of these different venues are meant to cater for different audiences. And mechanically, it enables you to. Like, we are also a big proponent of OTC because, well, it enables the market maker to be able to control risk in a much tighter way. If I am continually forced to put depth onto a SEX book, if I get run over, well, then if the risk of getting run over forces me to put less in there because there's just less controls. Whereas with an OTC environment, you can structure it in such a way that I have more confidence that when you trade against me, I won't be run over, so I can do more size. So I think that benefits everybody. But then it's a question of, well, what is the audience again you're trading against? For a SEX environment, a lot of it is retail. A lot of the order size is a bit smaller. But when you're going the OTC route, it is a bigger size, so more institutional. I think by design is meant for that. So the point here is recognizing that all of these venues are crucial because it serves different clients, different customer bases, and you tailor your strategies accordingly. All are necessary.
Got it, yeah. I think some good points there. And to the next question, we kind of talked a little bit about some of the challenges. So maybe more on the positive side. Jeremy, what technology or infrastructure improvements have had the biggest impact for you on execution quality?
Yeah, I think there are actually a lot of improvements over the years on the technology side that have led to better execution quality. But one that is really important, I think, is just more robust infrastructure, reducing the overall latency, and then that has helped with execution speed, which is really important for execution quality, right? And also people talk about execution costs as well. Now, execution costs is closely associated with obviously execution speed as well. If the latency is really, really high and not deterministic, it's very, very difficult to attract market makers who come in and quote large. And I think right now we've seen exchanges improve their latency significantly, and that has a positive impact on the liquidity that market makers are providing on many centralized exchanges. And I think that improvement we've seen not only in centralized exchanges, but also DEXs as well. So earlier we talked about DEXs and centralized exchanges. Obviously, there's still a big difference, I think, in terms of infrastructure maturity, but both is heading to the direction, obviously, of traditional exchanges. And one day we might even see, each and out protocol, for example, offered by a centralized exchanges. And I don't think that is too far away, to be honest. So I think that's one thing that has really improved, that has led to better execution quality. Now, from the perspective of a smaller institution, a smaller firm, I would say the advent of execution algos, algo orders. I think that has led to better execution quality as well. You can see a lot of exchanges have algo orders right now. I would say 6-7 years ago, I would say most major centralized exchanges do not have that. I mean, those that are obviously have a trading desk would know the importance of execution algos. You help to minimize market impact, reduce slippage. I think having that being available to just retails and small institutions is really, really important. And I'll say most major exchanges have this right now. So I think that's also another improvement on the technology side.
Great. And Giuseppe, did you have any different, key technological?
I think Jeremy covered quite well. And for example, if you look at what we have done in the last few months at Kraken, we have started to offer collocation to reduce latency. We have improved execution quality. We are currently and always trying to improve the execution for our clients, but also the liquidity that comes with it. Also, I would say that it's really important to have a clearing and settlement layer that is equally fundamentally working, during period of stress. And I think Kraken is probably top of mind for this for all our clients. And so I'll say with the now the sort of banks have been more receptive. Also, we have been strengthening the part of the business, and I think this is really important as well for institutional to come in and being able to transact with centralized exchanges.
Okay. And Paul, Will, do you have any different opinions on that, or any technology infrastructure that you find particularly useful that you wanted to mention?
I think that the interoperability of DeFi is such a crazy powerful tool that I actually think a lot of folks don't really take full advantage of. So if we're going to launch, something I care a lot about, and I promise I won't talk too much about it because anyone who knows me has heard me talk about it before, but I really believe that FX markets should live on chain, which means stable coins for different currencies trading against each other. So a euro stablecoin against a Hong Kong dollar stablecoin. This doesn't scale well at centralized exchanges because you might have 5 different dollar stablecoins, 5 different Hong Kong dollar stablecoins, 5 different euro stablecoins, and that's a lot of different combinations. So that doesn't really work that well. But what you can do with decentralized exchanges, which just aggregate orders really well, is you can just have, let's say, okay, USDC is going to be the base pair for all of these. And you can have each of these 555 can have one pair against USDC. And so if you want to trade from any one into any other, it just does it in 2 hops. And DeFi is really, really good at this. Centralized exchanges could do this as well. They would just have to have implied functionality. But this brings so much capital efficiency because now you don't have to pay market makers to park their capital on the bid and the offer of these 5 times 5 times 5 different markets. So that's something that DeFi brings, which CeFi, I think, still struggles with a little bit.
Okay, yeah. Sorry, Giuseppe.
It's actually, this is something that we are trying to solve, and we are working on it. So I think we have quite a fairly good solution that we should be launching soon. So
Just to quickly add to that, Paul's point on capital efficiency. crucial there. And for us, we've traded on, say, 50 plus venues now across CeFi and DeFi. I mean, with that being said, a lot of tail stuff, there's not that much flow. But the point here is every venue you access requires you to stick money in there. That money is not productive. So to be able to ensure that can you recycle capital in the most efficient way? And I think we're starting to see solutions around that. Oftentimes it revolves around a partnership between a centralized exchange and a custodian, where you can mirror assets, very valuable, especially if you can mirror assets that can also just generate yield while also being able to facilitate trading on these exchanges, very valuable. I think we're still early days there, since there's different custodial partners who link with different CeFi exchanges. But if you can ultimately have this shared pool of capital that enables you to trade across all the various venues, it's super valuable. And I think primes are trying to solve for that. I come from a prime electronic trading background from TradFi, so starting to see a lot more of the old playbook transitioning in, but applied to these new asset classes. Other pieces important to notice on the CeFi exchange side, it's really interesting to see the level of stability and consistency of how you interact with an exchange. When you're used to trading on the Tokyo Stock Exchange or HKX, the rules are pretty clear. At least the spec is very clear. The behavior that you need to optimize your algos around should be reasonably clear. But in crypto, it's so inconsistent just because, let's say, the level of maturity of the market. Sometimes you just don't know when the exchange is going to do something. And that limits your ability to take risk.
Okay. Yeah, I think, go.
If I could add one thing, I really want to drive home that point, because from the exchange standpoint, they're like, well, why do we want to put more technology into this? Why do we want to put more resources into this? At the end of the day, trading firms will put more risk on platforms that they feel more confident about. And so it's definitely worthwhile for exchanges to make that expenditure.
Lots to think about. And the next question as well is probably one we could discuss for a while. Very topical. So how do market makers adapt to varying volatility and liquidity conditions across assets? I think given 1010, et cetera, it's a really pertinent topic. And Ceffu, I think nice to get the take from an exchange, I guess, first before we go over to the market makers.
Yeah, so it is a really good question, especially after 1010, as you said. And going back to what you guys were discussing before, it's for those market makers and for all the actors in the market, it's really important to being able to price risk. And if you can price risk correctly, then that's gonna, create better condition for liquidity. So what market makers are probably after 1010 trying to do is like establish what happened and making sure that they work with exchanges that have clear rules and they offer the right tools and the resilience, right? Because at the end of the day, like they need uptime, they need to be able to trade, they need to have what they need, right? And to continue to provide liquidity. And so I do think that right now it's really important for exchanges as a whole to provide more transparency, right? Provide also transparency of what are the rules to trade on the exchange. And for us, what we are trying to do naturally is like always improve our uptime, also being, offering the right programs to improve the liquidity, but a liquidity that is true liquidity, not just debt, right? Liquidity that is there when it's needed. And so I do think that we as a whole, as an industry, need to come together to provide a better environment, as also liquidity for market makers is always silo, and they need to, trade across all the different centralized exchange. And probably we should do more of a, collective effort to improve the overall infrastructure.
Yeah, Paul, did you want to jump in there as well, just given the take from a market-making firm?
Yeah, sure. I mean, trading firms, we all have a mandate, and it's to make money for our partners or for our investors. But when you sign up to be a liquidity provider, you're also signing up to say, like, okay, there are going to be times where you are supposed to lose money. And if you are providing liquidity and never losing any money during periods of volatility, you're not providing a good service. I would love if we could just make money every minute of every day, but when a market maker or when a project says, hey, come help us with liquidity, or an exchange says, hey, come help us with liquidity, they're not just hiring you for the boring moments and for the moments where things are going sideways. They're also engaging with you to provide for them when the market is falling out of bed and everything is volatile and capital does disappear from the markets. That's actually when they really need you. And so frankly, like, how do market makers deal with volatile periods? The answer is we lose money, right? That is actually part of the deal that we sign up for when we sign a market making agreement, whether it's with a stable coin or a token or an exchange. We're saying, okay, on 10/10, we expect to lose money. And if we don't, it's because we turned off at the right time, which means that we're not supporting our partners, whoever they are. So it's not fun, but it is part of the equation that we have to think about when we're structuring deals and when we're structuring partnerships.
Okay, and Will?
That's actually a really great point. It's not talked about enough. Like, when you enter into a partnership as a market maker, you essentially sold an option. Typically trading firms come from more of a, they're prop by definition, so it's much more about making money, being opportunistic. But when you enter into these commercial partnerships, yes, part of being able to trade opportunistically creates depth and volume, but you're also there to ensure stability. So baking that into the costs and the long-term revenue profile of this partnership is crucial. Estimating that in the right way, well, in crypto, it's hard. But I would say for us is, like, you think about, you really have to bet on your partners. You really have to take a long-term fundamental view. Are these people, do I trust in them to do the right thing? Are they here to stay? And if they're not, then you may not want to take that bet. So I think that's required. I talked about earlier, we're connected to 50 plus venues. There's only so many that you are that active on, because, well, there's a level of trust and the range of quality of venues. With that being said, I think it's also, as part of the risk management side, being able to manage this risk in these situations in a more optimal way. Oftentimes, your risk is concentrated, whether you like it or not, because there's only so many venues that are reliable. Hence, we talk about, like, CeFi is one thing, DeFi is another, OTC is another. All of these channels, one way is for us to deliver liquidity to a partner. The other is, are they also avenues for us to manage our risk? So a big focus for us is really overhauling our risk systems and thinking about, as a firm, across all the desks that we have, across all the venues that we're trading on, how can we think more strategically about, in these situations, are we able to warehouse risk from here, knowing that it's necessary, and then can we offload it elsewhere in a safe way? So these are lessons that are necessary, and if we want to be serious and long-term in this business, well, you have to think that way.
It's an interesting point. I mean, can be the consensus view that just volatility suits the market makers, right, and they're making money, but as it's interesting to hear from you guys that that's not always the case, or often not the case. And Jeremy, did you want to jump in?
Yeah, actually we'll touch on a point that I really agree, which is on risk management system. Like, aside from digital assets, we do trade a lot of traditional products as well. We use the same risk management system and control. We're constantly stress testing as well on risk management system to make sure it works under all market conditions, right? And I think risk is one thing that is often overlooked, especially for a lot of the players in crypto. And I think it's really, really important. Like, you have to understand how ADL actually works, how liquidation works, what does leverage actually means when you're using those trading perps or trading spot margin on any centralized exchanges. And I think those are the details that are often forgotten by people that are very active in the space, which I think is really, really important. I think everyone, one thing that, a lot of trading firms learned from October 10th was how to manage that leverage and that risk better, right, under all market conditions. So I think that's one thing that is really important. Another thing also, part of risk management is always assessing, counterparty risk as well. When you're trading an exchange, what happens if the exchange goes down? What should you be doing if that happens? And even like products, right? What happens to a product that you're trading? Say, for example, the liquidity drops significantly. Can you get out of positions? Ask yourself those important questions and plan for it. I think that's really, really important. And I think that's how, the very best market makers, survive.
Okay. Lots to think about there, and I'm sure a question we could go on for quite a while, but the last one is, again, a broad one, which is, Is, in your opinion, liquidity becoming more resilient or more fragile as markets evolve and merge? Your bull cases and your bear cases, guys. I'll start with Jeremy, sorry.
Yeah, my answer to this question is that it's become more resilient, and mainly it's because when two different markets, right, TradFi and crypto, when it converges, I just see the number of participants increasing significantly. There just be more buyers, more sellers, more liquidity as well, which is a good thing. The second thing that I think that also emerged from this convergence is just increased competition, right? When traditional exchanges are trying to offer crypto products and crypto exchanges are offering traditional products, you often see the two sets of exchanges competing with each other, which actually benefits trading participants, drives costs down. Market makers have to compete harder as well because traditional market makers are now competing with crypto market makers. And you have to quote tighter and larger to get fill. So competition is obviously a good thing for especially for other takers there. So I think this is what will happen.
On that topic, for sure, the convergence of TradFi and crypto is noticeable, especially from inside. Like you see a lot of new players coming to the crypto sphere, but also like exchanges expanding their service and product range. As well, I do believe that there is a higher degree of specialization between market makers. For example, as Jeremy said, right now there are really large players that compete on majors. So a lot of the smaller firms are specializing on mid-cap or long-tail tokens, which sort of improve also the liquidity for maybe smaller cap and smaller tokens in terms of their market cap. So and really after 10/10, it's hard to say that liquidity is getting much better, but I do think that once we recover from their events, people are going to be more aware of certain details that Jeremy before described, such as ADL or how leverage works, or how really to price perps. But once that is done, I do think that now we see many more players, and ultimately liquidity will be improving a lot over the course of the next years, given that the macro remains supportive.
And one thing to add as well is obviously we've seen more and more tokenized assets as well launched on centralized exchanges. I would say even for liquidity of those regulated products, those products that we see in traditional space, liquidity for those has improved as a result of just overall liquidity and overall volume increasing. So it's also happening the other way around, right? Even traditional products that are moving to crypto exchanges, their overall liquidity has also improved. And right now, obviously, everything that's being offered on crypto exchanges is 24/7, which means that obviously there is liquidity even over the weekend, even during holidays as well, which I think is really important for trading participants.
And wasn't necessarily always the case in the past. And I guess overall summarizing, there's kind of two on the more resilient side there, two takes on the more resilient. Will, any different contrasting opinion, or are you joining the others?
I think it's more nuanced. It is more resilient, but concentrated in a smaller universe. I don't think it's any surprise to anybody that new launch tokens mostly don't do well at all. There's just no liquidity there. There's no new buyers. You've seen capital concentrate in the majors, and some alts that have exhibited strong fundamentals. Funny how we talk about fundamentals in crypto, which wasn't really a thing a year ago. Right? So I'd say for the assets that demonstrates that there is some reason to hold this stuff is getting more resilient. And you're seeing the new entrants tend to be focusing on these assets. So that's much more resilient. The fragility, you see much greater fragility in tail end assets, especially if there's really no reason to bet on this stuff. So I think that we're also seeing higher correlation across crypto and TradFi. So right now, it may not look very resilient because everything's weak. Like gold and silver, silver crashed, 30%? Some plus in the past couple of weeks? if the real world is not doing too well, then how can crypto do that well? So that higher correlation is I think it's just here to stay. But if macro improves, then you'll probably see there's already more participants coming into crypto, and they will be more positive, and therefore you'll see that reflect in liquidity and prices.
Okay, and Paul?
Yeah, I'd like to zag here a little bit. I think that an overabundance of competition can actually increase fragility in the market. There have been several periods where there was one business line that traditionally was doing pretty well, and so a lot of people came into that business line, and then it becomes oversaturated. And one of those right now is market making, right? It's pretty well known that market makers did really, really well in the period between like 2021 and 2023, right? It was just a very good time for that market. And now, frankly, there's a lot of market makers, right? There's a lot. There's probably like a dozen different represented in this room. And a result of that means that they can't all get the good deals, and so they have to get really, really, really competitive. And every once in a while, we're talking to a project that is looking for a market maker, and we say, okay, here's what we want to do, and they say, oh, well, so-and-so is willing to do it for this. And we look at it, and it's not just a case of like we're being greedy or we're trying to take too much, but we're like, that doesn't math, right? And if you're hiring a market maker, but you're giving them almost no value, you're almost guaranteeing that they're not going to be there when you need them. And so I think that the market is actually so competitive right now that there is this pendulum swing where these deals are just trading at levels that don't make sense. And if they don't make sense, then they just don't work in the long run. And so what tends to happen is a lot of these projects then come back to us like 3 months later. They're like, yep, didn't work with so-and-so. But a lot of times the damage at that point has been done. We saw this type of activity in the past when like OTC markets got really hot. And so then there was like 150 OTC markets, OTC desks in crypto. And I think we're kind of seeing the same thing right now. I think it's probably going to start to swing back a little bit because as there's less TGEs, there's less need for market makers there. You can see it in yield-bearing assets as well. And RWAs that have yield, it's not enough to say, yeah, we're going to pass on EFFR to the holder. You have to say, but we're also going to loop it 17 times, which dramatically increases the risk profile. And so competition is great. We're all in crypto because we like open markets. But there is a pendulum, and when you get too much competition, it just brings this extra fragility to the market.
I am waiting for the consolidation phase, man. You know exactly how I feel.
Guys, any further points on that topic, or are we gonna close off there? It's like a last chance to pull a point in there. All good? All right. So, thank you very much, guys. Thanks for listening, for joining. I think for me, personally, I work with lots of institutional trading firms, but I think everybody in the room, needs to be aware of of liquidity and how it's managed. But it's great to actually unpick the mechanics with the panelists here today who actually can. So thank you very much, guys. Thanks for sharing your thoughts. Thanks for the discussion. And yeah, we'll wrap it up there.
Thanks, everyone.
Thanks so much.
All right, thank you very much. Great job, Anton. If I could have you gentlemen step forward and pull tight for a photo. There you go. All right. Very good, gentlemen. Well done. Great panel. Anton, you did a fine job. We appreciate it. There we go. Here at Liquidity 2026 at the Marriott. Well done. All right, Mr. Giuliani. Got through all that with no Mayor Giuliani jokes. Well done, Anton. Okay. All right, moving right along. Sometimes people think that the crypto industry has gone off the rails, but how can you go off the rails if you haven't even built them yet? So we're going to be talking about how the institutions are building guardrails to facilitate bringing digital assets and the traditional asset worlds together. Absolutely spectacular panel, ready to bring that to you. Your moderator for this panel is Alevtina Lobiak, and she wants you to be in crypto. Somebody else she wants to be in crypto is Chris Shin. Chris Shin is with Kyobo Life Insurance. He's going to be joined by his Korean countryman, who is Jae Kim, who's joining us today from Mirai Assets. From one of the global heavyweights, Amazon Web Services, we're going to be welcoming Zhen Xing. As well, we're going to have Sherry Tsu from the Futu Group, rounding it all out as one of the big names in crypto. From Solana, we welcome Ramzi Ali. So that's a big panel, so let's get them up here and ready for action. Aleftina, it is your time. Bring your gang on up. Don't be shy, guys. Run on up here. Here we go. There we go. Let's give a little round of applause. Get them warmed up, ladies and gentlemen. Here they come. All right, thank you very much. Ready for action, these guys. There we go. Cheers. And one more. All right.
I'm very sorry. Oh, it works perfectly. Okay, let's start. In 2025, institutional capital poured into crypto at an unprecedented scale. BlackRock Bitcoin ETF pulled in $40 billion in first year, while tokenized treasuries surpassed $5 billion in market cap. And Goldman Sachs, JP Morgan, and Citi are now issuing and settling securities on-chain. And the question currently is not how well the technology is developed, but how catastrophically it can fail if something goes wrong. And is infrastructure ready for the pressure that institutions are bringing with them? The legacy finance took centuries to build settlement rails and custody standards and regulatory frameworks, and digital assets needs just years to do this all. So today we will be discussing how industry is building institutional rails for the digital asset economy. And today I want to introduce you our speakers. First, I would like to introduce you the representative from the Kerber Life Insurance, Chris Shin. Kerber Life Insurance is one of the Korea's largest insurance companies. And last October, Kerber became the only Korean firm to join Circle's ARC blockchain testnet, alongside Goldman Sachs, BlackRock, HSBC, and Standard Chartered. Chris, could you please introduce yourself?
Hi, my name is Christian. Thanks for having me. I am a Director of Global Strategic Partnerships at Kyobo Life Insurance. Kyobo Life is a 68-year-old, 100 billion AUM with 4 million policyholders. It's building the national capital right after the Korean War. And we have other subsidiaries like Kyobo Securities, Asset Management. We also have the biggest bookstore chain in Korea. So we're actively engaging how we can leverage the whole on-chain finance wave so we can better serve our customers and be competitive in the global market. Thank you.
And the next speaker is actually also from one of the most renowned companies, from Mirai Asset Solutions, the part of world's 12th largest ETF manager with over 320 billion in global assets. And this January, Mirai announced plans to tokenize all of their assets. Jay, could you please introduce yourself?
Hello, everyone. My name is Jay Kim. I'm leading initiatives at Mirai Asset Securities in Korea. Our division is to drive overall strategy for digital assets and business development within our group. So to give you a little bit background on Mirai Asset is one of the largest independent financial group in Korea, managed over 750 billion USD in global assets. So we operate from investment banking to brokerage, asset management, and so on. We have presence in Asia, in the US as well. So in terms of digital assets, our vision is to tokenize premium assets on our platform, which will provide 24/7 trading and instant settlements and programmability, which will innovate financial products. So that is what we're trying to do. Is we're trying to build a infrastructure for the future, will encompass all the assets on chain. Thank you.
And the next speaker is exactly the person who is representing the company which is the backbone of institutions engineering digital assets. Sheen from IWS, the cloud infrastructure powering a significant portion of global finance services and Web3 platforms. Sheen, could you please proceed with the introduction?
Hello, everyone. This is Zheng Qin from AWS. I'm a solution architect at AWS, focusing on the crypto industry services customers. So we have been working with the crypto industry customers for over decades, including those centralized exchanges such as management company, brokers, crypto mining services company, to actually help them build highly performance and highly reliable services and architecture on AWS so that to serve their critical businesses.
And on the user case, we currently have also Sherry Ju from Futu Holdings, the largest tech broker in Hong Kong. And last year, Futu partnered Coinbase to launch Mumu crypto platform, which provides all-in-one trading experiences.
Hi, everyone. This is Sherry. So currently, I'm leading the group's Web3 business. So for Futu, our vision is very simple. We want to provide a compliant, an easy and secure investment platform for the investors to trade traditional securities as well as cryptos. So globally, we have launched crypto spot trading in Hong Kong, Singapore, and US. And last year in Hong Kong, we actually launched the crypto deposit and withdrawal functions. And hopefully, for the upcoming year and years to come, we will have all the jurisdiction where we have securities business to have an extension to cover crypto trading as well.
And the last but not the least is Ramsey from Solana Foundation. And Solana's institutional ecosystem surpassed almost $1 billion of ETFs across Franklin Templeton, Bitwise, VanEck, Fidelity, and Grayscale. So Ramsey, could you please add some comments for the context of today's panel?
Yeah, it's great to see you all here. I'm Ramsey. I'm the head of DeFi at the Solana Foundation. For those who are uninitiated or don't know, Solana is the fastest, most performant, most efficient L1 in the world. We finished last year with some pretty impressive numbers, $1.6 trillion in trading volume, about $14 billion in stablecoin liquidity, and all of that is on a monolithic single state L1. And that's really our kind of key selling factor is that we maximize composability and efficiency for everyone using it.
Thanks a lot. Now, when we understand the background of each of the panelists, let's deep down into the questions. So my first question I will ask to Jim Kay from Mirai, because it refers to the assets. How do institutions actually balance building new digital assets capabilities while integrating them into existing legacy systems?
So there are a lot of practical challenges that we're facing in terms of integrating a blockchain into legacy system. One particular thing I would like to mention is, so since blockchain is a decentralized system, whereas traditional financial systems are mostly very siloed, centralized systems. So especially around the client data and client information. So in jurisdictions like Hong Kong or in South Korea, financial institutions have a lot of strict obligations in regards to protecting client data, which makes it very difficult to just send out public information, like client information on the public blockchain. So one approach that we're taking, which I believe is quite common across other institutions, is that we're trying to keep the client very sensitive information off-chain with all the transactional data as well, while we maintain the blockchain as the representation of asset itself and also the transfer of value. So with that being said, also custody is also another thing that we're facing. Try to balance out between Web3 and Web2. A lot of financial institutions are used to using very trusted custodian banks or either centralized depository institutions like CSD. But when you're moving to digital assets, controlling private key is a core to your operation. So it is quite difficult in terms of making a new internal policy controlling the private keys. Also, you need to be able to ensure the regulators that your security standards are very met with their expectations. So there are a lot of challenges that we're facing. And lastly, I want to point out that trading is also part of the challenges that we're facing because, as you guys all know, trading venues are very, there are a lot of trading venues. So there are about like hundreds of trading venues in crypto, digital assets. So for us, traditional finance, we are very used to very monopolistic trading venues. So in order to integrate all the liquidity, aggregate all the liquidity, we need to be able to understand each different infrastructure of the trading venue. Some trading venues support stable coins. Sometimes they settle in fiat currencies. Nowadays, you have hyperliquids of the world where you operate 100% on chain. So those are the things that we need to understand ahead in order to integrate these systems. So the balancing is very hard. It's something you need to cope with, but it is something you need to do to move forward with the innovation.
Yes, absolutely. And Chris, as another Korean corporation, I'm pretty sure you face very alike challenges. How do you approach them?
No, I fully agree with what Jay said before, and I want to focus more on the technical side of the integration. So, of course, we've been around for almost 70 years. The legacy system is very hard to adjust, and more companies are moving on to cloud, like Amazon. And being tech ready is really important in this era where we're entering into, so digital and finance is almost a synonym, and being nimble and flexible is critical to this fast changing era. So someone like us we have a lot of challenges. So we are trying to make a hybrid approach where we build something outside, build from scratch, and then prove it from outside, and then add it on to the existing system. Also, of course, there are many regulatory hurdles and standards that we have to meet with the regulators. But once we have a proven model from outside, we have easy time persuading the internal stakeholders. So it's really hard balancing, but we have to tackle one by one, and a hybrid approach is a good way for us, I think.
Thank you so much. And if we are talking to like more traditional experiences like trading, etc. So as a traditional brokerage entering the crypto space, Sherry, compared to native crypto players, what kind of challenges you are facing and what kind of benefits you are bringing to their space?
Hello. Yeah, I think it's working. Sorry. I think for the biggest challenges, it would be all about infrastructure as well as talents. Because I'd say, I totally agree with Jay, like when entering into the crypto space, there are certain, skills, for example, how you can manage custodies, the keys, all these are actually new information. So for a bunch of existing TradFi talents, it would be a bit challenging for them to like quickly pick up all those techniques as well as to build a very safe infrastructure. So I think in that part, within our own company, for the talents hiring, we do open to the crypto native people as well as TradFi people who have the interest to enter into the Web3 space. And in terms of opportunities, I'd say it is very, very obvious for our platform. Two keywords, trust and convenience. So for trust, it is about your brand name. It is about your licenses, your compliance framework, and it is also about like asset safety as well as like fiat rails. So for our brand name, it is now one of the largest fintech broker platform in Asia right now, and we have like 28 million users globally. So it is easier for those existing users to trade crypto on our platform rather than switching to a completely new platform, whether they have licenses or not. And in terms of like safe custody, because we have the license, we have to comply with all the regulatory requirements in each market. So generally, the clients will trust us for holding their assets safely. And for fiat rails, because we are an existing broker in those jurisdictions, so banks are usually more friendly in accepting cash in and out for crypto trading purposes. And for the second point about convenience, there are also two folds. I think the first one is also linking to the banking rail, because we have the banking rail, which makes it very easy for people holding cash to trade crypto on our platform. And also for crypto deposit and withdrawal function, it is very easy for them to complete the on and off ramp in a very safe way. And the second thing about convenience is that we are a one-stop solution for both TradFi and crypto. So we are a truly like multi-asset platform. So for people deposit crypto on our platform, they can off-ramp it and seamlessly use the funds to buy traditional securities. So those are the opportunities.
Absolutely, and no scalability is possible without safety. And I saw that Ramsey was actually supporting what Sherry was sharing with us. Ramsey, what infrastructure requirements must be in place before scale becoming is possible?
Yeah, I mean, I think, you know, on Solana, our number one focus over the last couple of years is just maintaining our performance and our uptime. And, you know, over the last 2 years, the chain has not gone down. It's performed incredibly well in the sense that, you know, we can maintain relatively high TPS. The cost to transact is incredibly low. And so I think, like, ultimately the infrastructure requirements are consistency. It's not really one thing. I think there are certain elements of custody that need to be solved in a way that get institutions more comfortable with having their assets exposed in a permissionless environment. I think there's also elements of the protocol that have to be refined for more sophisticated market participants. And so that's something that I think like we're really laser focused on, is ensuring that the user experience and the ability to interact with the chain is not impeded by the knowledge of niche sort of Rust and other like kind of coding languages. Ultimately, we want to make Solana as accessible as possible to anyone who has the intent to trade anything. And so I think if, you know, to answer your question, what piece of infrastructure is kind of impeding institutional adoption? I think it's really consistency and accessibility, and that's why I actually really agree with what Sherry was saying about, you know, trust and ensuring that the counterparty trusts the chain implicitly, and that's yeah, I think probably the most important thing for us.
Okay, so we have consistency and accessibility. And Chris, from an asset owner and allocator perspective, what infrastructure requirements must be in place in your opinion?
I think the Korean market, the regulatory framework is still uncertain. So I think that's the biggest hurdle for us going forward. It's really hard for a big corporate to make a decision with an uncertain framework. Nevertheless, the digital asset basic law is moving along, so it will open up eventually. So we're preparing for some of the things that doesn't require a very detailed guideline. For example, we're doing a lot of POCs with the external partners where we can really test out how we can integrate the blockchain rails with the legacy system so that we can receive, for example, insurance policy premium in stable coins, or also pay out in other coins and stable coins as well.
And Jay, do you agree on this perspective, or would you like to add some other points?
Well, I would like to add one more thing, that I think what is required for scaling this type of like security token, especially on the security tokens, if you want to scale on a global level, I think you need to have a standardization, because nowadays you have different types of assets across different blockchains. They all serve different purpose, but they all fall under security in some jurisdictions. So I think what we need is to have a standardization of all the, not just the technical part, but also on the legal part as well. In order for if you have all this different framework for each different security, it will cost a lot of operational friction to settle these tokens. So if you have the standardization, it will cost much less time and resource to settle these tokens. So.
Okay, Shin, we did for you currently a quick market research from your potential or current customers on what is their expectations. So that's what my question next is coming to you. How critical are cloud infrastructure and data architecture to actually build this institutional grade asset platform? What are you doing at AWS?
Okay, so it's kind of a big question. So if I want to dig into technological wise, I think it takes more than an hour. So I'll cut it short. Actually, many crypto or Web3 customers is actually born cloud native. Like Chris also mentioned, many of them is actually going on cloud, and they are using cloud to build their mission critical workloads. So the key thing here is that the institution and the digital markets. So to simply say, the cloud service provider actually provide the platform with the data resilience and service resilience built in for the institution to run. And cloud service provider also provide elasticity for the digital market to run. So simply said, all the digital market, or you said the crypto is running 24/7 global-wise. So for your mission-critical applications, the resilience is a must. So it's not simply some technical stuff. It's actually something about your business protector. It's your revenue insurance. People don't judge you, don't judge the institutions on a normal day. They judge you on a fluctuation days where 10 times surge traffic coming through your gateways. So that is the key point. You need to build in with the resilience and elasticity on cloud. So for example, here we are in Hong Kong, and AWS has a Hong Kong region. The Hong Kong region consists of 3 availability zones with multiple data centers. So these availability zones is connected, is geographically distributed, but interconnected with low latency networking. So that is the platform for the institutions to build high resilience and high elastic services, the mission critical service for them to work with the digital market, the fluctuated digital market.
Okay, thank you. Still for me a little bit too technical. Okay, because everybody is so serious, but come on, we are talking about institutions. Sherry, what do you see as the key factor currently hindering institution adoption of cryptos?
Well, I think one of the main hurdle is the regulatory fragmentation, because for now, each country is trying to having their own like regulatory framework, and because of the very specific custody risk which happens in crypto, which does not apply to the TradFi, so far we don't see any cross-border mutual recognition schemes for one market, one jurisdiction to recognize the other jurisdictions, say like crypto exchange regulatory platform or like, regulatory framework or like custody framework. So I think relatively it makes things very challenging compared to the TradFi world, meaning that in the TradFi it is very natural for all the liquidity to be centralized, say on NASDAQ or NYSE, or in the derivatives market we have like CME. But in crypto, it's like each market is very fragmented. So for a global company, say Goldman Sachs or Morgan Stanley, the infrastructure they are using in US does not really apply to Hong Kong. Make a very simple example, like in Hong Kong, the largest BTC ETF, IBIT, is not even permitted to be offered to retail investors here. So I think from this angle, when a company or an institution plans to like embrace crypto, it is usually they can only embrace in one jurisdiction versus all jurisdictions. And I think the second challenging part definitely is about custody, because that is an entirely like novel risk for crypto. So for TradFi, it is hard to embrace that part. And I think the third part is about the banking treatment as well as like accounting treatment for crypto, which makes it financially challenging for an institution to recognize it on its balance sheet. For example, in Basel, like the crypto is subject to 100% haircut, which means if you have to comply with certain like liquid asset rules in certain jurisdiction, if you are holding crypto, it means 0 on your balance sheet. So I think all these little by little makes it very difficult for an institution, like from risk management, compliance, business perspective, to embrace this category entirely.
So this is a business perspective, but if we are looking at the perspective of blockchain and technology, my question is to Ramzi. How are institutions thinking about security control and governance that are literally the internal regulatory for blockchain?
Yeah, I'll give you a couple of examples here. And so really what we've seen in the last year is Solana expand its number of products for folks who are concerned about things like custody, self-custody in this context, KYC, AML compliance, as well as transaction privacy. And so from a custody perspective, we saw Anchorage and Camino, which for those that don't know, Camino is our largest borrow-lend market, actually build a product that allows institutions to retain their assets on a qualified custodian, Anchorage in this case, mirror them on Camino and borrow liquidity against it. Now, really what that unlocks is a much broader suite of assets that can be held in custody and in collateral on a permissionless borrow-lend market. So you see this melding of both CeFi and DeFi in that context. To kind of discuss the KYC AML compliance, we've decided to actually build out two different solutions. The first is the Solana attestation service, which is a ZK compliant attestation call that lives directly at the protocol and is built and maintained by the Solana Foundation and Solana Labs. And basically what this allows is for an application to query if a wallet is eligible to access a product or to trade an asset or to deposit funds into a vault, all without the user having to share private confidential information to that application. And so yeah, we built this attestation service that can be called by virtually anyone who builds a product on Solana, and it's saved a lot of headaches in terms of managing that KYC. The second solution is Contra, which is our private state channel. Essentially, it's a private execution environment that lives directly in Solana. So no longer are there any requirements to have to build an L2, use a bridge, and interact with a new network or a subnetwork in order to gain privacy and minute control over transactions. You can do it all within the Solana L1, and this is also something that the foundation, as well as our sort of suite of advisors have helped us build. Yeah, I think ultimately like these are the concerns that institutions have, right? They want to ensure that they're compliant. They want to ensure that their assets are held in a secure manner. And of course, they want to interact and participate in DeFi because ultimately that is where the next frontier of yield, the next frontier of trading, all of that will be invented and will be proliferated. So yeah, I think that's those are some of the solutions that we're hopeful will work, but working on a lot of other stuff too.
And such complicated systems with so many elements and so many procedures in place are impossible to do just by one company. So usually you're operating in a series, in an ecosystem of partners who are supporting you from different perspectives. And Sheen, I wanted to ask you, because maybe you are the company with the biggest number of partners among all of our speakers today, what role do technology partners and third-party infrastructure providers play in accelerating institutional ecosystems?
Yeah, in terms of accelerate the institutional readiness, I think the first thing is we need to go back to the building blocks. So the cloud providers or the technical partners, they provide essential primitives. That these primitives is actually the building blocks to build institutional critical applications. So these primitives actually be there out of the box for the institution to try and to run. For example, the AWS has so far has 39 regions across the globe and has 123 availability zones and has more than 200 full-feature services that is out of the box for the institutions, for everyone to play, to use, to test their solutions on top of it. And that is not enough. The second thing is that beyond the primitives, that we also have the inherited solutions, the inherited experience that build on these primitives, tailored for the crypto industries. And these solutions are valuable assets for the institutions, so they can easily to adapt and catch on the real market, to catch on the current solutions that in this market. And thirdly, I think together with the cloud providers and the technical partners, we need to build an ecosystem for the institutions that they can test safely and securely on this platform. And also they can fail fast. So they can recover fast. They can try their own business fast to make sure they eventually reach their readiness on this current market.
Absolutely, I can support each word as we are also the client of AWS and we are using the infrastructure. It helps a lot. But from the perspective of the brokerage, Sherry, could you please advise what role the technical partners plays in you to help you scale faster? For example, you partnered Coinbase, as I remember, to launch Moomoo platform.
Yeah, I'd say the support from technical partners is very, very important. This includes not just our upstream liquidity provider, but also some very fundamental support that the users might not experience. For example, AWS or other cloud service providers for providing cloud services to maintain our system as well as to holding key shards. And of course, there are lots of wallet providers. For example, there are MPC, HSM, different kinds of wallet providers. If you have to build this in-house, it is technically impossible. And all those like experts, wallet providers, their solutions have gone through all the NIST Labs test. They have all the FIPS level certificate, or they got the SOC 2 Type 2 like certificate. So I think for all these like type of certificate, they're actually another form of tech provider. They're helping us to certify such kind of solution is actually subject to the same standard of all the banking level infrastructure. And when talking about like AML, KYT, wallet screening, we also have a lot of on-chain partners such as Chainalysis, Elliptics, et cetera and et cetera. I'd say without their help, it is impossible for an institution to build a crypto exchange and other like crypto trading business.
Absolutely. And if we are looking ahead, Jay, what signals would confirm that institutional rails for digital asset are mature enough to support mass adoption, in your opinion?
As for the mass adoption, I think the tipping point will be when you start to see listed public stocks being tokenized natively on chain and circulate on a public chain will be a very significant signal. I'm not referring to the ones that you're traded in a certain platform today, but those are mostly, I would say they're mostly like a derivative products than equity itself, because it doesn't attract a lot of institutional demand for now. But once you have the actual shareholder rights tokenized on chain, if you think about it, listed stocks are very foundations for all the vast majority of the traditional financial products nowadays. So once you have the rights on chain, you will have everything built on top of that will also migrate to on chain. And more importantly, I think the biggest signal will be when the average investor starts to realize that or even they don't even care if the assets they're investing or trading are tokenized or not. It is more like the blockchain, the power of blockchain, I think, is not to just sit alongside with traditional infrastructure. It is more likely to replace the majority part of the infrastructure. So that is, I think, the biggest signal. So I think sooner or later we'll start to see many traditional institutions start to onboard their flagship products on chain, like the ones you see from BlackRock or Franklin Templeton. You see a lot of MMF funds being tokenized on chain. This will start to accelerate in the future, I think. Why? Because a lot of institutions, they can't just ignore the benefits of having these assets on chain. One is that they can have potentially have 24/7 global liquidity for all these assets, and also through fractionalization ownership, you can now reach to the new segments of investors through fragmentation. Fractionalized ownership of certain assets. So you can now fractionalize certain real estate. Before, you can only have a certain amount of money to own a certain building. Now you can do it on a fractional tokens and own it by just a small amount. So that is what is changing right now. I think the key factor to success in the financial industry in the future is having these challenges, having this certain strategy to solve these challenges, and preparing for the future.
Absolutely. And Chris, from a corporate perspective, what signals do you see, or maybe you just agree with Jay on some of the signals that he mentioned?
It'll be, again, the regulatory framework, the clarity on how the country can go forward with embracing the crypto assets into the existing financial system. Unless that is cleared, institutions will be hesitant to invest in these systems and bringing in interesting assets such as BIDL and Benji. So the retail adoption is a one thing, where institutions are another thing. Korean market is famous for its vibrant investorship of crypto assets, where there's almost none of institutions markets. That is exactly because of the regulatory framework, and we're eager to wait until that bar is open, and we want to comply with the regulatory framework, but also try to provide our clients, be it institutions or retailers, the attractive products such as the DeFi or yield-bearing tokenized assets, so that we can better serve the market and keep up with the market.
Okay, and from Solana perspective, Ramzi, what signals do you read telling you that the industry is ready for institutions?
I mean, I agree with everything that's been said so far in terms of regulatory clarity, and I think, like, just to add to that, markets, I think, are an interesting litmus test here, and really the scale of on-chain capital markets, I think, will be sort of the tipping point of when we see institutional adoption truly cross the chasm of reality, and, from what we hope to kind of see over the next few years to reality. And I think a really good litmus test for that would be if price discovery of a blue chip or a major asset were to happen on-chain. Right now, price discovery basically just follows where the liquidity is deepest. And so you could argue that Bitcoin's price is currently being discovered on kind of like the Binance perp club. And I think you would argue that pretty much all equities have, or, US equities at the very least, have price discovery localized to either the NYSE or the NASDAQ. I think if we see a point in time where a large enough asset that is global and kind of captures the mind share of capital markets, retain it, or kind of have its price discovered and originated on chain, we can confidently say that institutions are here.
Absolutely. And now I will ask all of you in 1 minute maximum to give us a bold prediction of where institutional digital asset infrastructure will be by the end of this year. And of course, no financial advice. Chris, could you please start?
So we don't know when the regulatory framework will be lifted. So instead of banking on the local regulators, Kyobo, as a group, we want to expand outside of Korea so that we're free from waiting for the regulators. So we want to set ourselves outside of Korea, where the regulatory framework is more settled, and that way we can build our own platform to deal with crypto assets as an asset management. So by the end of this year, I think we'll have our own platform outside of Korea so that we can serve institutional and retail clients.
Jay?
So there are many moving parts in integrating this new technology into our legacy systems. So we need to coordinate with a lot of external partners, but we also need to coordinate within our firm as well to try to educate them and help them work with us in terms of changing a lot of components to the legacy system. So sooner or later, hopefully by next year, we'll have some sort of a retail platform with a tokenized product natively issued on chain in Korea, also globally through our integrated system. There will be challenges, I think, on the way. There could be some compromises where a lot of decentralized features that was praised in the Web3 might have to be somehow compromised with the legacy system. but I believe we're in the transition phase. So the prospect is very clear. We're on the way to the blockchain infrastructure of traditional finance. Thank you.
Thank you. Shin, could you please share your take on how the digital asset infrastructure will look like by the end of this year?
Oh, that's a big topic, actually. It's very hard to forecast, but we do know that as infrastructure providers, we want to provide with our customers the best-in-class infrastructures to help them build the data resilience, the service resilience, and operational resilience on top of the cloud infrastructure. I mean, the cloud infrastructure becomes invisible when it becomes success. But however, on the other side, the disruptor technologies like AI is actually coming, so they are actually drive the innovation of the digital market, drive the innovation across the world. So it's going to be a major change by driven by the technology side. So AWS actually want to provide both things to our customers to make sure they can success and strive in this wave.
Okay, that's for sure. Sherry?
Yeah, so I'd expect there will be more clarity in terms of how the regulatory framework is going to identify crypto to be sort of equivalent as TradFi securities based on the same business, same risk, same rule philosophy. So that I think in Hong Kong, very soon we will see the regulator allowing the cross-margin type of business model. And I think in that case, it will fundamentally pave the way for the crypto asset to be identified to be something equivalent as TradFi asset, because it will be able to be used as collateral for margin purposes, etc.
Thank you. Ramsey, your boldest forecast.
Well, I guess if we assume that my co-panelists are correct and that the regulatory clarity will kind of become more evident this year, I would really like to see the first direct listing of an IPO on-chain. I think an entirely native direct listing would be an incredible milestone, and hopefully that'll be on Solana.
Thank you. Thank you very much for the panel, everybody. And as we see, institutional adoption is not something behind like the doors. It's already here, it's being built, and it's being built pretty fast. And stakes have never been so high as they are now. So thank you everyone for the insights, and wish you all nice end of the day.
Thank you very much, Valentina. And if I can have you all stand up and come close. Our photographer is making his way in to capture your smiling faces. There we go. We are taking a short break. You've got 15 minutes to recharge, refresh, grab some coffee, do your thing. The people at Avelicom are sponsoring our coffee breaks today, so thanks to them for getting us a coffee. And we'll want you back in your seats 15 minutes. We got 2 panels to close out the day, and they're dynamite. So thank you very much. Great job to our panel. Well done. All right. Valentina, don't worry. We got that covered. You're working double overtime. Yep, no problem. I appreciate the effort. That's great. Thank you very much. I'm Andrew Work. Be back in 15 minutes. Thank you. And we are back in action at Liquidity 2026. Whoa, the guys in the AV booth gave me a little pop. Thanks, Stephen. All right, we're back in action. Our next panel is ready. And we're going to be talking about what happens when everything becomes collateral. One of the beauties of the crypto world is that for those that were really into it, you always had the opportunity to stake your claim, to be able to use your capital and put it to work, which, frankly, traditional finance has not been very good at the last few years. They kind of took your money and let it loose everywhere else, and you were lucky if you got 2 cents of interest. Crypto's been great for that. But now, real-world assets, tokens, everything is becoming collateral that you can stake. So how exactly is that going to work? We're going to find out with a panel that is going to be led by Ryo Sakai from CoinPost. He's going to be up here with Emma Pasenicic from Fidelity. Sitting next to her is going to be Michael Chan from UBS. We have Michael Chan from Zand Bank, which is the first digital bank in the United Arab Emirates. Kayan Chan is from UBS and is going to be joining this panel. And the last big name is from Franklin Templeton, is Chetan Karkanis And so they are ready for action, and Ryo Sakai is going to bring them on up. Let's do this, Ryo! Yeah, let's go. That's what I'm talking about. There we go. How was that? Thank you. All right, go get him. The man from Zan. Cayenne, great to have you. All right, Chetan, go, go, go.
All right, thank you so much for coming here today. So we have amazing speakers here. So I want to start the introduction at the first. So myself, I'm the moderator for this panel, Ryo Sakai from CoinPost, and also organizer of WebEx. We do the biggest crypto media and organizing the conference in Tokyo. So whenever you guys come to Tokyo, just feel free to hit me up. And then a lot of things are happening in Japan. I'm so excited. So at the first, we're gonna have an amazing speaker here, Emma from Fidelity, Michael from Zenbank, and then Kayan from UBS, and then Chetan from Franklin Templeton. So can you start the introduction at the first?
Yeah, thank you, Ryo. So I'm Emma Pesenisik from Fidelity International. I did digital assets globally for Fidelity International. That means 2 areas, crypto, ETP, ETF, and enable our clients to have crypto exposure through those wrappers, and as well tokenized funds. So we lead all the activities around fund tokenization. Fidelity has been in the space for more than 10 years. Back in 2014, we started to do Bitcoin mining, and we are really one of the only asset managers that have started that early. From that journey, we developed a crypto custody solution in 2018 with Fidelity Digital Assets, who is now the backbone of all the product that you see, whether it's a crypto ETF, Bitcoin ETF, or Bitcoin ETP in Europe.
Amazing. Michael.
Yeah, thanks. Thank you for having me. So my name is Michael Chan, the CEO for the Zenbank. The bank based in UAE, the bank actually got a full license, and we have TradeFi side and a DeFi side. So TradeFi is more on corporate banking that you have the global market, the corporate banking side, wealth, and also asset management. And DeFi side, actually, we are issuing dirham stable coins, and then we have a digital asset custodian under the bank. And then we are actively also participate, the tokenization project with the Dubai land authorities. Besides this, actually, we are also doing a lot of AI projects with smart cities, and then in Abu Dhabi, Dubai, and Sharjah as well.
Hi, my name is Cayenne. I lead the digital asset business development team out of APAC for APAC. Mainly responsible on the 3 pillars of UBS digital asset strategy. And that is 1, crypto products onboarding, as well as exploring crypto trading and custody for UBS wealth management. 2 is about onboarding crypto wealth clients. And 3 is tokenization, money market funds, gold, etc.
Hi, everyone, and hope we're going to make this session. This is the first time I've been in a session with 2 or 3 other asset and wealth managers on digital asset tokenization. So very excited to be here. Chetan Karkanis, I cover digital assets for Asia Pac for Franklin Templeton. Emma, you may have been the first to mine Bitcoin. We were, I think, the first to actually launch a tokenized money market fund. But who's counting, right? So 3 main areas, just as Emma covered. We focus on tokenization, so the actual issuance of tokenized real-world assets. We focus on investment strategies related to crypto, so listed token strategies or ETFs. And then finally, we do staking and node operations and are looking at a whole other ways to partner with our peers in the industry.
Awesome. So as a media, I want to ask a lot of questions to all the speakers here. But today, the main topic is going to be everything's going to be cloud law. So a lot of people here must be pretty interested in how everything's going to be on chain, how people see it in the future. So I'm going to focus on this topic and then start asking the question. Is everything good? All right. So at the first, I want to ask, how are institutions redefining what qualifies as acceptable cloud law today? Can you start the question, Michael?
Sure. From the institution point of view, it's very different than the non-institution, of course, right? Because all the institution actually has to follow the Basel, right? So right now we're talking about Basel III. In terms of Basel III, the basic principle is that the collateral must be fulfilled 3 things. The first one actually is the liquidity. The second one is acceptability. And the third one is the legal enforcement, right? Example, money market fund tokenized actually considered actually high liquid and then stabilized and then is enforceable actually by the legal perspective.
But if you talk about real estate, it will be very different because liquidity will be low, right? So the classification will be different because I think the main point for the institution point of view is two things. What is actually the risk weighting for that, and what is actually the capital consumption on this, right? That's driven actually, there's interest for the institution, whether they should or they should not actually classify this as a acceptable collateral.
Thank you. What about Kayan?
Yeah, so like Michael says, it's very different, and it also depends on what kind of lending business you're trying to do. For wealth management, we're most famous for Lombards. So for Lombards, pretty much everything could be collateral, right? From cash like US dollar, euros, to securities like equities, bonds, to money market funds, to even private equity. I think what's different is the haircut that you apply to the different asset class, and that depends on one, market liquidity. Two, it's about the price availability. Three, it's about the country of risk, and so on and so forth. And that is very different from institutional lending, right? For example, if you want to post margins for futures and options trading, then a lot of times that is actually guided by the regulators and also by the exchange. They would say, for example, in the case of CME, they would be more liberal and lenient, and you would be able to post like money market funds as collateral. But if you're dealing with, let's say, the NSCC, they would be much more harsh and narrow, and you would be able to only post like treasuries and agency bonds and so on. So very much restrictive. So it really differs on the markets, what kind of products are you trading, what kind of lending you're doing. And I think coming back to tokenized collateral, I think the key value add that tokenized collateral could bring is that ability to do 24/7 settlement and instant payment, because in that case, for margin calls, it becomes a much more mobile, collateral.
All right, thank you so much. So I think you mentioned about liquidity. I think it's going to be like a really important topic, not only as a collateral for like whatever in the crypto space, like institutions. So I think, how do institutions evaluate the liquidity and the haircut framework for non-traditional collateral? Can I go back to you, Kayan?
Yeah, so as I said, it depends on the market value, the volatility of the asset class, how liquid it is, and how readily available am I able to find buyers and sellers in the market.
Thank you. What about Michael?
The haircut actually depends very much, I would say, the coming Clarity Acts in the US, because that will change everything almost, right? And then on the other hand, it's how quick the other regulators in a different jurisdiction follow. Haircut basically is quite clear definitions. The LTV ratios, for example, if you tokenize that, what ratio you should apply. But the new classes for the tokenized asset may not have actually these classifications. But unfortunately, because of this, right, it probably will fall into the group 2, which is the Basel. That means actually you need to apply 1,250%, on the asset for the capital consumptions. So I think let's see whether Clarity Act will be approved, and then how actually the other country will follow.
All right, thank you so much. So I think when it comes to on-chain, definitely the other topic we got to think about is that risk. So I think a lot of people hesitate to be on-chain because even though as a gold, a lot of people say like on-chain gold should be like, can be, be instead of like a real gold or something. A lot of discussion I've ever seen before. But I want to ask you about this on-chain too. So what operational risks consideration arise when the cloud law moves on-chain? Can you ask Emma?
So we see 4 main risks: the legal ownership risk, the operational risk as well of moving capital and token on-chain. You have as well the custodial risk, and finally the liquidity risk, right? So those are the 4 main categories. If I look at the first, the legal ownership risk, it's important that you decide when you invest, and you decide to use a token as a collateral. Often the requirement is to make sure that the token is actually, the share of that asset. So in a fund context, you will look at it as only taking what we call digital native tokens. So in the fund area, you have digital twins as well. So it's typically when you have someone else creating a twin version of your product. And as a result of that, the end investor cannot claim the direct ownership of that asset. As a result, those digital twins cannot be eligible for collateral. So that's why a lot of asset managers like ourselves have been, expanding from digital twin to digital native products. So now at Fidelity International, we're looking to launch our digital native product issued from a jurisdiction where the end investor can have the clarity that they are indeed the token holder is a shareholder. So that's one. Then operational risk, right? On the operational aspect of things, because the collateralization, often what you will do is that you will put your tokenized asset in custody somewhere and you will trade on exchange. So there is an operational, and smart contract layer that operates between your custody layer and your exchange, right? And that add, additional risk that you need as well to first implement and as well monitor, right? And have a proper governance around that mechanism. Third, the custody risk, right? When you want to claim back that asset, you have really the ability to claim it back? And that's, again, how you're going to operate all the private keys around, the wallets that where the tokenized assets sit. And finally, it's really liquidity risk. From our perspective, as I mentioned, we're developing digital native products. And for those products, because they will be eligible as collateral, you need to make sure that eventually if someone starts to redeem it, you can basically liquidate everything in order to basically enable this redemption, right? And that's where, there has been so far a bit of, not great liquidity yet around, those products. And from a portfolio manager perspective, you need to be ready to manage that on the primary side as well. So those are the key categories for investor and people to look at.
All right, thank you so much. Can I ask you, Chetan?
Yeah, I think Emma's done a wonderful job of covering most of the risks. So not much to add there, except for, I think on the point of, this is an important point when it comes to tokenized money market funds, because I think we would like tokenized money market funds to be given the same respect as a traditional money market fund, especially if it is used for collateral. And there also the point being, if you're going to design it for collateral, then it has to reflect the investment characteristics of a very safe, ultimately we can't decide what can be used as collateral. It's up to the banks, it's up to the regulators, firms, institutions like the BIS, but we can actually influence the composition. So 99.5% comprised of T-bills, very safe, low duration under certain wall or WAM metrics. That's how I think you can control one of the elements of investment risk. But to add to Emma's points, look, what happens if you've got a digital twin and you've got a situation of bankruptcy or duress? You have to have a token that the legal ownership represents the interests of the parties involved, right? So that's why we actually did design our iBenji product, for instance, as purely an on-chain digital. There's no digital twin. It's purely on-chain. It's a single source of truth, and it's designed such that any party to whether it's a custodian or the issuer or the client has an understanding of who actually owns the ownership rights in that fund, in that collateral. On the operational level, I think it's very important to keep these assets bankruptcy remote, as well as have a 24/7, 365 liquidity mechanism that enables you to mark to market the position and get your assets back or claim assets if there's a default at risk. So, I think that has worked in the traditional world. In the tokenized world, it has to be seamless, and that's where some of the operational flavors come into play.
I think the seamless should be really key point for the collateral, but I know you have a lot of collaboration and the partners, each regions. How do you see regional differences between regulation from the US and other countries? How do you fix these problems, other operational risk?
Specifically with collateral or just in general?
Whichever you're comfortable with, but
I think collateral is a pretty specific use case, but in general, so by background, we have issued tokenized money market funds because they're a security and they're regulated by the securities regulators of each of those governing jurisdictions. So we have the US regulator governs, SEC governs the 40 Act Benji Fund, MAS governs the Sing Benji. In Hong Kong, G Benji is for professional investors only, regulated by the SFC, but it's a Luxembourg domiciled product. So there is a bit of portability, But ultimately, in some ways, it does feel like we're going back to, it's not like a stable coin or like, you can take a stable coin anywhere. With a tokenized security, you have to abide by the jurisdiction that you're in. So I don't know if I answered your question, but operationally, there's no difference in how the chains or the chain is actually agnostic to jurisdictions. That's the beauty of blockchain. It's the jurisdictions and the regulations that actually impose the differences.
That's amazing. I think seamless is like a really, really important topic when it comes, like you mentioned, about the infrastructure and a stablecoin. Just it's a border, so you can just trade, transfer everywhere more like smoother. And I think like when it comes to stablecoin, I think a lot of people here and also know like in crypto space know about the stablecoin. Even like for me, we do the media. A lot of people ask us like, what is a stablecoin and how we can do stablecoin, even though they are not from a crypto background. A lot of people like recognize stablecoin as a new type of like transferring and then like cross-border payments. So I want to ask the other questions. It's gonna be, what role do stablecoin play within institutional cloud law and then settlement strategies? Can I ask you, Michael?
Sure. So Zenbank actually is honored enough to be the first one launching the Dirham stablecoins in a multi-blockchain in the UAE. So basically, the nature is actually for the coin is a fiat-based one-to-one. It very depends on the jurisdictions on the countries. I mean, how you managing a reserve. In a country like the UAE, actually, that's they classify 50% has to be on a cash, 50% actually has to be the liquid asset, but it's less flexible compared to the US, where you can actually invest a BTC. That means we can only invest, let's say, the short-term money market funds, money market bills, or other liquid assets. Now, this kind of stablecoin actually in the context of the UAE can be quite different compared to the other jurisdictions. So the purpose of the stablecoin actually has a multiple purpose for our coin. Number one, actually, like what you said, I mean, it's the cross-border trades and then also our remittance. UAE is the second largest our remittance after the US. And then you can imagine actually there's some capital control as well in Africa, where actually can solve some problem, that's delivery on the unreachable country in that sense. Second, because of the nature of the UAE is a re-export hub to the Middle East and North Africa, where you can imagine actually Hong Kong is the same, which is playing the role for the re-export for the China, right? Today, the typical problem we are having is that if we have, let's say, a single US dollar stablecoin in the middle, you didn't solve the whole problem, because you can imagine on the UAE, you on-ramp, off-ramp, the other side, and then you on-ramp, off-ramp based on the US dollars, presuming that actually the designated country and the sending country, they are not a US. But at the end, actually, you have to convert back to the fiat of the countries. Now, if it's unfortunately fall to actually off hours on the Friday night, you can't actually really value the money until the Monday. Now, that creates a very big issue when you're talking about the high-value takers, especially UAE, they export the oil, right? And then when you have a precious metal from Africa and then two-day interest matters. But that can actually force the supplier to have an invoice discounting, which is can be quite, depends on the market volatilizations, and then that can be quite deep in terms of the discount. So I think stablecoin in that case actually help a lot actually to hedge again the settlement risk. And the second actually is that I think the next wave of the stablecoin market is no longer just talking about single currency, but actually it's like a pair. And then the gate from the receiving and the gate on the sending. In that case, you really solve the problem of 724.
Amazing, thank you. What about Kayan?
Yeah, I think earlier I touched on that there are certain exchange and clearing CCPs, they only accept cash as a collateral. Then I would say that stablecoin is the tokenized version of that, right? It's basically tokenized cash, except where it's fungible. Let's say it's fungible on the balance sheet against cash and cash equivalent. Let's say it's fungible. There's mutual recognition scheme between the Genius Act of the U.S. and the stablecoin bill of Hong Kong. Then that is the holy grail, right? If we can achieve that in stablecoin, then I think it's gonna be a superb collateral, because one, it's so vanilla. You don't apply haircut to something so vanilla, and it's backed by real world assets, and it's governed by law by multiple jurisdictions, right? Two, it's instant, it's 24/7, and that works well for as a collateral, because when you do futures and option tradings, these margin calls could be out of nowhere, right? Just look at silver, look at gold. I mean, it crashed over like one day, was like 20%, 30%. Gold right now actually has more volatility than Bitcoin. it's a very different world we live in, and I think it also calls for a different kind of collateral, because if you look at it today, we've got crypto, we've got event contracts that will be that are trading over the weekends, that is 24/7, and soon, we'll have tokenized equity. We already have, tokenized money market funds, and asset managers are going to tokenize more of their fund shelf. I think the investment shelf is moving 24/7, and that calls for a 24/7 instant collateral as well.
Yeah, I can see like world has been changing like 24/7, and a lot of things are happening. And at the same time, even though the topic today is like everything becomes collateral, I think still need a lot of process to move forward for this conversation. And then like they mentioned, definitely stablecoin is going to be the key point that we can move forward about this. But also, I think there's still a little bit more things we need to come up for this. So I think what needs to mature, like before broader institutional adoptions of tokenized collateral. Emma, can you ask about this?
I think today they don't fit in the current frameworks, right? They are really on the side. So either they are on private chains of banks. So for example, at Fidelity International, we have participated in JP Morgan Kinexys tokenized collateral network, but that's something that is really on the side, operated, by JP Morgan for the purpose of JP Morgan clients. And then you have the on-chain, world where basically you post, in your custody account, and this is integrated with the crypto exchanges. And, the rest, all the banks are really trying to figure out, how to really upgrade the current system. So right now it's still two avenues, and it's how, as Karen mentioned, how we're going to make that merge at some point, and eventually the large bank upgrade their infrastructure in order to enable, more of those tokenized assets, and eventually totally switch, on blockchain.
What about you, Ken?
I just wanted to sort of go back one question before institutional adoption. So I think stable coins are a great means to, and they've clearly seen the wave, but they're great means for cross-border money movement. They're fast, they're stable. Ultimately, though, they're backed by either cash and T-bills or very safe assets. You have to look through what the composability of the composition of that is. However, for collateral, why does a stable coin make more sense than a tokenized money market fund or a tokenized set of liquid T-bills? To me, you're able to offset your borrowing cost while posting up the same treasuries. The only difference between a stable coin and a tokenized money market fund, one is paying out the yield as a security, the other is not. And the one is giving you a yield while you're holding the collateral, the other is not. So I think investors need to be able to differentiate that. They're using it for collateral. I sort of have some questions about why. And if it's a stable coin that's issuing yield or rewards, let's call it rewards because it's not a security, then I have a question on the regulatory treatment of those versus actual tokenized securities. So going back to the question on institutional adoption, look, I think what I've noticed in the last couple of years is there's still a lot of education and awareness. The banks are not fully there yet. They have their own internal risk and compliance and monitoring systems and incumbent systems that are in place. Anything that requires dealing with anything that's on-chain requires a whole team set up, system set up, and I don't think a lot of firms are there yet. So until that happens, and until institutions see both the retail value as well as the institutional value for their clients, the adoption curve has got some ways to go.
Okay, thank you so much. You want to follow up, Kayan?
I think to supplement what Emma and Chetan already said and very nicely put, I think it's one, the regulation. I think the CFTC, they've been very hard at work. The 2539 letter, etc. I think it really paves way forward for the CCPs to the market infrastructure players to banks like us to really look at tokenized instruments as a collateral, right? And that in turn spins, the flywheel for asset managers for issuing products that are intended to be used as collateral. I think one, regulatory clarity has to be there. Two is, I think, whether all of the market participants are tokenization ready, right? So if I come from a banking view, it's more than just, whether the CCP, they allow UBS to post, tokenized money market fund or stable coin as collateral, but it's also about whether we have the ability to custodize it. From an order management perspective, let's say I've got a wealth client or an investment banking client, they want to subscribe to a money market fund using UBS system. Can our order management system, is our order management system actually connected to the blockchain, right? So I think until we solve the infrastructure problem and the ecosystem problem, then I think we're not there yet. But I think a lot of market participants are recognizing the fragmentation of the playing field and are working very hard towards it.
Yeah, I just wanted to add, there is an interesting working group called GDF, Global Digital Finance Working Group, that has basically worked last year in a lot of problems around posting basically tokenized money market fund as derivatives margins. And they highlight some of the regulatory and as well operational constraints, and it's not coming from me but from them. Basically what they say is that in Luxembourg you have full clarity around the fact that you can use a token for posting margin. Then you have issues in the UK, and that UK is actually coming just into a consultative stage, so they hope that this year they should bring more clarity in the UK with the FCA. Ireland, they said that Ireland, eventually you can basically hope that the regulator and the laws will see a tokenized money market fund as a normal money market fund. And I think this is just a constraint that they have applied for European jurisdiction, and they will be doing more work in the US and eventually Asia as well, in order to bring some industry clarity of what can be done around those products. So yeah, something, just a working group that is worth watching.
Thank you so much. So I think we have a lot of discussion today about the cloud law, and I want to ask you guys more how you can see it in the future. So it's gonna be a last question, but I want you to guys have 2 or 3 minutes each to talk about how do you guys see cloud law in 5 years. It doesn't have to be on-chain to me. I just want to hear your general opinion about this. Can I start from Sharon?
Yeah, sure. So over 5 years for 2 minutes. Look, I think I could cover it in 2 seconds. We'd love to see collateral tokenized money market funds as, a multi-billion, if not trillion. It's a $19 trillion collateral stake or position in place. So are there benefits to how the blockchain can help make this more efficient, more transparent, real-time? Are there advantages for people to actually borrow using a tokenized fund as opposed to the way it's currently done? I would certainly say yes to all of that, and the ultimate measure of this is more venues, more clients, more institutions, more banks, and more regulators adopting and blessing the use of tokenized money market funds as collateral. It's really as simple as that. And just to take a bit of a step back, for us, there is certainly a focus on the money market funds, which is asset managers. We've launched as a test bed for tokenization. And we obviously want to scale that. But this translates to all the other funds as well. So the point I keep getting and focusing on is scale, scale, scale. Because until this industry, we're well past the stage of experimentation and POCs. The full engine of Franklin Templeton, at least, is focused on how to deliver the assets in a very reasonable period of time. And that's not 10 years. That's, hopefully 10 months or a year. So that's all I would say about what our expectations are on the future.
I think we often hear that event contracts and crypto, it starts the flywheel for tokenized collateral, which is 24/7 and instant. But I think if we look at crypto and events as of today, right, it's still a very small market. I do think that the traditional underlyings, they need to be tokenized in order to create a sufficient inertia or sufficient momentum for a 24/7 collateral. So I think I would like to see in the next 5 years tokenized equity, tokenized bond, natively tokenized. And I think the States, it's you know, very much in the future, right? The DTC, I do think tokenization has to happen in the custody layer. You know, NYSE, they're looking at tokenizing the trading venue. And I think that's the right way to start, right? It starts at the custody layer. It's an infrastructure play, and then gradually it's a flywheel.
So first, I pro on the tokenized money market fund, but I also pro actually on the most liquid asset, which is stablecoins. You know, we talk about collateral, right? So what means to the collateral is that we talk about how to do the margin call during the office hours, right? The most liquid asset, most stabilized asset, and then as long as legal enforcement, that will be the preference. I think the gap today depends on the debate in the US. If the bankers win, we're not allowing the stablecoin to have a yield bearing, and then in that case, that will take many years. But if the bankers lose, where actually stablecoin will allow to have a yield bearing, and then I think the most liquid assets still the cash, in that case, which is the tokenized money, the cash, which is a stablecoin. If this can adopt, so based on actually the Basel, because all the institutions were based on the Basel, and then I think that reflect at least, you know, from the BIS go to the Basel and then go to the bank at least 2 to 3 years. I'm pretty optimistic. I think this will happen actually within 5 years.
Yeah, we think that, you know, 2 to 3 years. Yeah, for sure, you know, in the next 5 years, we estimate that there will be about, you know, 500 billion of digital liquidity funds on chain, right? That the potential, if you look at just stablecoin reserve, the collateral use case, the fact that as well all the on-chain treasuries companies are looking to diversify away from stale idle cash to tokenized money market fund or digital liquidity fund. This gives a lot, you know, to progress. The collateral use case is something that requires more operational, you know, implementation as well. So that's going to take a bit longer time, but in 5 years, this should be a shift, right? And I agree with Kayan's point that we need as well the underlyings in order to make that more efficient. Otherwise, you know, what we believe at Fidelity is to bridge in the meantime, you will have to rely on a lot of, you know, credit facility, market making in order to develop that 24/7 components. So we still have a way to get there, but it won't be as good as when we'll have, you know, tokenized bonds.
Thank you so much. So I really appreciate like all the questions and the answer today you had. And I think a lot of people are pretty familiar with like tokenization and also like, interested not only as a cloud law. So today, as we talk, like a lot of things starting from a cloud law, but also like including like tokenize the MFF, stablecoin, other ways. So I want to ask you guys if you guys have any question to these professors here. Any questions? Probably it's going to be acceptable, but if you have any, raise your hands, please. There's no questions. Yeah, I think, all right. So I think it's the time to end. And then we appreciate our speakers here. Shout out to everybody here. And thank you so much for listening.
Thank you very much.
Thank you. All right, there we go. And if you guys can gather up at the front, we'd love to get a photo. Brilliant. There we go. All right, laying it in. Look at, I saw you ready with a question down there, but don't worry, you can grab these guys when they come off stage. All right, thank you very much, you guys. Absolutely fantastic. Brilliant. Thank you so much, Emma. There we go. Real great job. All right, we're going to be looking a little bit of broader perspective about where crypto's going. Some people would argue the froth has been blown off the top, but, you know, we've been here before. We've seen this before. We got a great panel that's getting ready to come up and join us right now to discuss about the future of crypto and digital assets in particular. They're going to be led by Ms. Sachdev. Nikita Sachdev from Luna PR is going to be leading this group, which is going to include David Martin from Clear Street. We're going to have Chris Tyrer from Bullish is going to be part of this. And of course, a lot of you know that Bullish has been making big moves in this part of the world. Erkan Kaya is going to be joining us right up here. He's with ABEX. If you have a look at the backs of your seats, you'll see it right there. And finally, from Anchorage Digital, we are going to part the waters for Moses Lee, who's going to come and sit right here on our panel. And if Nikita is ready for action, Ms. Sachdev, the floor is yours. Please, ladies and gentlemen, let's give them a little love as they come up to the stage. Thank you very much, Nikita. Erkan, absolutely brilliant. Mr. Martin, ready for action. There we go. Chris, knock him dead. There we go. And finally, the man from Anchorage Digital, Moses Lee. Thank you.
Amazing. Well, good afternoon, everybody. I think this is the last panel of the day, so we got to make it really exciting. We'll start off with some introductions. My name is Nikita Sachdev. I'm the CEO and founder of Luna PR. We're a PR agency headquartered in Dubai with offices in New York and London. Been in the space since 2017, started my crypto career with Huobi Exchange, now HTX in Singapore, and now in Dubai. Over to you guys.
Hi, I'm Erkan. I'm the CEO of ABEX. We specialize in advanced trading algorithms, and basically that's our specialty. Thank you.
Awesome. Hello, everyone. I'm David. I spent about 11 years in TradFi as a quant. I jumped into crypto in 2015 because I found out the exchanges were giving away free data. I ran a fund in the space from 15 to 20. I then joined FalconX to help build out the institutional premise within the crypto industry. Was there for about 5 years. And I just jumped over to Clear Street, which is a TradFi prime broker that's jumping into the crypto space.
Hi, everyone. Chris Tyrer. I'm president of Bullish Exchange. We're an institutionally focused digital asset exchange, globally regulated. We do about $3 billion a day, which in practical terms means that we do more spot Bitcoin, more spot ETH than Coinbase. We went public last year on the New York Stock Exchange. Nice to be here.
Hi, I'm Moses, and I represent Anchorage Digital in APAC region. So Anchorage Digital is a crypto-native platform purpose-built for institutions to participate in digital assets. We operate as a federally chartered bank in the United States and also operate in Singapore as a major payment institution. Our services include custody, trading, settlements, as well as on-chain services such as staking and governance. We also recently started to become a stablecoin issuer, and as many of you might have heard, we have also partnered with Tether as the issuer of USAT in the United States. Thank you.
That's amazing. Some fantastic panelists, and I'm guessing you guys have been in the space for quite a while. Today's panel is about after the hype, what stayed, what's next. And it's an interesting moment in time. This past 1 year, we've seen a massive shift towards the US with Trump coming in, legislation being a little bit more friendlier towards crypto. We've seen companies go public. We've seen digital asset treasuries, the rise of stable coins, and RWA, of course, the buzzword. What narratives will continue from here? What is actually here to stay, and what is hype?
I'll jump first. So, I mean, I think there's a couple of things, right? Like, the number one thing that I would cite is a few years ago, we were asking when the institutions are coming, and now it's about how do we scale all these crypto businesses and unify it with TradFi. And I think if we had to boil that down, you've got about like a year ago, October 24th or 2024, you had about 4% of Bitcoin wrapped up in TradFi-related products. That scaled to about 11% of the outstanding float. And about 30-ish% of spot Bitcoin is traded in TradFi and related assets. And so you're seeing this massive convergence. I think one of the benefits of that is that the institutions are here and they're actively participating in the market. And even though that we've got this like 45, 50% drawdown from the peak in crypto pricing, the interest overall remains relatively elevated, even if the price action isn't showing it. And so I think a lot of the conversations that I have is like a crypto native portfolio manager a year and a half ago was only trading digital assets, or they were trading derivatives of digital assets. But now they've got a healthy chunk of their portfolio in assets that are more akin to TradFi, like equities and DATs, mining stocks and things of that nature. And so you're absolutely kind of seeing this convergence take place right in front of our eyes. And for those of us that have been kind of in the crypto space for a long time, building on the institutional side, this is kind of the moment that we've been waiting for, and now it's time to really execute and scale.
Yeah, I would say, I would split it into a couple of different categories. I'd say that there's the, there's what's kind of already here and has proven itself. I'd say really only kind of like Bitcoin fits into that. Bitcoin's on its way to realizing its terminal value as a digital monetary commodity. I don't think there's anybody that, the kind of, Bitcoin is going to zero. I think like there's very, very few people around that sort of still believe that. Then there's next like ready for prime time. And I'd say that, you could put stable coins there, $300 billion AUM or market cap. That's, I think that's about to explode even more so than it has already. And look, really stablecoins were the first successful use case of tokenization. People have been talking about tokenization for 10 plus years. It's taken a very long time, even though people could look at the rails and say, hey, this is just a more efficient way of issuing, trading, settling, reconciling, all assets or all contracts. Really it took, stablecoins to kind of prove it out and get to the scale that it has to demonstrate the value of the use case, so on and so forth. And now we're just seeing everything else come in. So I think that, trivially we'll see, all asset classes experiment with tokenization from FX to private equity, private credit, so on and so forth. So I think that, and then there's kind of everything else. And I'd put kind of like Web3 and, all that stuff in there as well. TBD on whether that kind of survives and whether there's a persistent use case and persistent interest. But I'd sort of categorize it in those terms.
And sorry, what do you mean by that? Like in terms of like NFTs, metaverse, is that
yeah,
what
I just think there's a lot of stuff like we've been through DeFi summer, NFT summer, we've been through, there's a lot of historic narratives. Like I think DeFi has proven itself out, but now is that going to get strangled by, controlling the on and off ramps? The market structure bill is debating DeFi as we speak. That has the potential to, really throw the brakes on, some of the innovation and some of the growth there. So yeah, I think that it's yet to be proven. It hasn't found product market fit. DeFi is slightly different. Like you look at Hype and Astra and so on and so forth. I mean, they're trading massive volume. NFTs are a good example though. Like, I think that's a really interesting space, but it hasn't really lifted off and hit sort of mainstream public adoption as yet. And I think there's a question mark as to whether it ever really does.
Yeah, I like what you said about product market fit. I think that's very important. It reminded me of, I live in Dubai, and the Dubai police has actually integrated NFTs for stolen passports. And I think there's some case studies like title deeds and passports that are really good case studies for NFTs. But I think maybe it was just the wrong products being put into market and very hype focused. But sorry, Moses and Erkan are curious to hear your thoughts on what's surviving this market.
Yeah, I think I'm like the particular thing I observe is the derivatives market is here to stay. Basically, the more the activity is shifting from the spot and small coins into big coins and like Bitcoin, and then from there it moves into the derivative space, and then from there it moves into the more advanced derivative space, and that is a great indicator for the institutional needs and how the product space is evolving. So for me, it's a clear path towards moving into this shape. So more retail-driven products are becoming less interesting overall. The other thing that I see that there is a smaller correlation between the products that are the projects that are building particularly interesting pieces in the space versus how much they're actually trading or what the value of that token is. And so that's another interesting thing, which means that the survivability of these projects are not necessarily backed by the trading activity. And then you have a question there. So there's a lot of unknowns in front of us on what's going to survive, what's not going to survive.
And Erkan, I'm curious, do you think that's a good thing for the space, that there's less retail interest from what you're saying, or less interest in retail products and more institutional?
Good question. I think retail drives the individual's needs, which are often less sophisticated than the institutionals. Institutions tend to drive the more advanced product models, more advanced shapes, more structures. And in the retail, you're often looking to get the most out of your money by leveraging the highest and more of a bid on, sparse bids. So institutional volume will push us towards the more advanced product space, I believe.
And with institution also comes more institutional adoption, comes a little bit more regulation, regulated structures. And the crypto space was initially built on peer-to-peer, decentralized. It was meant to be more retail focused, in my opinion. So how do you think both the institutional and retail parts will come together? Do you think the pendulum will swing more towards the institutional side, or do you foresee a good balance in the future?
I think the regulation itself is finding its feet on what to regulate and what to not regulate too strongly. I think it's caused some of the firms to, be kicked out of countries and move into other countries, and so the crypto industry is still shifting around, finding the right regulatory space to operate for its needs. We believe in regulatory regulation to improve the space very much. So we have just achieved our FCA full authorization, which allows us to do derivatives as agency, which is a fully authorized activity in the UK, as well as we have
Congrats.
Sorry?
That's a huge deal. Congrats.
Thank you very much. I appreciate it. As well as we have the FCA crypto license, which allows us to do principal trading, custody, and on-off ramping. So we're fully aligned with the regulatory side, because we believe that allows you to operate in a more safe and innovation within a framework where it's safe for everyone and more institutional welcoming.
Thank you, Moses. I'm curious to hear your thoughts.
First of all, hate to say that the hype is over. I think the hype is maybe a little bit more subdued, but definitely there's different focuses now. So, for example, we've spent maybe 3-4 years working on block space, block availability. I think people forget that maybe 3 years ago, we kind of couldn't imagine a world where there was enough block space readily available and cheap enough to actually use. And so that has largely been addressed. And so now we are able to actually scale with use cases like DEXs that have been tremendously successful with Hyperliquid and so forth, as well as stablecoins. So you could not use stablecoins the way we are planning and using stablecoins outside of trading without that kind of infrastructure that's been built over the past 3 years. So what's more important now is how we use the block space, not like building additional infrastructure for the block space. So that is something that will continue to be an enormous focus. So what is the product market fit outside of trading and remittances and payments? Those will be very interesting going forward.
And when we look at the next coming years, a lot of people talk about the quantum threat. They talk about AI being a threat to crypto, or even a change in the political party in the U.S., maybe backtracking regulation. So, do you see these parts as risks, and what else do you see as a risk to crypto in the future?
So regulation is super important. Without regulation, institutions will not participate in crypto. So that is a fact. So for example, banks, they are still limited from full participation in public blockchains due to BIS regulations on capital requirements. So regulations, step by step, it's being implemented in different countries with different types of regulation. And as you said, politics matters a lot. Anchorage Digital was the first federally chartered bank 5 years ago. And that was put on pause as far as bank license issuance for crypto companies, largely due to the political environment. And then you found that last month there were many, many bank licenses issued in the US. So definitely politics matters, regulation matters, and regulation really is the key for successful entrance in the institutional space.
I think that some of this is, there's definitely been gasoline poured on the fire of the industry in the US just with the Trump administration and the focus that they've had on it. I mean, it was the #1 policy priority, with Trump incoming. That said, like so look, if he's, he's got, this is his last term, and after that, if there's a Dem candidate in the White House, then, things could reverse course. How much are they going to reverse course? Like, I think that, the Overton window is now shut. I don't think that Liz Warren and, her anti-crypto army have the same kind of sway that they did. That said, you look at, if the Dems really wanted to take retribution on Trump, what would be the easiest thing to do? Go after some of the kind of crypto wealth that he and his family have built. So I think that we could see, some slowdown, some reversal. And so these things definitely hold risk. But what I would say is that, it's kind of interesting to me because, if you rewind, the price action of crypto right now and the sentiment around tokenization just could not be more different. So I think that, whilst we've seen, we basically we're in the middle of a sort of 50% drawdown in Bitcoin, and maybe there's more to go. The flip side is that on the tokenization front, I mean, you look at like the sort of ADV of non-RWA tokenized assets. In Jan 25, we were trading $32 million. Jan 26, we traded 1.2 billion. So there's this kind of like, I think awakening that everybody's come to terms with the fact that, everything's going on chain. And there couldn't be more divergence between, the current market sentiment around crypto native assets and then the direction of travel as it pertains to financial market infrastructure. And so that's a genie that you're not going to put back in the bottle.
I'd agree with that. I think, as I mentioned before, the infrastructure is now robust enough to build on. And so the most important thing that many people forget is that with public blockchains, you have one source of truth. And that is a huge technological difference than what is happening in the TradFi space, where, like, for example, in a TradFi space, if you had to send an international wire from one country to another, then it's almost like riding a train and stopping in many stops. Whereas with public blockchains, you don't have those kind of rails. It's like an airplane and going point to point. So it's now very apparent that we are dealing with a superior technology, and obviously regulation matters. The sad thing is that better technology doesn't always win. So I'd say TradFi will also get better. So it's upon us to keep on pushing.
Okay, so Moses, when we're talking about, you're saying that it's not always like the best technology doesn't win. What infrastructure will win? There's so many chains out there. There's so many L1s. People are then building L2s. And sometimes they're adding a bit of a layer of complication. Like, we're all trying to strive for mass adoption. We're trying to keep the technology as simple for the mainstream to understand. Which infrastructure wins? Which chain do these RWAs build on? Which stable coins do people use?
So with blockchains, network effect is something that is massive. Blockchain, public blockchain, it follows the internet rule. And so network effect is something that needs to be supported by the underlying technology as well. And the technology also needs to continue to improve. The other thing I would mention is that, yes, block space is now more available and cheap, but then there are other problems that have not been fully addressed, such as privacy.
Yeah, and I'd say the actual chain of which one wins is like, that's a developer question of like what makes more sense, and those guys are much smarter than I at that world, right? But what I would say is like crypto still kind of needs its moment where it becomes easy for the everyday user to access crypto, right? And so a lot of institutions, a lot of retail apps are focusing on basically how do we kind of mask away some of the complicated things like you were mentioning, right? Like once upon a time, you know, you put money into Coinbase, you convert your dollars into USDC, you move it into your MetaMask wallet, now you can trade in DeFi, then you want to lend it or stake it or generate yield in some fashion. Those are a lot of steps to keep track of, right? And there's not one centralized view. And so for me, I think like the underlying chain, the ones that get the network adoption and the ones that builders want to build on top of are the ones that are going to win, and I don't really have a fighting horse in that race. But I will say, I think that crypto needs a UI upgrade, and a lot of folks on the institutional and retail side are working on doing that right now.
I'll kind of add to that. I think one of the reasons why we would say that the hype is over is because I think we've reached a certain point where we've gotten enough friction where we've already onboarded the retail users, the individuals that are willing and able to manage their own private key. Most of the world will not do that. And that's why institutions coming into the digital asset space will improve the UX. And then what kind of chain is used will actually be more influenced by the institutions going forward.
I think we've definitely gone past the, you know, tell me how this works, and now people want to see show me how this works. Like, you know, it's definitely, you know, the world doesn't need another L1. You know, what we need is you know, is proper utility. And look, the market structure bill has the concept of a mature blockchain, capital M, capital B. You know, so if you're the SEC, you know, are you going to give authorization for a company to issue a tokenized financial instrument on a brand new L1? Like, I think the answer is candidly no. And so what we're going to see is, I think, a convergence around some of the very well established and heavily understood and broadly accepted L1s, and we're going to see, I think we'll see a sort of real, you know, selection process go on. So I would imagine that we see a lot of L1s become redundant over the next kind of 5 years.
Yep, that makes sense. I think for me, we've definitely achieved that crypto is here to stay aspect, and the second part is stable coins have become a lot more commonly used, and it's become more transparent than SWIFT system in its operation, which is incredible, much faster, more transparent. I think I'm most excited about the tokenization, because I think in the tokenization has the aspect of completely swallowing up the traditional finance and into crypto, and that means everything that is in traditional finance will be replicated in the crypto space over those tokenized assets. And that's very exciting because there's a whole world of new financial system to build by us, basically.
Yeah, I think on the back of that too, like one of the themes that I don't think that people are really talking about a lot in the space right now are like on-chain asset managers, right? So because you have the growth, particularly of like yield-based products in the crypto space, now you have folks that are creating actively managed on-chain financial products for people to invest in. To carry through. And so like if crypto yield from like a basis perspective is better than the rates that you can get in TradFi, then you're going to allocate your portfolio there. But if it's TradFi yield, which generally speaking is kind of where we're at today, then you'll make an adjustment and allocate more that way, right? But I think like the concept is fairly new. There's a handful of folks that are working on doing it. It hasn't attracted a lot of assets under management, but to your point, I think this is probably one of the key themes that we're going to continue to see. And you kind of have this convergex where you're taking crypto and you're wrapping it in TradFi products like an ETF, and then you're tokenizing things and you're bringing it on chain, right? And so you're from both directions, you're swimming upstream, you're swimming downstream, but you're getting that convergex in the middle, and a lot of it is related to financial products and asset management.
And Erkan, you touched base on, this kind of crypto or tokenization completely swallowing up TradFi. Is that the end goal for tokenization to come in and completely revolutionize the traditional finance ways? Or do you feel like we're going to have a bit of a mutual ecosystem?
I think completely, like 100%, would take a very long time. But there's a practical point where you say, okay, the dominant is the crypto world. I think that's relatively within, I would imagine it to be 7 to 10 years range that we would completely swallow up the traditional finance, because you can see the biggest firms already in the space. What I didn't know is the largest firms, largest asset managers, have been mining Bitcoin since 2014 silently. And that was quite a surprise when I found out about that. And
are you talking about Fidelity?
Yes, I didn't want to name it, but yes, that was quite a surprise that they've been mining. And BlackRock is involved in tokenization. You've got the JP Morgan is creating payment rails over its own blockchain, but these own blockchain has already been done and dusted. And it's like, okay, you're going to have a chain here, you're going to have a chain here. There's going to be something that talks between the two languages, and suddenly it's all everywhere, right? So I think these are the steps we will see over time that allows us to converge into the blockchain world. And with the tokenization, with the replication, with asset managers on chain, with companies that are one side on the traditional finance, the other leg on the crypto side, will allow the replication to happen. And as such, we will migrate towards this world because it's more transparent, it's more trackable. It's kind of what the government will want as well because of its transparency. So there's a path that it flows through it.
I guess it depends what you mean by coexistence. Like if you mean, hey, look, we had all these companies that were super successful on the old traditional rails like NASDAQ and New York Stock Exchange and so on and so forth. But, here the crypto guys come and they're just going to take everything over. Like, I don't think that's going to happen. Like, I think if what you're talking, so, like, there's no way that those guys are just going to lie down and let somebody, well, it was fun while it lasted and just let, Coinbase and Robinhood come and eat their lunch. Like, I think that there's definitely going to be, the New York Stock Exchange announced that they were going to go 24/7, which I think, now, one of the interesting things is that crypto has demonstrated that you can, run an exchange 24/7, 365 with minimal downtime. That's not something that people thought was really possible. It was all kind of batch processing and taken down for maintenance and weekend closes and so on and so forth. So I think that, just in terms of infrastructure, I think that the infrastructure itself is going to be adopted. I think that, how we, issue and trade financial instruments will definitely change. But a lot of the big legacy companies are going to maintain, they're going to adopt the technology as opposed to be replaced themselves. I mean, I think one of the interesting things is kind of figuring out, what happens with stable coins. We think about this a lot, and when you think about it, a stable coin it's whether the analogy is stablecoin cash or is it a settlement product, and because within let's say within the US. With all these kind of payment apps, you can settle 24/7, 365 between each other. It's not full and final settlement. There's still a credit obligation between the two different financial institutions, but it works pretty well. So, and one of the sort of, so does stablecoins have a role place in replacing money? The issue with stablecoins, of course, is that they're fully reserved. And so, if everybody moves to stablecoins, you just remove the deposit base of banks, and then you remove the ability for banks to create credit in the same way that they do. So I think that I'm not sure that we're, this is why all the banks obviously want to issue tokenized deposits. Tokenized deposits have a bit of a marketing issue because they're fractionally reserved. So if somebody says, hey, you can have this thing that's fully backed and, the reserves are audited and you can have a look at the smart contract and you can see that the number of tokens issued is less than the amount of the deposit base that we have the underpin it. Or you can have this thing that's only got 12% of the assets. Well, which one are you going to use? You're probably going to use the one that's fully funded. And so I think that there's still some question mark around like the extent to which stablecoins, as an example of a tokenized asset, integrate into the way that we conduct business. For cross-border trade settlement, it's perfect. For domestic, payments, I'm less convinced.
So when you're talking about tokenization, just because this topic is so spoken about in 2025, 2026, Chris, you just mentioned NASDAQ started trading 24/7. So do all assets really need to be tokenized now? I mean, you have TradFi already making things more accessible. That's one of the reasons why people are tokenizing assets. So I just wonder, is right now we're talking about putting all assets on chain, but is that really a necessity?
Look, things work pretty well right now, which is why there hasn't been a ton of inertia. Because I think, look, 10 years ago, people were talking about tokenization, and people thought it was all going to happen a lot faster than it's happened, myself included. The problem is it's really a coordination issue, because you need the companies, the banks, the exchanges, the regulators, the CSDs, et cetera, all to kind of like get over the line at the same time. And so this is why it's been kind of slow progress, coupled with the fact that it kind of works, right? But, is it more efficient? Yeah, or do you remove all these unnecessary layers of complexity? 100%. So, like, I think that, and do you make, settlement and reconciliation a lot more efficient? Yeah, 100% again. So I think that, like, the inertia over time will take us there. But yeah, like I don't think is it something that we need to do tomorrow in order to save the fight? No, I think it's just that operational efficiency and the desire to capture those efficiencies will drive us there over time.
And I think from a tokenization standpoint, the kind of key benefits, if we break it down, right? Like number one is liquidity. Number two is like freedom of choice, right? If I'm have my assets custody with a broker, I can easily pick them up. I can move them to wherever I want, right? And I kind of break it down in those two key premises. Now, I think one of the issues that we have with tokenization right now, because a huge believer, I remember when like the St. Regis and Aspen got tokenized in 2018, I believe it was, and I was like, yeah, this is awesome. And I thought we were just going to go on this like rock and roll tokenization of the world narrative, and cool, we're still on that journey, right? But I think one of the issues that the market is facing right now is that like a lot of people are spinning up new RWA platforms. You got a lot of new venues that people are basically doing the trading as well as the tokenization. And if you think about trading at its most basic level, like you need decentralized pools, right? Whether it's centralized or decentralized doesn't matter, but I need a source of liquidity. And there's too many platforms, right? And so you've kind of seen an aggregation of where flow goes from an exchange perspective in just like spot crypto as well as derivatives. Right now, I would say tokenization is kind of in that like 2015, 16, 17 stage where the crypto exchanges were. And you're going to go through and you're going to see the ones that capture the demand, and then you're going to see a consolidation phase. And I think like once you can actually bring liquidity, you can use these underlying assets as collateral. You get the functionality and use case of them. I think that's when people will start to see the real underlying benefit alongside the like safekeeping and freedom of choice to move your assets when you wish.
Yeah, 2017 St. Regis Aspen was one of the first use cases of back then what we used to call security token, now RWA. I think Stefan Debates built it on Tezos. I don't know, why he chose Tezos, which is why I was asking the question earlier, which chain wins? How do you decide what chain to build on? And his biggest struggle was getting the retail audience to come in to the space. People didn't know, where do I buy this fractionalized share of the St. Regis? Today, do you think that we could see exchanges like NASDAQ or platforms like Robinhood offer these type of assets? Or do you think it's going to come more from the crypto side, like Binance and Bybit? Which one do you think is going to offer assets like this?
I mean, in short, I'd say all of the above right now. You see the arms race right now with like, you've got Robinhood swimming down deep into the crypto world. You've got Coinbase excessively going after the equity world. You've got equities listed on Binance and OKX, and like everything is converging, right? And to me, that also means RWAs. And I think at the end of the day, like the most simple thing is like, where's the network effect, and then where's liquidity, right? And so people are going to choose, and I think like one awesome example recently is like the success of Hyperliquid, right? Came out of nowhere, stole all the DEX flow, continues to be very supportive in the industry. In addition, has garnered a lot of volume, continues to push the bounds of like what assets they're listing on there. And it also has quite a bit of like network effect and hype, right? It's cool to trade on Hyperliquid, and it has been, which it used to be, and it still kind of is. Like Binance also used to carry that in the 17s, 18s, 19s in the crypto space. So I'd kind of fast forward to just say, I think everybody's going to try to be the one-stop shop, right? This includes the institutional side as well as the retail side. Everybody is going after all assets, including prediction markets. And the ones that aggregate the flow and have the liquidity are going to end up winning and then consolidating other platforms.
Moses, were you going to say something? Did you want to chime in on that?
I suppose taking it up from a more high level, why would you want to tokenize something? Like, and from a crypto native looking back, there's been many experiments in tokenizing, and a lot of dead bodies are in the past. So tokenizing something doesn't mean success. You really have to understand why you're tokenizing something. And one of the things that are key is distribution channels. And then also the other thing that I kind of consider is like tokenizing something gives you certain benefits. One is you could tokenize something to use it as a reserve asset. You could tokenize something to be a tradable asset. You can tokenize something for it to be a transactional instrument. So let's just take BlackRock's BIDL for an example. So BlackRock BIDL, Anchorage Digital uses BlackRock BIDL to use it as a reserve asset for stablecoins, for example, USDTB. So that's great, but then you can also invest in BlackRock BIDL as a investable asset, a money market fund. And then not too far in the future, you could potentially have two institutions just settle with BlackRock BIDL as a transactional instrument. So those are kind of like compelling reasons to tokenize something. You actually have some benefits. You have distribution and you have benefits. And that gives you an edge over, like, let's say, some database. So those are some of the higher level things I think about for success in the RWA tokenization space.
Awesome.
I think there's also another angle where the retail really is keen for some exposure as quick as possible, as straightforward as possible. So being able to trade from their web UI, where they buy and sell a token in like Tesla, for example, stocks tokenized in their own, like, I don't know, whatever DEX they want to trade in, that's quite attractive. And it skips a lot of steps for them to achieve if they wanted to do this in the normal ways and buy. Also, other part is that they can trade in more micro sizes. Right? That's another piece, which is actually the traditional finance instruments are also converted into the mini versions when the contract sizes are large, so that the retail participation can be done with the contract sizes. So similar to that is another use where it is all towards the ability to trade and exposure. And I can imagine, I don't know, a yield product to be not so interesting for a retail to participate, but that's more institutional. But retail is always there for exciting trading opportunities. So I totally see the entire stock market to be converted into tokenized with no hesitation.
Okay, great. Well, last question to close up the panel. What are you most excited about this year in 2026?
I'll kick it off. I mean, I think what I said earlier about the worlds are colliding, and so a lot of institutional and retail counterparties are basically building the bridges between crypto in digital assets. And after sitting in the space for a number of years, I find like this is probably one of the most exciting things. Like, how do you truly solve something like capital efficiency across asset classes? How do you bridge the two worlds to get more functionality and use cases out of it? And at the end of the day, I think like we're very much on the journey and on our way right now to solving some of those things that people have been talking about for a long time. I think the next 2 years are primarily about how do we scale in massive size within the crypto space to service both retail and institutions alike. And I think it's like, it boils down to the ease of use. How easy is it to get into a position at midnight and when the stock market's closed? How do I fungibly use my assets as collateral? How do I get yield on an underlying asset and use BIDL instead of using dollars and have less friction? And I think that's the space that the market's in right now, which I find to be quite exciting, because we're moving past that early stage of like, hey, this is super cool, but it's crazy complicated, into people are basically building the layers on top of it to make it easy to use for everybody, which then breeds more adoption.
Chris, Moses, Erkan, in one word, what are you most excited about for 2026?
In a word, probably tokenization.
Stable coins for cross-border trade settlement. This is going to be huge.
That's too many words.
I get a pass because someone made fun of me with a Moses part the ocean joke for an introduction.
Yes, I'm very excited about tokenization and the derivative products that builds on top of the tokenizations.
Amazing. Well, thank you so much. Thank you, everybody.
Thank you so much. Brilliant job, Nikita. Well done. If you guys would come front and center for a photo, we'd love to capture the moment as we finish up here. There we go. Once again, that was Nikita Sachdev from Luna PR. Thank you so much to everybody for joining us today. Consensus Week in Hong Kong is truly off to a good start here at Liquidity 2026, where we are bringing together the worlds of digital assets, tokenized assets, and traditional finance and making it all happen. Thanks, Moses. So please, make sure you're back here next year when we do Liquidity 2027. Great job, Chris. And we look forward to seeing you again. All right. Lay one of these on me. There you go, Erkan and Nikita. Well done. So once again, thank you very much for joining us at Liquidity 2026. We'll see you back here for 2027. I'm Andrew Work. Let's roll. Yeah.